Thank you. All right, good morning, ladies and gentlemen. Let's take it from the top once again. Good morning. That's great, fantastic. Thank you for bringing that energy and enthusiasm to this room, because trust me when I say this, we're going to need it, because in turn, you're going to get a big dose of it from all the speakers that are going to join us on the stage. A very, very good morning to all of you. And what an absolute pleasure and honor it is to be standing in front of this August gathering and welcoming all of you to the very much awaited Mint BFSI Summit and Awards 2024. Yes, we're super thrilled because I'm introducing to you the 16th edition of Mint's flagship financial program. And I think that calls for a round of applause. Can I request you all to please put your hands together? Thank you so much. My name is Zenia Fernandez, and well, I urge you to hold on to your seats as discussion, as deliberation, debate, and even recognition are going to keep us all on the tenterhooks through the intellectual power that we are going to witness all throughout the day. At the very outset, thank you so much to all of you for joining us here, for taking the time out of your very, very busy day. And I can assure you that we are going to make the most of every minute here. You know, much like the ever-evolving plot twists of our favorite Bollywood movies, financial services and the insurance landscape has also been going through a series of transformation in the recent times. And in today's financial extravaganza, we're here to dissect the transformation and also to measure the pulse of the BFSI industry today. Well, at the very outset, I want to take this opportunity to thank our partners who partner with us and make events like these possible. Our associate partners, Equirus Capital, IIFL Finance, Union Bank of India, Jammu and Kashmir Bank, Canara Bank, LIC of India. Our enterprise reinvention partners, Accenture, our partners, Manipal Cigna and Bank of India, and our knowledge partners, How India Lives and FISDM. Can we have a huge round of applause, ladies and gentlemen, for our partners? Thank you so much for this incredible partnership and for allowing us to put this beautiful program together. And of course, now would be the perfect time for me to invite all of you to join me in taking all the conversations on the stage and inside this room onto your social media platforms, because I think it would be the right thing to do to share our thoughts, our insights, and our takeaways with the community outside this room. And when you do that, please use hashtag MintBFSI 2024, and don't forget to tag us at Live Mint. Now, in case your friends, your colleagues have not made it here physically, don't worry, we have them covered. You can, in fact, use your cell phones right now, message them and ask them to join us as we live stream this event on livemint.com, on Mint's and also on Mint's social media channels. Now, for those of you who are familiar with Mint ABC, that I've had the pleasure of hosting for a number of years, the annual banking conclave, I'm sure the question is ripe in your minds as you sit here today, which is, why the change? Why fix something that's not already broken? And I think we must begin this morning by addressing that question. And to do that, ladies and gentlemen, please join me in welcoming on stage the man who's at the helm of this transformation, Editor-in-Chief of Mint, Ravi Krishnan. Huge round of applause for Ravi, everyone.
Good morning. Governor Das, distinguished guests, ladies and gentlemen, a very warm welcome to you all. After 15 editions of the annual banking conclave, I'm thrilled to announce that we have decided to reimagine it as a Mint BFSI Summit and Awards, as Zinnia mentioned. This banking conference is as old as Mint itself. When we launched in 2007, to be an unbiased and clear-minded chronicler of the Indian dream. And I think the financial services sector kind of embodies that spirit, that dream, that aspirations of India. This is our oldest and most prestigious event. I dare say both the event and the paper have come a long way over these years, as indeed the banking and the financial services sector has. I remember that, the topic for one of the panel discussion in a very early edition of this ABC was, should India open up the financial sector? Now, you would have thought that that was an apt topic for those times. But ironically, that event took place on the very day that Lehman Brothers filed for bankruptcy. The then RBI Governor, Dr. Subbarao, was scheduled to, put in an appearance at the event and address the audience. But he pulled out of the event because I guess he didn't want to speak on what had suddenly become a very sensitive topic. Now, today, more than 15 years later, we have another and a much broader edition, and another RBI Governor honoring us with his presence. And what a momentous time it is. The financial services sector has really taken off. The banking sector is very much in the thick of the action. We are seeing an increase in financialization of the economy. We are seeing physical and tangible things like real estate going into REITs and roads getting into InvITs. And now the arrival of Fintechs has made things really exciting. They are reshaping not only the industry, but also how individuals are managing their finances. All of this together represents a fundamental shift in the world of financial services, and we hope to capture that in today's event. This digital transformation, which everyone is talking about now, and the synergy between the different segments of the financial services sector, I mean, they are also very crucial, in having a more inclusive and responsive financial ecosystem, which is critical to India's growth. So that's why we have all of you here, the domain experts, bankers, fund managers, insurers, technology evangelists, and of course the regulators in this platform. At Mint, we are committed to asking searching questions. Ask better questions is our tagline. In that spirit, so let us collectively look at how India can create a financial landscape that is not only robust, but also inclusive and responsive. And now, it is my privilege to welcome Shri Shaktikanta Das, Governor of the Reserve Bank of India, to deliver the keynote address. Thank you. Governor Das.
Good morning, namaskar. I'm extremely delighted to be here this morning and participating in the Mint BFSI Summit. Exactly 4 years ago, I was checking up in the morning on 25th February 2020, I also participated in a similar event, a conclave on banking and financial services, which was arranged by the Mint. After that, a lot of things have happened. Much water has flown under whichever river you wish to mention. The world has changed. India has changed. And as Ravi Krishnan rightly pointed out, the Indian banking and financial services sector has also hugely changed and changed for the better. Therefore, at the outset, I would like to thank the organizers of this event, the Mint, for having invited me to be here. And it feels really good to see so many players who are so active and direct participants of the financial services sector. What I am planning to do is I wish to speak for about 20 minutes or so. Thereafter, we can have a conversation. There will be some Q&A. And so that's how we will proceed. Broadly, what I have decided is that I would like to focus on the turnaround in the Indian banking sector. So that is the area of my focus. Now, not very long ago, the Indian banking sector was, beset with a host of challenges and problems. Indian banks were weighed down by high levels of non-performing assets, while the returns on assets and quality and equity were in the negative zone. 11 banks were under the Reserve Bank's prompt corrective action as at the end of June 2018. Failure of a major non-banking financial company stoked fear and risk aversion among market participants, leading to increased costs of market borrowing, especially for those with perceived asset liability mismatches. Even as we were coping up with the stress in the financial sector caused by this failure of the ILNFS, the COVID-19 pandemic in the beginning of the year 2020 came as a shocker, which led to major disruptions across all sectors. During the last 5 years, the Reserve Bank took a series of initiatives on the regulatory and supervisory fronts, while banks themselves, to their credit, responded to the challenges by strengthening their internal defense mechanisms. As a result of these concerted efforts, there has been a gradual and consistent turnaround in the Indian banking system, despite the multitude of headwinds emanating from COVID-19, geopolitical conflicts, and sharp monetary policy tightening almost in every country in the world. All the key indicators of scheduled commercial banks, namely capital adequacy, asset quality, profitability, and similar other parameters, have now shown improvement in the last 4 years. And this was not a mean achievement, because I think if you recollect in the recollectable human history, let's say of the last 7 or 8 decades, or at least in the last 100 years, I think one after the other, so many crises and so many headwinds of such proportion and such intensity, and with such huge impact, not only on the financial sector but the real sector. I think this is a unique period in the sense, we had the COVID-19 pandemic, then the onset of the war in Ukraine, which is still continuing, has not ended. There are wars happening elsewhere, geopolitical conflicts, synchronized monetary policy tightening. So therefore, I think it is to the credit of, the Indian financial services sector to have not only withstood this, but to have emerged out of these crises in a far better shape than the banks or the NBFCs or the financial sector entities were when we entered this period of massive difficulty. Now, the financial indicators of non-banking financial companies are also in line with that of the banking system as per the latest available data. On the whole, India's banking sector has emerged, as I just said, on the whole, India's banking sector has emerged stronger from the unprecedented challenges of the recent years. Questions are often raised as to how this turnaround in the banking sector took place. My short answer to this question is that it is the result of all the good work of various stakeholders in the system. In my address today, I have therefore chosen to speak on the Reserve Bank's efforts to steady the economic ship amidst turbulent waters in the last few years. I have structured my talk in the following manner. First, I shall speak on our response to various crises, starting with the non-banking finance companies, that is the NBFC sector stress that haunted us even before the onset of the pandemic. Next, I shall dwell upon the body of work we have undertaken in recent years to revamp our regulation and supervision. Now, as to how we navigated through the crisis, I don't want to spend much time. It is there in my written text of my speech. A copy of the speech will be uploaded in the RBI website soon after this session is over. So those of you who are interested can have a look at it, because this is already well documented, and I have spoken about it at length in various other fora about how we dealt with the multiple crises which we encountered, starting with the failure of the ILFS and thereafter the COVID and war and the continuing challenges. But let me just say that in the aftermath of the infrastructure leasing and financial services crisis, the Reserve Bank heightened its focus on maintaining and fostering macroeconomic stability through a series of conventional and unconventional measures. The flexibility provided in the flexible inflation targeting framework was also utilized by us to deal with the monetary policy issues and provide the required support which the economy required during this period. So as I said, that whole period of the challenges coming from the ILFS crisis, I am skipping. I don't want to go through that. You may probably, those of you who are interested can have a look at it when it is uploaded. Now let me proceed to strengthening the regulatory architecture. While dealing with the COVID-19 pandemic related challenges, we announced and implemented a series of structural measures all through this period to strengthen our regulatory systems, shifting from an entity-based approach to a more principle and activity-based approach. These measures have played a key role in not only averting a crisis, but also enabling the financial sector and the economy to emerge stronger and healthier from the multiple crises that we experienced in the last few years. Now, during that time, a number of people, when we came out with many regulatory measures, which I will just mention, a few people, not a number of people, a few people were asking me that is it the right time to bring about these changes when the economy is beset with so many problems, the financial sector is experiencing huge crisis emanating from the impact of COVID. So why do you do it, why do you do it now? Why don't you do it later when everything normalizes? I said, look, the way the world is now developing, to expect that the situation will be normal, again, your definition of normal and somebody else's definition of normal will vary. So therefore, if there are required regulatory changes, they should be done now, because there is never a good time, to sort of do things. If you feel something is necessary, yes, the timing of your intervention, the timing of your measures are very important. But timing it does not mean, sort of just postponing issues which are considered as necessary. And we thought that the regulatory and supervisory changes which we were bringing about, our effort was to introduce them in the most non-disruptive manner that was possible, and not take the market by any negative surprise, but to see that seamlessly and without any major friction or difficulty, the new regulatory architecture or the supervisory methods, they sort of seep into the system. So in the recent period, that is from 2020 onwards, the Reserve Bank has undertaken a complete overhaul of the regulatory architecture of the banking system. The regulatory steps include, among other things, just to give a few examples, the list is pretty long. It includes the implementation of leverage ratio in June 2019, large exposure framework June 2019, guidelines on appointment of directors and constitution of committees of the boards of banks in April 21, revised guidelines on securitization of standard assets and transfer of loan exposures September 2021, scale-based regulatory framework for NBFCs October 2021, revised regulatory framework for urban cooperative banks July 2022, and guidelines on digital lending in September 2022. So you will see that throughout this period, beginning 2019 till now, we have been bringing about new regulatory architecture to add that necessary robustness into the financial system. For example, when we issued the digital lending guidelines, there were questions and there were some opinions that if you issue guidelines for digital lending, will it stifle the fintech, the lending by the fintech sector? And are we sort of stifling growth in that sector? But believe me, in fact, the data, you can look at the data. After we came out with the guidelines, if you go by the data will establish unambiguously that the confidence of private sector investors in the fintech lending sector has gone up. Not just anecdotally, but in terms of actual data. I have been told by a number of serious players in the fintech lending space that the fact that the regulator has now provided a framework, an overarching framework in which the fintech lenders or the fintech, let's say even the app providers and others who sort of operate, gives a greater confidence to the investors. So the flow of investment into the fintech space, particularly with reference to digital lending, has really grown, and the confidence in our system has really gone up. So therefore, And as you are aware, we had formed a group to study this with external experts, to study the challenges and the problems in the fintech, in the digital lending space. And based on detailed consultations, wide consultations, our guidelines were issued. So therefore, the regulatory architecture, if you look at it and compare it with what we had 5 years ago, I think the entire financial services sector space, the Reserve Bank has been able to bring in a new set of regulatory guidelines and framework which gives confidence to all the stakeholders, in not only domestic but also foreign players, when they are looking at India. And many of the things we are actually, what we have done is, India has become a pioneer in many of these areas. Of course, with regard to fintech apps and all, there are some issues, but the issues are mostly pertaining to the illegal apps which have their own different business practices, and that is a problem with which both the government and the Reserve Bank and other authorities we are dealing with that. Now, the capital and liquidity requirements which we have now introduced uniformly, they apply to all scheduled commercial banks, irrespective of their asset size and exposures. We nudged the banks for achieving complete automation of income recognition, asset classification, and provisioning processes. Notably, while the guidelines to this effect were issued as early as 2011, their full implementation was pending for a number of years. But we were able to work closely with the banks to ensure that this automation of the recognition of the NPAs was introduced into the systems of all scheduled commercial banks. Further, additional guidelines were issued in 2020 to ensure the completeness and integrity of this process. I would now like to highlight some of the other facets of Reserve Bank's regulatory efforts. There are 6 points here to which I wish to draw your attention. First, I have already touched upon it, is fostering a sustainable digital lending landscape. Post-pandemic, digital lending has seen an exponential rise in various emerging economies, including India. At the same time, it has raised a host of business conduct issues. Consequently, various regulatory dilemmas have emerged, wherein a balanced approach had to be taken. It was necessary to weigh the customer benefits brought in by innovative business models of fintechs on the one side, and the emerging business conduct and regulatory concerns on the other. The outcome of the Reserve Bank's regulatory balance was reflected in the digital lending guidelines issued in September 2022, followed by the guidelines on first loss default guarantee, that is FLDG, in June 23, covering prudential concerns and other salient facets of outsourcing, business conduct, data privacy, and digital lending operation. The regulatory objective was to rein in negative externalities while retaining the salutary effects of innovative digital models. And as I said, the data on private equity flows into digital lending space after the issuance of these guidelines demonstrate the faith of investors on the Indian digital lending story and the belief that going forward, digital lending under the regulatory gaze of the Reserve Bank, that is the regulator, will spur the fintech sector even more. In furtherance of this objective and as a part of our efforts to accelerate and widen the reach of digital banking services, the concept of digital banking units, that is DBUs, were introduced. The second point in this regard, I said there are 6 points. The second point is on firming up of governance in the regulated entities. Our focus in recent years has been on strengthening the governance and assurance functions in the regulated entities. Banks and that is regulated in entities including banks and NBFCs, to enhance their internal lines of defense. The emphasis has been on building an environment of trust, transparency, and accountability. The assurance functions, namely risk management, compliance, and internal audit, are critical links between governance and business. The key to identify risks early, monitor them closely, and manage them effectively is the real challenge, and that needs to be achieved. In this context, instilling an appropriate risk culture in the organization is very important. This needs to be driven by the board and senior management with effective accountability at all levels. We expect the senior management, the board of directors, the audit and risk management committees, and the internal audit function in banks to play a more proactive role and be more watchful of incipient and emerging risks. The Reserve Bank has issued detailed guidelines for ensuring quality and independence of the governance and assurance functions. These areas are also subjected to intensive supervisory assessment. The third area is reimagining regulations with a pro-customer perspective. We have given renewed focus on strengthening the conduct-related aspects. Instructions have been issued on the responsibilities of regulated entities to ensure avoidance of intimidation or harassment of customers by their recovery agents. The master directions on issuance of cards have also strengthened the conduct regulations relating to various aspects of card operations. Now, we have also addressed the issue of quick resolution of customer grievances by the regulated entities. Accordingly, the ombudsman scheme the integrated ombudsman scheme has been introduced in RBI, and the internal ombudsman scheme in banks and other financial entities are also have been strengthened. And the fourth point I would like to mention is sustainable finance initiatives. Given the significant challenges from climate risks, a dedicated sustainable finance group has been institutionalized in the Reserve Bank. Besides actively participating in dialogue with various stakeholders at international and domestic levels, the focus has been to kindle brainstorming among regulated entities to internally review the systems, processes, policies, and oversight towards sustainable finances and the way forward. The fifth point relates to the measures we have taken to develop the credit market. There also a number of steps have been taken. I have already touched upon some of them. We have issued the guidelines for securitization of standard assets, transfer of loan exposures. A discussion paper has also been issued on the framework for securitizing stressed assets, which is almost, the comments have come, and we will be issuing the necessary guidelines on this very shortly. The sixth point and the final point with regard to regulation is the macro-prudential measures. While we continue with our endeavor towards reorienting financial system, our focus is on broader systemic stability and addressing the incipient signs of imprudent practices, if any, that continues. Considering the persistent credit growth in certain segments of retail credit, preemptive measures were announced, as you are aware, in November last year to sober down undue exuberance, which was clearly visible. Risk weights in certain segments of consumer credit have therefore been enhanced. The issue of interconnectedness through bank lending to NBFCs has also been addressed through higher risk weights. More recently, concerns on evergreening on account of regulatory arbitrage between lenders and the alternative credit channels, that is the AIFs, have similarly been addressed in December last, that is in December 2023. Now let me quickly turn to the revamping the Reserve Bank's supervisory processes. Structural changes have also been implemented to enhance the agility, flexibility, and specialization of our supervisory structure. The Reserve Bank's supervisory systems have been recalibrated to attune them to the dynamics of the financial sector in a forward-looking approach so as to smell possible distresses early. The emphasis is on fostering resilience of the supervised entities at 3 levels: financial, operational, and organizational. Needless to say, it is a constantly evolving process, but it has been made more dynamic. In this context, I wish to highlight 5 aspects, and I will run through them very quickly. First is the unification of the regulatory and the supervisory arms of within the Reserve Bank. Earlier we had in the regulation side, we had about 2 or 3 departments. In the supervision side also, we had a separate department for the banking, then for non-banks, for cooperatives. Now all that has been integrated. We have one department of regulation and one department of supervision, and there is very close interaction and interaction and discussion and internal exchange of thoughts and ideas between them. Now this unified, harmonized approach has led to regulatory efficiency and effective oversight. It has enabled early and timely detection of cross linkages across the sectors, as well as it has established synergy of regulatory and supervisory approaches. By no means, however, we have adopted a one-size-fits-all model. The rationale was to bring an activity-based supervisory approach in addition to doing entity-based supervision. The second point is with regard to the on-site supervision. The on-site supervision has now been made, is now been made much closer, and they get detailed analytical feedback from the off-site supervision, the wing in the Reserve Bank, which does off-site monitoring through the various data which flows in, and based on risks or problems identified in individual bank or NBFC, that information is provided to the on-site inspection teams, and when they visit a bank or an NBFCs, they know that these are the problem areas. Of course, there's a standard protocol they follow, but they are already well fed with adequate information by the off-site teams as to which are the critical areas that need to be looked into. Now the objective, the underlying objective binding all these initiatives is to be proactive and ever vigilant in identifying and addressing the emerging risks and vulnerabilities. In fact, the recent regulatory macroprudential measures which we announced were a result of this kind of supervision. And the on-site supervision also engages directly with the management, even with the internal auditors in the banks, with the statutory auditors, so its scope has been substantially enhanced. Third point is with regard to off-site supervision, which has now embarked upon much sharper analysis. We have considerably strengthened supervisory macro and micro data analytics to capture potential and emerging risks. We deep dive into business models of banks and other lending entities and closely monitor their asset liability mismatches and funding stability. We have a system of early warning signals that provide lead indications of risk buildup. While asset quality and capital position indicate resilience and robustness of the financial institutions in the medium term, recent experience in certain advanced economies have shown that liquidity can become an immediate cause of crisis. We monitor the liquidity position of not only the banks but also of the non-banks. Now, in strengthening off-site data analytics, models have been developed with suitable and judicious use of machine learning. The risk-based supervisory rating models have also been recast on the basis of feedback both from internal and external experts. Thus, our whole approach to supervision is to be proactive for minimizing surprises and spotting the challenging areas and the concerns and addressing them early. The fifth point is with regard to sustained focus on capacity building. As you know, we have set up the College of Supervisors. Internally, we are also, we have really expanded the size of our supervision department. Continuously, the officers in the supervision department are put to various new training programs, and the College of Supervisors, which we have set up within RBI, is assisting this process. Now, The fifth and final point is enhanced focus on IT and cyber security risks. I think going forward, for all financial institutions, the robustness of their IT systems and the threat from cyber security can become a major challenge. So our emphasis is, as a part of our supervision, we also look at the IT systems of the banks and NBFCs, the banks more particularly. Our C-site team, we have the wing which looks into the robustness of the IT systems. They go deep into the IT systems of various banks and also, as I said, non-NBFCs. And wherever we see gaps or loopholes, it's immediately brought to the notice of the management and to take corrective measures. You see, there has been some comments here and there mentioned. Some people tell me privately that, look, I think the financial sector, the banking sector or the NBFC sector, sometimes they feel that there is overdose of regulation or overdose of supervision. Now, that comment I do hear from time to time. But I think all serious players in the banking sector, including the senior management in banks, I can tell you with a reasonable amount of confidence, based on my conversation with them. In any case, I encourage them on a one-to-one meeting. I encourage each bank CEO to speak to me as frankly as possible and not be not be overawed by the fact that, I am the governor and, we are the regulator. One-on-one, I ask them, in private, what are the possible, how do you see our, regulation or supervision? And take it from me, I do get inputs from bank CEOs about possible areas of risk build-up in the banking sector and in the NBFC sector. In the last 6 to 8 months, a few of, I would not say a number of, but at least 2 or 3 bank CEOs have in private shared with me, sir, and told me that these are the areas which they are getting also worried. And they have flagged these issues for, our regulatory and supervisory look. So therefore, our primary emphasis is to ensure that the Indian banking system, the Indian financial services system, the NBFC sector, and the entire, the financial sector which is under the regulatory purview of the Reserve Bank, our emphasis is to ensure that they remain resilient and they are robust and they are fully prepared to support India's journey to becoming an advanced economy. And with that, we work very closely with the managements of banks and NBFCs. Our approach is very consultative, and whatever we do, it is done in a very consultative manner, and that is demonstrated by the fact that most of the regulatory guidelines which we issue, either we issue a discussion paper first, get comments, or we issue a draft circular, a draft master direction, get the feedback from the players, and then we act upon it. Now let me conclude. In conclusion, I would like to say that the remarkable turnaround in the Indian banking system has been the cornerstone of India's success story in the recent years. Today, the Indian banking system is well placed to support India's growth story in the years ahead. Trust is the essence of a robust financial system and is built over a period of time through sustained efforts. This needs to be preserved. The Reserve Bank has committed itself to safeguard the trust factor in the Indian financial system. Our recent efforts to improve regulation and supervision are guided by this basic principle. With our diverse responsibilities, that is Reserve Bank's diverse responsibilities such as being the monetary authority, the regulator and supervisor of banks and non-banks, the regulator of payment systems and other segments of the financial markets, we have used all our instruments, monetary policy combined with macroprudential regulation and supervision, synergistically to achieve better outcomes. As we move forward, we guard against any sense of complacency and work tirelessly towards further strengthening India's banking system and the overall financial system. I'll stop here. Thank you very much.
Thank you so much, sir. for that very, very comprehensive address. I'm going to request you to please join us here on stage as I request the Editor-in-Chief, Mint, Ravi Krishnan, to please join Mr. Das on stage for a conversation to take this further.
Right. So, thank you, Governor. Lots of interesting comments, you made in your speech. I would like to start with what you said a little bit towards the end, where you said in your interaction with some bank CEOs, they had flagged some areas of concern. And I remember at the time when RBI had raised the risk weights on unsecured loans, you had called it a preemptive measure. So are there any other areas where, which makes you a little bit worried and where you think, you will now direct your lens at with more intensity?
Thank you. Now, at the moment, the Indian banking sector remains resilient and robust. Even if you look at the, the unsecured, the consumer loans and the personal loans, as we call it, some segments of personal loans, as you call it, the numbers that we have before us are not particularly alarming. The numbers are, within, I would say, reasonable limits. Even the NPA numbers are also within reasonable limits. They have not really steeply or significantly gone up. But what came to our notice were 2 or 3 points. One, as I mentioned in my address, there was a kind of a exuberance which we clearly saw that it was building up. And a kind of a, a fear of missing out, what they call a FOMO approach also getting in. Almost everybody was, this was one opportunity which everybody sort of thought they will capitalize. Now, in the process, what was happening is that every institution, whether it's a bank or a NBFC, they have a certain management bandwidth. They have a certain bandwidth to appraise proposals, to diligently examine a loan application, to build up, they also, some of them have got this, what you call model-based lending, and there are models, which automatically sort of generate sanction letters. We saw that banks and certain NBFCs did not have the, as per our assessment, supervisory assessment, did not have that kind of bandwidth of diligence, bandwidth of doing due diligence of the loan proposals to justify the kind of loan growth in these sectors that was seen. And it was very clear that this kind of growth would not be sustainable going forward if it is not slightly, moderated. So we clearly smelt, we saw, anticipated some problems, ahead of us, down the road. So therefore, we call it that we acted preemptively, and the approach is that, I said it in the last monetary policy, we do not wait for the house to catch fire and then act. We would like to see where the fire is likely to, arise and act in time so that there is no fire in the house.
Right. But that said, do you think that over the medium term, we need to revisit the whole personal lending framework in regulated entities?
You see, it is for the banks to do it. I mean, how to do appraisal is not something which the regulators should be really telling the banks. Each NBFC have their own internal capabilities. Our job is to just drive home, because the banks ultimately, they are collecting depositors' money, they are lending that money, it is their responsibility. Our task is only from time to time, as the referee from time, or as the coach or referee, whatever you call, our approach is from time to time that, look, this is where one area where perhaps you need to, give a second look. And for example, this, this model-based algorithm or the model-based lending is one area where currently we are looking at. And I have said it, it's not that I'm sharing any, secret or anything. I have mentioned about it in one of the speeches about a month ago, that this model-based lending also, the robustness of models, it is something for the bank management, bank board of directors, and that includes NBFCs also. It is for the boards of directors, it is for the managements of these NBFCs and banks, and it is for the audit committees or the risk management committees of these financial entities to see how robust are the algorithms and how robust are the models. The ground realities keep on changing. So whether your model is falling behind the curve or it is in tune with the times, and what are the possible risks which the models can create. So that is one area which we are closely now studying. But again, our expectation is that the managements of the banks, the boards of banks and NBFCs should themselves analyze and look at the possible riskiness or the possible gaps which are there in their model-based, algorithm-based lending, which can lead to a potential crisis.
In this area, you had listed, the changes in the regulatory architecture, the strengthening of the architecture. What other changes can we expect going ahead?
That I think you'll have to wait. I mean, I would not like to announce anything prematurely. Once we are ready with a particular analysis, we immediately issue it. And mostly, in many cases, in most of the cases, we issue it as a draft circular and then finalize it. Certain situations, it's not possible to issue a draft circular. We have to straight away issue the circular. It's situation specific. But you have to wait. I mean, I would not like to sort of make a announcement prematurely unless we are fully convinced that this is something and this needs a regulatory intervention.
Right. How are you dealing with this illegal lending apps, sir? I mean, you said the government and the RBI are dealing with it. Are there any details which you think you can share?
You see, we have from all licensed, that is all registered or licensed lenders with the RBI, the banks and the NBFCs, we have collected the list of apps and we have given it to the government, to the Ministry of Information and Technology, which is uploaded in their website, and which are the apps utilized by the banks or, as third-party service providers, which are engaged by the banks or NBFCs. That list is already out. Now, it's a long list. So what is necessary here is to actually the responsibility is more for the law enforcement agencies to, look at, identify the illegal apps, because our system, we get complaints from, from the public, or we try to sort of through the banks or through the NBFCs, we have made the bank or the NBFCs which engage this third-party service provider, because we don't regulate the apps. We regulate only the banks and NBFCs. So we have cast the responsibility on our regulated entities to see that the fair code of conduct and the fair business practices are adopted by their third-party service providers. But the problem, as you said, is with regard to the illegal lending apps, and there again we have already furnished this list with government. Whenever we come across any further problem, we give it to the government, and there is active engagement between the Reserve Bank and the concerned ministries and Government of India and the law enforcement agencies. And these meetings are held, coordination meetings are held regularly between these agencies to take appropriate measures against the illegal lending apps. And I think there is a growing consciousness also, growing awareness also among the people. We have been doing a lot of media campaigns, awareness programs to sensitize the public not to fall prey to, any sort of apparently attractive looking some loan or some other offerings.
Right. Staying on the subject of fintechs, you had said that after you tightened regulations, I mean, PE money was still flowing into the industry, right? But the fact remains that regulations are tight and many fintechs are still not in sight of profitability. Does that worry you? What the sustainability? Fintechs don't have any sight on profitability.
No, I mean, it is for the somebody who is doing business, it is for him to sort of decide on his investment and his tolerance level. Every business, obviously, whether it's a financial service sector company or it's a manufacturing company or any other real estate, I mean, real sector, not real estate, real sector company, they cannot, everyone cannot expect to see profit for, from day one. It is for those fintech companies to identify how much, how much of initial loss or how many years of loss they can absorb. And also, it's a question which they should be asking themselves: is the model adopted by them, sort of likely to create? Is risky or likely to create loss? And if it is something which is loss making, it's a question which they should answer themselves, whether they should travel down that lane and at what speed. So therefore, so far as we are concerned, I would like to say that the digital lending apps, we have not done anything. We have only put the responsibility on the bank managements to ensure that the fair practices and the fairness is, fair practices are followed by their lending apps. We have also sensitized the banks through our direct interaction that they must also look at this lending, algorithms and, the what you call model-based lending. And as I mentioned, the digital, lending guidelines have been issued after wide consultation. And that has been, I would like to say very clearly that the digital lending guidelines have been well accepted. Look at FLDG. When we issued the digital lending guidelines, there was, a lot of clamor that we should also recognize FLDG, first loss default guarantee. And at that time, we clearly said that it is under examination and we will consider it. Then we had extensive deliberations and consultations with the actual players. And the percentage which we have prescribed, it is something which came from their side, and we examined it and we accepted it. So therefore, I think the fintech sector is growing. It will grow. The fintech sector, fintech lending sector, digital lending sector is, it will grow, but it needs to grow in a sustainable manner, and that is our emphasis.
On a related note, with the success of UPI, there are also, I think, some murmurs that it has become a kind of a monopoly. And there were some reports that RBI is looking to revive the idea of that new umbrella entity, a kind of a competitor to this NPCI. Any thoughts on that?
You see, now NPCI is treated as a, our entire payment systems, and within that the UPI is now treated as a digital public infrastructure. And it's a kind of a, it's open to all, any sort of, the likes of the various apps, the Google Pay, the Phone Pay, the Bheem app, any private entity can sort of onboard into the UPI system and operate. So it is an open kind of a platform. And of course, they have to apply to the NPCI, and NPCI has to give them the necessary permission and onboard them. But so UPI has become a digital public infrastructure, and UPI needs to grow. UPI has become an international model for the to be emulated by other countries. G20, under India's presidency, there was wide appreciation and recognition of the fact that UPI is the leader in, payment systems across the world. We are now discussing both RBI and NPCI. Both RBI and NPCI, we are in discussion with a number of countries to assist them, to help them to develop similar payment systems in their country and to integrate it with our UPI. Already Singapore has been done. United Arab Emirates, we have already signed a MOU with the Central Bank of United Arab Emirates. There are few other countries in our region with whom the discussions and the talks are in various advanced stage. We are ready from our side. Once they are ready, we would like to integrate. So UPI is now positioned in a place where it is a public infrastructure and it is, it has to make its presence felt. So therefore, UPI needs to grow, and that's the first aspect I will say. And I would not look at it as a monopoly, because it's a kind of a, anybody can come and play with that. It's based on the principle of public-private partnership. The success of UPI in a large measure also owes a lot to the private sector payment players, who have onboarded into the UPI. Left to itself or left to our, left to many banks have their own apps. I'm not trying to pull down their role or anything, but I think that companies have had a major role. So we want to position UPI as a digital public infrastructure. It's an open platform. It's available to all, and that should grow, and that has the potential to, it is a world similar payment systems in other countries, and also in developing and improving the cross-border payments that we have. Now, you are referring to the new umbrella entity. We got some proposals. There were many applications, and we did not find anything, anything sort of, unless you have a new, I think most of the proposals were just replication of what the NPCI was already doing. What we were looking for is some new innovative method, some new, some innovation, some value addition to our payment systems, which we did not see. But having said that, we will take an official view on this matter, this new umbrella entity thing. We will take an official view, and then we will make the necessary announcements as and when we take the official view.
Right. So yesterday, the US Securities and Exchange Commission had allowed an exchange traded fund tracking this cryptocurrencies. So I would like to know, does this give some legitimacy to cryptocurrencies now? Will this influence the regulatory thinking across the world? I mean, what is your view?
I think the the US capital market regulators, in that same announcement, as far as I know, they have also issued necessary caution, issued necessary cautionary advice, and they have also issued necessary, if I can say, warning to the investors to be careful. Also pointed about the riskiness of the whole thing. So therefore, the capital market regulator in US is fully, they are aware of the risks that it poses. Now, the way on this whole crypto thing remains unchanged, irrespective of who does what. Just because somebody is doing something, we are not here to emulate them. We feel that, especially for emerging market economies, and I would say the same would apply to advanced economies also, traveling down that path will create huge risks, which going forward, it will be very, very difficult to contain. The question arises, why do you need to travel down that road? What is it that you get out of it? It is the, the speculative nature of that product, which offers, which enables some people to make perhaps big money for some time. But majority of the people are not going to make big money for all times. In fact, the majority of the people will encounter losses, and because it's an entirely a speculative product. So therefore, I think I don't wish to comment on what another regulator of another country has done. I would not like to comment on that, because they know what is best for their country, and accordingly they have acted. I have nothing to say on that. But I would like to say two things. Number one, they themselves, the US market regulators, the capital market, securities market regulator, they themselves have flagged the riskiness of the products, advised people to be very careful. Number two, I would like to say that we are all familiar with the term, the tulip mania in Netherlands, which created huge financial, which created huge, it built up into a big asset bubble and then it collapsed. So I don't think the world, and in particular the emerging market economies, can afford a cryptomania which will lead to similar outcomes.
Governor, can we take a couple of questions from the audience, please? Take a couple of questions. Please keep it short. That gentleman in the front.
I am Anirudh Gupta. I have a question, sir, on the debt markets. Would addition of that 1.5 lakh limit, which is there under ATC, would allocation to debt funds and coming under that add to the depth of debt markets?
1.5 lakh rupees to?
We have that ATC provision.
Which provision?
Income tax.
Oh, ATC, income tax.
ATC,
Okay,
yes.
okay. Right.
So
I heard as ATC, air traffic controls. I was wondering. Okay, Section ATC, Income Tax Act. Okay.
So under that, sir, generally if debt funds can be added to that, would that deepen the debt market?
I think it's a government tax issue. The budget is expected in less than 20 days. It's not fair for me to comment on that in public.
I understand, sir. Thank you.
Yeah, we'll take them from here.
Hello. Yeah, hi, I'm Nirav. I have a question around CBDC. So very recently we crossed an important milestone in terms of daily transactions. I believe it was 1 million odd transactions per day. So how do you view the roadmap going ahead in terms of CBDC adoption? And how's the use case panning out for wholesale CBDC?
You see, in wholesale, we started with the, with the GSEC segment, both in the secondary market as well as in the primary auctions. Now we are moving towards money market operations. We have talked about it, that overnight money market operations, overnight call money market also. We are trying to onboard this, we are trying to ensure CBDC utilization in that area. And slowly we will be adding new segments or new areas where CBDC operations we will do. Our whole approach it's a pilot project. Let's remember that it's a pilot project. We are in no great hurry, because after all we are creating a new currency system, and we have to be very careful about the integrity and the safety of the currency CBDC which we are creating. So therefore we are being very careful. There is no target date as such. We are moving very cautiously, but the learnings that we are getting, we are trying to utilize and further fine tune our system. So in the wholesale segment, we will be expanding its scope slowly and steadily. Coming to retail, there have been many learnings. Now, for example, we are now working on the possibility of programmability in CBDCs. That is, you program, and for example, the government cash transfers for, to farmers or to other segments, whenever there is a direct benefit transfer or a cash transfer. So you program it in such a manner that the CBDC which he is transferred to wallets of the beneficiary, it can be programmed in a manner. Can it be programmed? And we feel it can be in a manner that it is utilized only for that purpose, where the end use is clearly defined by the person who's sending the money. So that is one area where we are working. Recently, we have made the UPI and CBDC interoperable, and the same QR code you can use your UPI system, payment system. You can use the CBDC wallet also. You can use the same QR code. So slowly, there are many learnings which are coming up. There are few countries in the world which are in the pilot mode, and there is a lot of interest from other countries also in our CBDC system. So I think CBDC in times to come, when it will happen, I cannot say. But I think it can happen sooner than we can believe at this stage. I think it's the future currency system, And in particular, CBDC will make cross-border payments much faster and much more efficient and less expensive, less costly. So therefore, and I think again, CBDC we are using, we are using the blockchain. We will go for the DLT method. So therefore, to the, to the critiques of RBI's view on the cryptocurrency, let me say that we firmly believe that the technology of blockchain has its merits. It can be used, and it is already being used by many companies even in India. The logistics providers, your maintenance of land records, the land registration records, there are huge opportunities available in blockchain technology per se. But the technology does not need a product called a cryptocurrency to grow. So we are using, for example, in CBDC blockchain, we will be using the DLT model also, and but it's a huge opportunity, and that's going to be the future currency system, and we need to be there. Thank you.
Right, that's all we have time
Sorry,
for.
Ravi,
And,
can I ask a quick question?
Okay, yeah. Just.
Sir, this is Neil Burati. I'm Deputy Editor at Mint. The mutual fund industry overseas investment limit of 7 billion has not been raised by the RBI. All funds were stopped from investing fresh money overseas from February 1st, 2022. And in fact, this limit of 7 billion was set in 2008, as far back as that. Now, 7 billion is a tiny blip in our forex reserves of more than 600 billion. So what is the RBI's stance on this? Why should this not be raised?
Now, this suggestion has been, request has been coming to us from the mutual fund industry from time to time. We have just come out of, the pressure on our currency, which we witnessed in the aftermath of the, the starting of the Ukraine war, February 2022 onwards. The rupee exchange rate was under a lot of pressure. Initially, there were a lot of outflows. So it's a question of timing. We do agree that there could be, there is perhaps the mutual funds. I mean, we have we don't question their, we don't question the basis of their request. It's a question of the right time for us to do it. We have just come out of the stress on our exchange rate, on the exchange rate of the rupee. We experienced huge outflows. Now things have stabilized, and the rupee has remained very stable. Of course, some people read it wrongly and call it a stabilized arrangement, but it is not stabilized. It is market determined. If somebody wishes to call it as stabilized, so be it. Now, I think the description of the exchange rate of the Indian rupee, at the cost of slight digression, let me say, the description of the Indian rupee as a stabilized arrangement, I think the fundamental strength of the the fundamental points that are being missed out is, number one, the strength of the macroeconomic fundamentals of the Indian economy, the strength of and the resilience of the Indian financial sector, the return of inflows into India, FPI inflows in particular. FDI inflows this year is less than what it was last year, but given that the global FDI volumes have gone down, in that India's share is one of the bigger ones. So I think these are the points which are being missed out. And also, I think our exchange rate system, our economy is today not what it was a few years ago, but that is beside the point. Coming specifically to your question, I'm not questioning the genuineness of their demand. It's a question of timing. When we feel confident that, things are, it has to be stable on a durable basis. It is already stable. We will take the call at the right time.
Hi, sir.
Sir, sorry, we don't have time, but just one last thing I would like to ask. I don't know whether you would like to answer it. Do you expect the pre-election budget to be inflationary?
inflationary? No, it will not be. That is one thing I can tell you with, whatever, I mean, I don't have any inside information about what the government will do, what the finance ministry will do on the budget, what the finance minister will do on the budget. I have no inside information. But going by the past track record and going by the kind of measures government has been taking in the recent months, right after the prices inflation started and it hit 7.8% after the beginning of after the Ukraine war, the government has been taking number of supply side measures. Particularly in recent weeks and months, you see number of supply side measures being taken. So that comes out. What comes out very clearly is that the government is very particular that inflation should be brought down, and there is appreciation of the fact that supply side measures can be done only by the government. Second thing is, our fiscal has not fueled inflation in India. Unlike in many other countries where huge amount of liquidity which was injected into the system, it was already there, even pre-COVID it was there, but during COVID the kind of huge liquidity that was injected, which is still sitting out there and circulating somewhere, that loose monetary policy also injected, that liquidity injection also fueled inflation. In India, that did not happen. From the monetary policy side, our liquidity which we gave were for limited periods, which have come back to us, and we have also been pulling out liquidity. On the fiscal side, the fiscal support which government provided during the COVID times and thereafter was also targeted, and it was very calibrated. That did not fuel inflation. I have talked about it at length outside. So going by the past track record, there is absolutely no reason to believe that any announcement would be in the budget would be inflationary.
Right. Thank you, sir. Ladies and gentlemen, Governor Shaktikanta Das.
Thank you very much, sir, on behalf of all of us in the room. And Ravi, I'm going to request you to kindly present a token of our extreme gratitude to Shri Das. Thank you so much, sir, for being here. Most importantly, thank you for that very affirmative address. Can we have a huge round of applause, ladies and gentlemen? Shri Shaktikanta Das, what a privilege to have you amongst us. Have a phenomenal day, sir. Thank you. Thank you very much, sir. Thank you so much once again. Can we have the holding slide, please? All right, we've got the perfect shot. What an absolutely terrific start to what's going to be an incredible Mint BFSI Summit, 16th edition. Ladies and gentlemen, kindly be seated. We're moving from one power-packed address to another conversation. The Stock Market Regulator, Securities and Exchange Board of India, or Sebi, we all know is at the heart of one of the most keenly followed daily events of our lives. The movements of the BSE Sensex and the NSE Nifty are relayed to us daily through various mediums, including Mint, of course. And in this financial chessboard, Sebi, much like a grandmaster, orchestrates regulations for all listed companies, including banks and fintech companies. In our next conversation, we are going to dive into Sebi's strategies, initiatives, and the foresight, and decode the regulatory narrative that shapes the heartbeat of our financial world. I request you all to kindly settle down. Please take your seats, ladies and gentlemen. And a gentle reminder, of course, to kindly place your cell phones on the silent mode for all those of you who've joined us recently. And on that note, I'd like to invite on stage our moderator for this discussion, Neil Borate, Deputy Editor, Mint. All right, my apologies. Neil will be joining us shortly. But before that, our speaker is going to address us all. Please join me in welcoming on stage whole-time member Sebi Shri Kamlesh Varshney. Welcome, sir. Welcome.
Good morning, friends. It is indeed my privilege to be here amongst all of you to share my thoughts on the Indian capital market and what we are doing at Sebi. So the topic that I will try to cover here is that what steps we are taking in the current regulatory environment, and particularly in the context of this capital market intermediaries. Now, one question that all regulators face, which was also referred to by RBI governor in the previous session, is that how much should we regulate? So that is a question which is faced by all regulators, and there you have all those type 1 error and type 2 error. So if I regulate too much, then industry suffers. And if I try to promote industry, whether there is a risk of investor protection. Now, this type 1 and type 2 error basically poses challenges to each regulator, and from time to time regulators take a call that what is the right answer to this particular question, how much should we regulate and to what extent we should regulate. Now, so far as Sebi is concerned, we have 3 objectives which are enshrined in Sebi Act. All of you are aware of it, that is investor protection, market development, and market regulation. So often it is said that if you try to do investor protection, then probably it is putting extra compliance on market. So market development suffers and vice versa. But there is another way to look at that. And that is what we are trying to do at Sebi, that can we fulfill all 3 objectives together without there is a counter current for any of them. To illustrate, if we try to draw a Venn diagram for all the 3 objectives, 3 circles, that is one circle representing investor protection, another circle representing market development, and another circle representing market regulation, and we try to bring these 3 circles together, so you will notice there will be an overlapping area. Now that overlapping area is where all 3 objectives of Sebi Acts are fulfilled at the same time. That means there are some actions where we are able to do investor protection without compromising on market development. So the challenge before us is that how to increase this area of intersection. And for that purpose, Sebi has taken a number of steps. First is consultation process. Most of the circulars that we issue undergoes consultation process. It was also referred to by RBI governor in the previous session that most of the circulars are issued in the form of draft circular, and when feedback is received, those feedbacks are taken into consideration, and then circular is issued. Of course, there would be some situations where you have to immediately issue a circular. There could be pressure points, there could be date extension and others, but mostly circulars also, before issuance, we issue draft circular and we do public consultation. And not only for circular, even for regulation changes. When we have to do regulation changes, we issue consultation papers, and those consultation papers, whatever comments we receive on those consultation papers, they are compiled and discussed in board meeting. There have been occasions where, because of the suggestions that we have received in the consultation paper, we have changed what we had earlier proposed. In case we don't agree with a particular suggestion, then also we give a reasoning in our note to the board that why we don't agree with this particular suggestions. So that ensures that whatever consultation feedback we receive from our consultation paper, each of them is considered by the board before a particular regulatory change is approved. All this ensures that public is on board on whatever policy call we are taking. Then you must have also heard Industry Standard Forum is a new concept that has been set up now. Once a policy call has been taken by the board, then how to implement it. That implementation part is given to Industry Standard Forum, which comprises of all the industry players in the stock market, and they decide or they suggest to Sebi that how this particular regulatory change should be implemented. Because it is coming from their side, the idea is that whatever regulatory change that Sebi board has proposed is able to be implemented smoothly and without creating extra compliance for the market participants. You must have also heard about a working group that Sebi has set up with special emphasis on ease of doing business. This was announced by the finance minister in the previous budget, that special emphasis would be given on ease of doing business, and 16 working groups have been set up by Sebi. Some reports have come and we are examining those suggestions to ease the manner in which market participants are able to comply with our provisions. Some reports are still awaited, and particularly in the context of intermediaries that I am referring to, we probably will receive that report within a few days, and from that report, a lot of input that we will receive from the market participants about how we can improve ease of doing business. Now, all these three objectives that I talked about, let me just give an example how through this public consultation process, we have been able to achieve all three objectives with a particular kind of example. We all have noticed that misutilization of client fund or client security has been a biggest challenge for us. We have seen how Kavi type of incidents have happened in the past, and therefore we do inspection. A lot of inspections are done in the office premises of the broker, and whenever we see any shortfalls, any discrepancies, then we issue notice, adjudication proceeding happens, inquiry proceedings happens, actions are taken. Now, to get over all that, the policy change was implemented by Sebi board, and that policy change was upstreaming of client fund on end of the day basis. Now, once a client fund is to be parked on a separate bank account and it has to be upstreamed to the clearing corporation on end of day basis, then we get rid of all this inspection work. So while we are protecting investor interest, because if there is a separate bank account, there is no intermingling of fund, of client fund with a broker's fund, and that particular amount is uploaded to clearing corporation on end of day basis, the misutilization risk is completely removed. So that is a policy call for investor protection, but at the same time, it should not hurt the industry. The task of implementing this was given to Industry Standard Forum, which was comprising of market exchange, brokers, 3 brokers associations and clearing corporation. And they came out with a circular that how do we implement this particular decision. And that circular was issued by us in the month of December. It has been warmly welcomed by all brokers associations. So this is one example of how through public consultation process, through Industry Standard Forum, we can achieve all 3 objectives together. And this is the direction in which Sebi is moving right now. I have just given you one example. There are many such examples in other areas as well. Currently, so far as intermediaries are concerned, we are working on another space which is of finfluencers. We know there are a lot of finfluencers which are acting outside the regulatory space. Probably they are violating the Sebi regulations. So the first challenge before us is that how to bring these people into our regulatory net. And when we say that how to bring that into regulatory net, we need to examine are there any entry barriers. So if there are entry barriers, we need to examine them. And that is what that working group that I earlier referred to is examining those issues. And we are waiting for their suggestions. What suggestions do they have to make entry easy for all of them, because it is simple, for law enforcement agency or for any regulatory authority, the first task should be that most of the people should be in the regulatory net, so that it is easy to monitor them, easy to see that they are complying with the security laws. If there are few people who are violating, then it is easy to catch them. And for that, it is essential that most of the people are in the regulatory net, and that is what our intention would be going forward on this particular area, that what regulatory changes we can bring in to have these people under our space, so that there is less of wrongdoing, which we are seeing right now. You must be seeing that lot of orders that we are passing in case of influencers, because whenever we notice something is going wrong, we start our adjudication proceeding or an inquiry proceeding, and we pass orders. But that is of course, enforcement side. But on the regulatory side, our objective going forward is that to make regulatory changes based on the input from the industry, so that all these influencers are on board. Now, there are some other suggestions which we keep receiving. It was also referred to by Das sir in the previous session, that are we doing too many changes? So this is another one area where we receive feedback that some people feel that there are a lot of changes which are taking place right now. So when we talk about the changes, we need to keep two things in mind. First, do we have to change? And second, what should be the speed of change? When we say, do we have to change, probably answer would be yes. Why? Because everything is changing around us. The technology is changing everything. India is growing, right? So India is aiming to be a developed country. Now, once those changes are taking place, we have to keep pace with them. तो अगर हमको बदलना है, इसलिए नहीं कि हम अभी अच्छा नहीं कर रहे हैं, हम अभी भी अच्छा कर रहे हैं, हमको इसलिए बदलना है कि हमें और अच्छा करना है, हमको इसलिए बदलना है कि इंडिया आगे बढ़ रहा है और इंडिया बदल रहा है. So that is a principle that should be kept in mind, that changes will come because we have to improve all the time. The speed with which we change, that is a second question, is a relevant question, because we all understand in management also that if there are too many changes, then change fatigues build in. But we also have to take into consideration that if there are risk areas building up, then we need to act immediately. However, so long as we follow the principle that I have outlined earlier in my speech, that before making any change, we consult the industry, we consult all stakeholders and take their feedback into consideration, that will take care that extra changes are not taking place, and the speed of change is what industry is able to absorb. So these are important points. We do understand that speed of change is also equally important, and through public consultation, through market participant consultation, we do take that into consideration when we do regulatory changes. So this was my initial thought on that. Thank you very much. I'm willing to take whatever questions you have. Thank you.
Thank you very much, sir. Thank you so much. I'm going to request you to please join us as we further this conversation. And of course, Neil Barate is going to take over from here. Thank you for moderating this discussion.
Kamleshji, so actually Ravi asked this question to the RBI governor, but actually Sebi is the capital markets regulator. So this is more properly in Sebi's domain. What would be your position on Bitcoin or other cryptocurrency ETFs in India?
So I heard RBI governor in the previous session, and he he was speaking about the risk areas that he perceives or RBI perceives. And he also referred to that, what is right for USA may not be right for us. So those are the important points, right? So just because US has done it, that's a good input for us, but one will have to examine it. And I can tell you that whatever points that RBI governor made, those are relevant points, but the decision will have to be taken not at SEBI's level, it has to be taken at ministry level. That is my understanding. That we don't think that that our mandate is to regulate crypto at this point of time.
There is one more nuanced aspect to this, which is mutual funds, particularly feeder funds that are allowed to invest in overseas securities, including ETFs. You might have such FOFs being filed with you to invest in Bitcoin ETFs. So what would your position be then?
So I'm not aware of that. When they come up to us for approval, whether they are going to, invest in Bitcoin ETF. Now that SEC has approved, this is definitely one area we will examine it, that if those things have to be examined when they come up to us for overseas investment, at that point of time we will see what are the relevant regulation and what safeguard we need to build in.
Now, Kamleji, recently Sebi enunciated its position on short selling, banning naked short selling. So what was the logic behind that? And one further question is, so not all short selling is bad. Short selling also helps in price discovery or brings out instances of bad corporate governance, etc. So if a person has enough money in their margin account, what is wrong with naked short selling?
So first of all, I fully agree with you that there is nothing wrong in short selling. In fact, if you remember, this particular issue came up before Supreme Court, and while this issue was being examined, Sebi also exactly said the same thing, that short selling should not be banned because, as you said, it is good, important for price discovery and, whatever responses investor need to take on corporate governance or other issues. Our submission before Supreme Court, which was accepted also by Supreme Court, was that it should not be banned, it should be regulated. So we are completely on board that short selling should not be banned. Now, what is naked short selling? Naked short selling is you don't have security, and then if you don't have security, how you are going to honor your settlement? And two things here I would like to make. First of all, it is not that last week we have banned naked short selling. This is reiteration of our 2009 or 2008 circular that we have reiterated. So this has been the position all along. There is nothing change in the position. And number two, all countries ban naked short selling. Simple. I mean, what is naked short selling means? That means your position is not covered. If you have taken a particular position on a security, you cannot honor your commitment. You are exposed at the time of settlement. Obviously, no country will allow that, at the time of settlement, you put your hands up. So that's a normal concept. I mean, there is nothing, probably the communication part has not been very good, that people think that this is something new or something has happened. But this is acceptable everywhere, that you should not be naked at the time of settlement. I mean.
So on a related note, SEBI has something called the securities lending and borrowing mechanism, under which you can short sell because there you're borrowing securities. Yeah. But that is not taken off much. So is there something that needs to be fixed there to make it more acceptable?
So, I mean, we will welcome all the suggestions. I am not, I can say that because I am new to the SEBI, so I don't know exactly why it has not taken off. There must be some reasons, and if those reasons to be addressed, I can only say that, if those things are brought, they must be already examining. The department which is dealing with this lending and security, borrowing and lending of securities must be examining those issues, because I am not dealing with that department. But I'm sure that this would definitely be addressed.
So if we can now turn to the question of investment advisors, which you directly supervise. The fact is that India has just 1,300 registered investment advisors in a population of 140 crores. Even if you look at just the investor population, that's also, we have more than 14 crore demat accounts. So why has this state of affairs come to pass? And what is your broad thinking on how it can be fixed?
Yeah, that I agree that this 1300 number is quite low, and this number should go up, which I also addressed some time back, that most of the people who are giving investment advice should be within regulatory framework, and if there are any entry barriers, we need to address those entry barriers. If regulations have to be, some changes are required in the regulations, we should be doing that, and we are examining that. I can tell you the consultation paper which was issued about 6 months back, there have been a lot of feedback, and we are examining all those feedback. We are discussing, we are having very long discussion internally because there are a lot of points. It is like probably we want to come out with all comprehensive solution for this particular issue. And we are also waiting for the report of the working group where you are also member. So everything we want to discuss it together and not in piecemeal basis. They have personally also, apart from the suggestions that we have received on consultation paper, personally also I have interacted with area members and all and taken their feedbacks, and I can only say that we are working on it, and we will come out with a comprehensive plan that how to increase this number of investment advisors or research analysts into the regulatory framework, and also along with that, how to act on those who are not registered or who are violating security laws. We are already in discussion with Meta, Google, YouTube, everything, and they are cooperating with us. That if somebody is violating the law, then they will take down that ad, or they will take down the content also. Like if in a video for 10 seconds he is saying something which is violative of security laws, and we are discussing with them that that particular part can be taken down. So all that work is going on, and it will take time because consultation takes time, you know. And we want to come out with one comprehensive solution to this particular problem.
So on the same subject, you also mentioned in your speech, the chairperson outlined a certain approach in a public event earlier, where she said that a lot of intermediaries directly or indirectly pay influencers.
Yeah.
And one way that Sebi can deal with the issue of rogue influencers is to monitor those payments. So could you develop on that? Any further action that Sebi is contemplating?
Right. So this is regarding a separate payment mechanism that if you want to pay to investment advisor, or if I am a registered investment advisor, I can only take my fees through a particular payment gateway. So once again, we have received feedback. There are very strong feedback on both sides on this particular issue, and therefore more consultation is required. And once again, this will also be a part of that comprehensive package that whether we want to make it optional to start with, so that will also be examined. Because once again, we will not like to do anything which instead of easing entry barrier, it creates an entry barrier. So that point also we need to take into consideration.
Right, sir. If we can now turn to the question of mutual funds, Sebi is reportedly considering a mutual fund category which sits somewhere between regular funds which have all kinds of rules on diversification and PMS which has a lot more freedom. How further advanced is that discussion, and how soon can we see this category come out?
So the concept is once again clear, right? That we have a lot of prudential norms for mutual fund because retail investors take part in mutual fund, and once retail investors are taking part, then because of investor protection, there is need for larger prudential norms which are not there for PMS. But can we have a product in between where large investors are taking part, who understand the risk aspect, who understand that this is the risk with this particular product, and I am willing to take that risk. He has that kind of education that he understands and he is willing to take that risk. So can we design a particular product in between which will have lesser regulatory norms or prudential norms than mutual fund product? So that is what discussion is going on. And it's very difficult to say when will it come out. I mean, all our approach is that once we finish internal discussion, we will come out with a consultation paper, and not possible to give a time frame, but it is very much in consideration.
Sir, do you have a broad cutoff in mind in terms of, so PMS you have to have 50 lakhs minimum ticket size, mutual fund there's virtually no minimum. Where would this sit at?
So that is also a discussion going on, and not right for me to give the number, but obviously it will be somewhere less than 50 lakh, and I mean, can't tell you the number, but those discussions are going on, yeah.
Right, sir. One other area that Sebi is working on in the mutual fund context is the MF Lite license for players who will only launch passive funds. So any further progress on that?
So once again, those discussions are going on internally, and we will come out with consultation paper shortly. The idea is simple, once again, that passive funds have lesser risk because the underlying security is indices, and therefore do we require the same kind of entry barrier like net worth requirement, profitability, your past record? Do we need that kind of corporate governance? Do we need that kind of compliance? So probably not. And therefore, can we lighten these all these requirements and create an opportunity for more players to enter into the field, so that there are more players entering into mutual fund industry. Their reach is to tier 2, tier 3 city. The reach is wider to take these products to the general masses. So objective is very clear, and it is definitely on board. And once again, this is one of those items which are lined up, and difficult to give a timeline, but you will see consultation paper soon.
So finally, there was a TER circular on mutual fund expense ratios proposed in June or July of 23, which proposed a different system of TER charging. Instead of fund level, it would be asset class related. There was some feedback, and then Sebi said we are relooking at this. So has that paper been indefinitely rolled back, or what is the status?
So status is that it came up to Sebi board in the month of June. Sebi board discussed it, and they gave some suggestions. Now those suggestions are again have been incorporated, and it went to a mutual fund advisory committee. Mutual fund advisory committee has given some suggestions, and those suggestions are being tested on the basis of data, because as you know, our approach in Sebi is that whatever we propose, we actually do data testing, you know. So that is going on, and once that is completed, then once again, you know, it will be put up for public consultation. So, but sufficient to say that the board input is being taken into consideration, and mutual fund advisory committee input is also taken into consideration.
Fair enough, sir. Maybe we have time for one question. If we can pass the mic, please.
A lot of startup IPOs are expected this year, and many of them will have Fintech IPOs as well. What is the Sebi thinking in terms of the disclosure that has been made? Broadly, can you comment on the startup IPO disclosures? Are you happy with it? What is the thinking in terms of what is expected out of them?
No, sorry, I won't be able to answer that question. I am not dealing with that particular subject, so it won't be right for me to react on that.
All right. Thank you so much, sir. It was a pleasure having you.
Yeah, thank you. Thank you.
Thank you so much, Neil, for moderating that conversation. I'd now like to invite Ravi on stage, please, to present a token of our gratitude to Sri Vaishnav, sir. So thank you so much for taking the time out and joining us here at the Mint BFSI Summit. Ladies and gentlemen, huge round of applause. Thank you once again, sir. Thank you so much. And well, ladies and gentlemen, our next session promises to be more enlightening than I'd say your favorite TED Talk. Because we're not just talking about the latest movie release, we're diving deep into the sizzling world of insurance's innovation agenda in India in 2024. In a world where change is, of course, the only constant, our insurance superheroes have been donning capes of innovation. It's not about calculating risk anymore. It's about surfing the waves of change like pros. We're talking about the pulsating heart of India's insurance revolution. And of course, our speaker for this session is joining us virtually. Shri Debashish Panda, Chairperson, Insurance Regulatory and Development Authority of India. Let's welcome him with a warm round of applause. Thank you very much, sir, for joining us here this morning. And sir, I'd like to pass it over to you.
Namaskar, ladies and gentlemen. A very good morning to this esteemed gathering. First of all, I'd like to extend my heartfelt greetings to all the dignitaries present in this august gathering. And it's also a pleasure to address all of you in the 16th edition of the Mint BFSI Summit. I am even more delighted to witness the evolution of this summit from its initial beginning, from being only a banking alone in conclave into a more comprehensive platform that encapsulates the entire BFSI sector. Now, this expansion represents a commendable initiative, fostering a holistic dialogue that goes beyond individual segments, and it is contributing significantly to the growth and resilience of the entire BFSI landscape. I am sure the summit would serve as a dynamic arena where the entire financial sector gets represented and collectively addresses pressing issues, navigating challenges, and exploring emerging opportunities. Friends, the theme for my address today is Insurance Innovation Agenda. But before I delve into the depth of the agenda, let's first talk about innovation. Innovation is nothing but a simple but yet a very powerful idea that has the power of changing the entire ecosystem, the way of doing something, or even the way of living. For instance, the way food delivery applications or the taxi aggregators have altered our regular lifestyles, or rather seamlessly integrated into our lives, we do not even remember the times when such applications did not exist. Today we carry everything in our hands, in our mobile phones. It has become our virtual personal assistant. Everything is possible on a click or a tap. Even the way we are transacting has significantly changed. Scan a QR code and the payment is done. Even the mandatory requirement of internet has been eliminated thanks to the UPI Lite. The UPI moment of India is one of the biggest innovations of our times. It has marked a tectonic shift in the country's financial landscape, propelling financial inclusion to new heights. In the last month alone, a remarkable 12 billion transactions plus took place, amounting to an impressive amount of 18 lakh crores of rupees. Not just that, India has innovated one of the world's largest digital government-to-people architectures in the last 8-9 years, and leveraging its uniquely crafted digital payment infrastructure. Now, lies at the core of this digital infrastructure is a unique, first-of-a-kind India stack, which exemplifies the DPI approach by combining digital ID, interoperable payments, a digital credentials ledger, and account aggregation. Now, while the DPI's role in leapfrogging the financial landscape is undoubtable, other ecosystem variables and policies that build on the availability of DPIs have changed the very face of financial services. The biggest game changer, to my mind, would be the innovative JAM Trinity. It comprises of the Aadhaar, the Jan Dhan account, and the huge number of mobile connections. Nearly 1.4 billion individuals equipped with Aadhaar are doing millions of transactions on a daily basis. The Pradhan Mantri Jan Dhan Yojana has also witnessed inclusion of more than 51 crore people into the formal banking system. What was constituted as a zero balance account now holds an aggregate deposit of more than rupees 2 lakh crore. This is the power of innovation. The growing network of mobile connections and internet penetration is the third element of the JAM Trinity. So the unique combination of digital identity, bank accounts, and mobile connectivity has today taken financial access to the very last mile. The Pradhan Mantri Mudra Yojana added a further fillip by providing access to credit to the small and the micro entrepreneurs. It has resulted in disbursement of more than 18 lakh crores of rupees since its inception in 2015, translating into growth and development at the grassroots levels. The growth is protected by highly affordable insurance schemes like the Pradhan Mantri Jeevan Jyoti Bima Yojana and the Pradhan Mantri Suraksha Bima Yojana. 50 crore people have been cumulatively enrolled into the PMJJBY and the SBY schemes, receiving life and personal accident covers at premiums as low as rupees 436 and rupees 20 respectively for an individual coverage of 2 lakhs of rupees each. Claims amounting to more than 15,000 crores of rupees have been paid till financial 22-23 in these schemes. Now, if we talk about the Pradhan Mantri Fasal Bima Yojana, that has universalized crop insurance with subsidized premiums, with some states even offering coverage as low as at a premium of 1 rupee. Even in the health segment, the Pradhan Mantri Jan Arogya Yojana is a path-breaking intervention. It is the world's largest health assurance scheme, providing health cover of rupees 5 lakhs per family per year to cover more than 12 crore poor and vulnerable families, which is approximately 55 crore beneficiaries that form the bottom 40% of the Indian population. It is complemented by the Ayushman Bharat Digital Mission, the ABDM, which is the integrated digital health infrastructure of the country. So it is one of the unique infrastructure that is trying to bridge the existing gap amongst different stakeholders of the healthcare ecosystem through digital highways. More than 51 crore Abha accounts have been opened, linking more than 33 crore health records. Further, to address the longevity risks among the workers in the unorganized sector and to encourage them to voluntarily save for their retirement, the Atal Pension Yojana also is a pension scheme that offers a guaranteed monthly pension ranging between rupees 1,000 and rupees 5,000 on a monthly contribution of as low as rupees 42. Thus, a unique yet affordable insurance ecosystem has been laid over the last 8-9 years, spanning life insurance, health insurance, personal accident, crop insurance, and even taking care of the post-retirement pensions. This collective access to banking, credit, and protection has placed India in a unique spot where the financial services are available today at the doorstep of its citizen, wherever maybe they are. This is a classic example of how innovation can transform and empower a nation of 140 crore citizens. The strategic approach of fostering innovation at the grassroots level, followed by upward mobility, has made India a genuinely inclusive and a human-centric digital economy. In this era of economic and technological ascent, the insurance sector also stands at the crossroads of unprecedented growth. The stability offered by democratic governance, technological developments, coupled with favorable socio-economic indicators like the burgeoning middle class, the increased discretionary spending, demographic dividend, and such other factors are creating an environment where the insurance industry can exhibit robust growth and flourish further. India's insurance sector ranks 10th globally, and several reports indicate that it will rise to the 6th position by 2032, outpacing its peer economies. Demonstrating a sturdy growth, the industry has maintained a compound annual growth rate of 11%, achieving 14% in the previous financial year with a premium income of more than rupees 10 lakh crore. It is also noteworthy to mention that the aggregate assets under management of the insurance industry stands at around rupees 60 lakh crores. Notably, in the last 13 to 14 months, we have seen the entry of 5 new insurance companies into the market, marking a significant development, that is, after a hiatus of 12 years in the life insurance segment and after 5 years in the general and the health insurance segment, we have seen the entry of these 5 new players. This resurgence not only underscores the sector's inherent potential, but also reflects a renewed and a heightened interest from investors. Though the industry is growing at double-digit growth rates, there still lies a huge potential for expansion as well as deepening of the insurance market in India. There is a significant scope for insurance proliferation in the traditional risk areas like life, health, property, motor, and crops. There's also a gap to fill in the MSME sector. The missing middle in the health requires urgent attention. Additionally, we need to address emerging risks like climate change, pandemics, and cyber threats. As the world becomes increasingly digital, we anticipate a future of continuous underwriting and seamless insurance wherein consumers demand personalized offerings. The future will also be shaped by young millennials and the Gen Z who seek personalized, flexible insurance products that fit seamlessly into their tech-driven lifestyles, more so in a do-it-yourself, the DIY approach. At the same time, older individuals are living longer and expecting more from their retirement, necessitating flexible retirement plans for an evolving later life environment. There are segments of the populations that are still unaware of the insurance needs, and it is the responsibility of the insurance sector to bring them into the fore. These protection gaps, the disparities, represent a massive opportunity. And thus, it can be said that the potential of insurance is nothing short of immense. And India's vast resources, human capital, and technological capabilities position us to seize these exponential opportunities. We need to cater to the needs of 1.4 billion people and their businesses, their property, their health, their cattle, their farms, and so on and so forth. We need more players. We need more capital. We need more distribution channels. We need more products. We need more competition. And most importantly, we need innovation. We need to find answers to these very fundamental questions. The first and foremost, how to make insurance transaction more seamless and more customer friendly. Do we have all the required insurance products on offering? Are the traditional distribution channels able to cater to the dynamic needs of the future, including those of the millennials and the Gen Z? Whether the cross-linkages in the BFSI sector for distributing financial products require a relook? How to build even a stronger grievance management system? What about awareness, affordability, and availability? What do we need to do, and what more, and how much more? I can assure that the insurance sector intends to find these answers, pursue these opportunities with resolute commitment and strong intent to take every insurance to every doorstep. The next decade is of paramount importance for the insurance sector, marked by radical changes in the way insurance is perceived, bought, and sold. There is a need to build an ecosystem where insurance is seamlessly integrated into our lifestyles, where the premiums are no longer one size fits all, but are customized to individual risk profiles, where data analytics allows for personalized pricing, where the premiums reflect individual risk and not just the average risk of the group, where the entire insurance process from buying a policy to filling a claim is not just efficient, but also trustworthy, where smart contracts automate claim settlement and you don't have to wait for weeks or months to get your claim settled, but it gets instantly and fairly and transparently settled, where insurance is a simple, swift, and personalized experience, while at the same time maintaining a delicate balance in ensuring consumer protection, fostering fair competition, and facilitating growth without compromising the sector's stability. That's where we want to go. And all of this is possible when we innovate to correspond to the realities of the 21st century. Now, to illustrate, the younger generation of today has immersed itself in the virtual world, prompting many Indian insurance companies to establish their presence in the metaverse, facilitating real-time interaction between the virtual avatars. This marks the initiation of a transformation journey that not only reshapes perceptions of insurance, but also redefines interactions between brands and consumers. The modern age has blurred the boundaries between various sectors, fostering integration to seamlessly provide diverse services. The insurance sector is no exception. Mass insurance schemes like the Pradhan Mantri Jeevan Jyoti Bima Yojana or the Suraksha Bima Yojana exemplify a symbiotic relationship between the banking and insurance. Likewise, the integration of insurance services with platforms such as ICRTC or the Amazon or the ride-sharing apps like Ola and Uber showcases a classic association between the insurance sector and the realms of railways, commerce, or transportation. In today's landscape, cashless claim settlement has become the norm, showcasing a collaborative effort between the health or the motor sector and the insurance industry, streamlining the processes for the common citizen. If I talk about travel insurance, insurance companies are able to provide cashless facility in their empaneled hospitals, even in the foreign countries as well. Not just that, various sectors have showcased demand for specialized or customized products that could meet their unique needs. For instance, the infrastructure sector may utilize an insurance product which would enhance its liquidity at minimal costs. This has led to the introduction of the surety bonds by the insurance sector. Addressing the recent geopolitical situations affecting the import of oil and fertilizers, the insurance sector established a 500 crore MCET pool for ensuring smooth imports and safeguarding the lives of ordinary citizens from disruption. In the realm of insurance, it may not be an exaggeration to state that its presence provides comfort, while its absence can lead to significant distress. And thus, it's evident that a silent yet impactful revolution is unfolding within the insurance sector, playing a crucial role in adapting to and shaping the dynamics of the contemporary world. Now, this underscores the pivotal importance of insurance in fostering stability and resilience in an ever-evolving landscape. We need to further sustain, fuel this momentum, and bolster the insurance sector of India so as to ensure safety and protection for all. Friends, the insurance industry has matured over the last 2 decades since the liberalization. The traditional rule-based regulatory framework may not be sufficiently equipped to harness the full potential of the sector, especially in the area of economic and technological advancements. Rather, it may act as a constraint or an obstacle to growth. The evolving landscape demands necessary freedom and sufficient maneuverability, and thus a regulatory overhaul became necessary to align with the intricacies of contemporary opportunities and challenges. Now, keeping these in mind, we undertook a 360-degree evaluation of the regulatory framework to check for its agility, to check for its relevance, and to check for its adaptability. It was found that there were many strict boundaries which were affecting the pace of the industry and thus stifling growth and innovation, also hindering choices for customers. A lot of approvals were required even for launching a simple product. There were a lot of compliance requirements and myriad of returns to be filed, affecting ease of doing business and also increasing the compliance cost. The next step was extensive engagement with the stakeholders, following a very, very consultative and a participative approach. Now, these engagements actually resulted in better understanding of the ground realities, the needs of the sector, and the transformations required therein. These critical insights and the inputs that were received from these discussions and dialogues helped in ideation of policymaking. Not just that, the revised framework was again put up for multiple consultations for further suggestions, improvements, and feedbacks. As a result of this extensive exercise, a new landscape has been created for the insurance sector. This new landscape builds on the pillars of A, ease of doing business, B, more avenues for growth, C, promoting healthy competition, D, enabling innovation, and E, extensive technological adoption while keeping the interests of the policyholders central. Now, to quote a few transformations, today, regulatory processes have been simplified with seamless entry into the insurance sector. An online portal for issuance of the no objection certificate has been established. A dedicated facilitation group is allotted to every new applicant for guidance and handholding. Once entered into the insurance market, various other flexibilities have also been facilitated in the spirit of necessary ease of doing business within the regulatory architecture. Say, for example, quick launch of insurance products by insurers have been introduced by the use and filed for majority of the products. Revision in the distribution architecture now allows insurers to tie up with multiple distribution partners, a step which is towards making it a fully open architecture. Increased empowerment and flexibility has been accorded to the boards of the insurance companies for making business and operational decisions independently with strict accountability through a strong governance framework. Flexibility has also been provided for payment of distribution commissions within the overall expenses of management, which is the EOM limit, which is now applicable and monitored only at the company level. Further, keeping in mind that the insurance sector is capital intensive, the limits for raising other forms of capital or the subordinate debt have been enhanced with prior approvals being dispensed of. Efforts are also directed towards adopting a risk-based capital regime to bring about efficient utilization of the capital and align with the global standards of accounting and reporting by implementing the Ind AS, that is the converged IFRS. Dedicated mission mode teams are working at full throttle in this direction, and we are expecting that we would be able to transition to the risk-based capital framework as well as converge to the IFRS by the middle of 2025. We are awaiting the notification of the standards, and once that is done, we will be able to move on. Regulatory framework for investments have also been revamped, paving way for more opportunities and better returns. For example, insurers can now invest in funds of the alternate investment funds, in debt securities of the InvITs and REITs, increased exposure to the BFSI sector, and many more. We understand the crucial role technology can play in changing the face of the insurance sector, and therefore we have a dedicated mission mode InsurTech team within the IRDAI working on technological initiatives in the insurance sector. Now, some of the initiatives include onboarding of the insurers on the Bharat Bill Payment System, which is an integrated payment solution providing an interoperable and accessible anytime, anywhere bill payment service. A total of 44 insurers have already been onboarded on the BBPS platform. Similarly, insurers are also being nudged to adopt the account aggregator framework, which is a consent-based architecture for seamless exchange of financial information. A total of 28 insurers have already been onboarded as financial information provider and another 32 as financial information users, while 27 have been onboarded as both FIPs and FIUs. Insurers are also being encouraged to use paperless, Aadhaar-based eKYC, which is simple, convenient, and seamless vis-a-vis the traditional method of KYC. 53 insurers are actively using the Aadhaar-based eKYC. The regulatory sandbox which existed has been completely revamped. From the earlier cohort approach, we have moved towards a 24/7, 365-day availability. The experimentation period has also been enhanced from 6 months to up to 3 years. The revamped environment fosters innovation and provides sufficient time to test and experiment the utility and the feasibility of diverse products and processes. The tech-based add-ons like Pay As You Drive or Pay How You Drive are a successful result of these sandbox experimentation. A lot of new risk coverages based on market needs have also been permitted, whether it is the title insurance, the surety insurance, or the performance insurance. They've all come into the market. Various other risk coverages which are not available or inadequately available in the country are being taken up. We are also looking ways and means and strategies to promote long-term products in property, motor, creation of the P&I clubs, the NatCat solutions, and more of parametric covers. Considering the importance of data for this sector, sincere efforts are also directed towards strengthening the sector's data repository, that is the Insurance Information Bureau of India, to turn it into a more vibrant and a dynamic body. It is also envisaged to have a one-stop for catering to the data requirements of the sector, and while also providing critical insights, early warning signals, and data analytics. This will help the industry in improved and data-driven decision-making, leading to better underwriting, better product design, and better pricing. It will also provide relevant inputs to the IRDI, and it assists the IRDI in moving towards a risk-based supervision framework. Now, the RBSF, the risk-based supervision framework, is supposed to become more agile, futuristic, and feedback embedded, which would not only discover the inherent risks, discrepancies, and aberrations, rather would act as a guiding force for the insurance sector by providing early warning signals, offering preemptive solutions, recommending corrective actions, and making the entire system more robust, more resilient. All of these measures have been initiated to make the insurance sector modern, progressive, dynamic, forward-looking, and technologically driven, as well as attractive for all the stakeholders, creating value for all. All of this is an essential part of our larger vision of insurance for all by 2047. Now, you must have heard of a unique Bima Trinity, which is being conceptualized, which includes Bima Vistar, a simple benefit-based product with parametric triggers. Bima Vahak would be a localized women-centric insurance field force from the community, from the Gram Panchayats. And the Bima Sugam would be an electronic marketplace protocol which would universalize and democratize insurance. This protocol will be connected with the India Stack to utilize the unique national digital infrastructure, enabling seamless delivery of insurance services. I believe this would be a game changer in the insurance landscape. You may ask how. The universalization of insurance would become possible as Bima Sugam would provide the reach and a bouquet of insurance services in real time at the doorstep of the citizen. This tech-led e-marketplace would transcend geographical boundaries and income disparities. It would host all the necessary information and available offerings at a single place, thereby reduce the information asymmetry. And the biggest highlight of this proposed protocol is that it would democratize insurance by making it available across geographies, across varied income levels, and across the diverse sections of the society. Even in insurance distribution, Bima Sugam is expected to cause an explosion. It would become the tech arm for the insurance agents, who are the foot soldiers of insurance, making them more accessible, making them more productive, and making them more efficient. The open architecture for distribution would result in more choices, more avenues, both for the insurers as well as the consumers, creating a win-win situation. Furthermore, an attempt is also being made to involve every stakeholder to make insurance a reality, inclusive insurance a reality. It would require a more collaborative approach amongst the governments, the regulator, the insurers, and the tech companies. In this direction, a state-level insurance plan has also been formulated, wherein each insurer has been entrusted with the responsibility of increasing insurance inclusion in the assigned state or the union territory. The support that we have received from the state governments in this initiative is tremendous, with many of the states formulating the state-level insurance committees and the district-level insurance committees. Working at the grassroots and providing protection to the most vulnerable would be the key to our vision of universal coverage of insurance before 2047. So now, as you see, from setting up of an insurance company to its operations, launching of products, distribution efficiencies, expense management, access to capital, and also the reach into the hinterlands with the support of the state machinery is being facilitated. The technology trinity would further amplify the depth and reach of the insurance market. To promote further innovation, we have a unique, first-of-a-kind InsurTech open house where we get to interact with the tech companies on a monthly basis and understand and implement the innovative solutions that may have for the insurance sector. We also engage with the CEOs of the insurance companies on a quarterly basis in a unique engagement called as the Bima Manthan to facilitate direct dialogue with the industry, understanding the challenges, deliberating on pertinent issues, while also setting the expectations that we may have for the sector. Bima Manthan is an excellent feedback mechanism to understand how the regulatory architecture is getting translated on the ground. For example, the feedback has led to introduction of a simple customer information sheet as far as the health insurance is concerned, which has become effective from the 1st of January 24. Now, what is a customer information sheet when you buy a health insurance policy? It includes the material details of the policies, including the inclusions, the exclusions in a crisp manner. The same would be introduced in other lines of business very soon. Not only that, the insurance industry is collectively working towards the common empanelment of network hospitals so as to make cashless claims even more accessible and policyholder-centric as the industry moves towards a 100% cashless environment. Further, a national health claims exchange is also on the offing, and the industry councils are working constantly with the National Health Authority for seamless integration. This would facilitate faster claims settlement and also bolster the underwriting capabilities of the insurers. We have many consultative committees, working groups, expert committees with eminent people to guide us in our journey to take insurance to the last mile. Insurance sector is characterized by its usage of a large number of technical jargons in the insurance policies or various documentations. Now we have appointed a specialized committee which will look into simplifying the language so that it becomes very, very comprehensible for the citizens who buy insurance policies. The report is expected soon. Another expert committee on finance is advising on the policy making related to insurance industry, which is a staggering 60 lakh crores of assets under management. As part of our regulatory review, we have decided to comprehensively assess the present regulatory framework. The aim has also been to provide a conducive environment for ease of doing business, reducing compliance burden for various stakeholders of the ecosystem, while also ensuring that the interests of the policyholders are protected. It was based on a predominant and extensive consultation with varied stakeholders, and as a response, the industry councils came up with a regulation review committee, which included the participation of the industry and the other stakeholders, and also representatives from the IRDI. The idea was to reduce the number of regulations, move towards a more principle-based approach from the current rule-based one, and also move towards unified regulations, which would be a one-stop for all the regulatory stipulations. A prominent feature is the introduction of a sunset clause of 3 years in all the regulations towards incorporating dynamism in policymaking. Recently, one principle-based regulation pertaining to expenses of management has been approved by the authority, while the exposure drafts of another 2 regulations are out for public comments. We are hoping that a total of 10 to 11 principle-based unified regulations for all the aspects of pertaining to the insurance sector would be notified before the end of the financial year. So from 100 odd regulations, we will end up with just having 10 to 15 regulations which will govern the entire sector, and from a rule-based to a principle-based. This is what we expect will provide the ease of doing business and the operational freedom and flexibility. So all in all, the present regulatory framework is very receptive, and it welcomes any kind of innovations or ideas or feedbacks or improvements. Our doors are open for any stakeholders in our general open house, which also happens on a monthly frequency. And through this forum, I would like to invite any feedback that any of you may have that can improve the way insurance is transacted in India. You are most welcome to share that with us anytime that you feel like. We are trying to build a new era of insurance, the era where every individual has sufficient protection and every business is supported by appropriate insurance solutions. And it cannot be done alone. All of us, all the stakeholders, be it industry participants, distribution forces, businesses, professionals, media personnel, common citizens, everyone's participation is important. Everyone is a change agent, the torchbearer of this transformation. This would ensure that our nation's journey encompasses not just milestones, but a harmonious symphony of progress and security. We are in this together, and we have to join hands and walk forward in achieving the objective of universal insurance coverage, resulting into sustained growth and development of India. And ladies and gentlemen, our vision of insurance for all before 2047 is very much a possibility. And 2047 is just the outer limit. Let us strive together to make it a reality very soon. Thank you very much for that patient listening. Dhanyavad. Namaskar.
Shri Devashish Pandaji, thank you so much, sir, for shedding light on the regulation of intermediaries with some eye-opening statistics that all point in a very, very positive direction. And I think it was also incredible how you shared there's so many areas of improvement, namely the risk areas that India needs to address and to move further towards this double-digit growth. Thank you so much, sir. We are very, very grateful. Well, ladies and gentlemen, before we actually move on and I invite our next speakers on stage, I'm going to invite all of my audiences that are seated at the back. As you can see, we have a couple of chairs that are available here, and I'm going to request you to please help me make sure that these chairs are also full, because as you would agree with me, it completely changes the dynamics of the room. So if you're seated there at the back, and if you're up for a really interesting conversation, please move ahead, please move further, and please occupy these seats because they have been reserved only for you. Thank you very much. Well, I can see we have an audience of go-getters, and that is phenomenal. Thank you, gentlemen. Okay, so all of you who are moving to the front seats, I'm calling you superstars of this day. And I'm going to introduce you now to the new stars of the BFSI ecosystem, namely Fintechs. You know, it's like witnessing a tech revolution on the stock market, and the conversations are, of course, becoming more intense than battles plot twists. Ma'am, we have chairs here. Ma'am, you can use, yes, this table has 2 seats here. We have 2 seats here on this table as well. So for all those of you who actually made it to the front, guess what? You've got a front row seat to discuss a saga that goes beyond the numbers. Can public listing be the alternative anthem for fintechs? Or is it the crescendo of a financial symphony? IPOs come with challenges like navigating a financial obstacle course, and the question is, are our fintech warriors ready for the scrutiny, the spotlight, and the unfiltered gaze of the public market? I don't have the answers, but they certainly do. Let's welcome our moderator for this discussion on stage, Ranjani Raghavan, Senior Editor, Mint, who will be joined by our speakers for this conversation, Kunal Verma, CEO, Frio, Nirav Shah, Managing Director, Equirus Capital, and Richa Chaudhary, Partner, Capital Markets, Trilegal. Let's welcome them with a warm round of applause, everyone.
Thank you, Xenia. Welcome to the panel, and a very good afternoon to all of you. We have the benefit of Governor Das's talk earlier today. And just to summarize what he said, an interesting point with respect to the fintech ecosystem that he made was that after the RBI guidelines, investments have actually taken off, and that the sector has grown, and that the feedback in general has been positive, is what he mentioned. I thought it was a good segue into our segment, especially because we have a pipeline of fintech IPOs ready for this year and the coming years. And it would be useful to understand from market participants and fintech companies on where they see the ecosystem headed and how robust is the scrutiny going to be and how robust are fintech companies themselves. So perhaps we should start with Kunal Verma, the co-founder of Frio, a digital lending and fintech startup platform. Kunal, where do you see the ecosystem headed? Can you also give us a sort of a landscape, the ecosystem for us in terms of how the ecosystem perceives the regulatory feedback that it has received in recent years?
Sure. Thanks, Ranjani. Thank you for having us here. Very loaded question, but I think taking on from what the governor also earlier said, the one thing which is changing a lot, and we see a lot of this happening, is that we're getting more clarity into the ecosystem. Let's say dial back 12, 18 months ago, there was some speculation in terms of which way would some regulatory policies go and how that would affect the business models of fintechs, NBFCs, other financial institutions, and hence how would that affect investor sentiment, funding environments, and are the younger companies really ready to create sustainable businesses. I think net we are much stronger as an ecosystem right now. A lot of clarity in terms of what business models are allowed, what are not allowed. anyone who was predicating their business model on, let's say, a regulatory arbitrage or a legal arbitrage, I think they've had to go back to the drawing board and maybe in some cases shut down their products, reinvent their business models, rethink how they're really going to, or what value they bring to the table. So, and the good part is that most players were not really doing that.
Yeah.
There was a lot of noise around the fact that, specifically fintechs, are these products allowed, this kind of models allowed, lending, payments, can you operate or not, what's the gray area? I think a lot of clarity emerged, and once the clarity emerged, we all realized that most players were trying to build very genuine businesses, genuine products. In some cases, they were lacking clarity. They needed more assistance, guidance from the regulator, and they got it. There were some players which probably were not clear about what they had to do, and we saw a bunch of products and startups getting shut down as well. I think net ecosystem is much stronger now. I think the earlier session we heard Chairman Panda say in the insurance context, but he said that the information asymmetry is going away. I would think it's true for the overall ecosystem, which is good for us, but it also separates the adults from the kids. So you have to think sustainable business model, you have to think long term, you have to think trust, and I think that also kind of leads into the topic that you had, which is going public eventually.
Yeah. Richa, I'd like you to comment on this. There's definitely more clarity, but what are the concerns that you're hearing from your conversations from fintechs and the regulators specifically about the challenges that there may be in fintechs going public? No.
Hello?
Yes, I think before I get into the specific regulations and the challenges that the companies are facing, or not challenges, how they should be IPO ready rather. I'd like to just sort of set context. Paytm was one of the first fintech IPOs that happened. If you compare it to the larger IPO market in terms of time, it's just been 3.5 years. So what happened with Paytm was that it was an unknown territory. And therefore, a lot of lessons were learned over time with Paytm. Now, I think we've reached a point where we have understood that these are the challenges, this is how you have to be IPO ready, and therefore, although the movement has been slow in the fintech IPO area, I think it's going to now go at a larger speed, because now everybody has sort of understood what the regulators expecting, what the market was expecting, what the valuation was expected, because it was a completely uncharted territory. So having that in mind, I think some of the main thoughts that the fintech company should have when they are preparing for an IPO, and it's very important, and that's why I keep saying using the word preparing, because I think you need to give at least a year, apart from just having your book ready, to just make yourselves ready to go for an IPO. One of the most important points to my mind is having a promoter. Most of these fintech companies don't have promoters. They have founders, and then they go ahead and sort of call themselves a professionally managed company. There are a lot of legal requirements in terms of having a promoter contribution, because Sebi expects that if you're going and raising funds from public, there should be a human being at the end of the table, and not a professionally managed company, because tomorrow if there's something, who does the regulator go to? So that's the main outlook. Now, to be named a promoter, called a promoter, you have to have certain shareholding in the company. So to maintain that, to be involved in day-to-day functioning of the company, which I think even as founders you do. So that's a clear sort of tick the box. The other challenge that the fintech founders and why they don't want to be called a promoter is, as a promoter, you can't hold ESOPs. And ESOPs are actually one of the most important payment incentives for them. So the way to think about it is, maybe sort of get all your ESOPs granted before you file your DRHP, whatever you hold up until then. And of course, we all understand that post IPO is when you'll actually get the value. But now this is the challenge that we have. Sebi is saying that no, you need to have a promoter in the company when you go to public. So that, to my mind, is one of the main challenges. And I think that founders need to start thinking about it a year in advance, about how they want to position the company in terms of them being called a promoter or who's going to be the promoter. The other challenge I would say is in terms of having all your licenses ready. You know, we all keep hearing these keywords, payment aggregator license, and you know, a lot of companies don't have it. There are, I think, about 8-9 companies that are still under application. A few of them, I think recently Google and Tata, they got their licenses and they're operating. But unless you have these approvals, you will never be able to go ahead and file your DRHP, which is just the first step of your IPO. So to have all of these licenses, if you're in insurance, you need to be mindful of, you know, how much shares you're selling or what you will end up holding post IPO, because those require, that's a 5%, 1% limit. So those need to be, you know, put in place. And these applications take time. And therefore, if you're thinking of going in for an IPO, please start at least a year ahead of when you decide to file your DRHP, not listed. So that's the long process.
Yeah, I want to come to Kunal later, you know, on how promoters think about, how fintech companies think about the promoter shareholding and the ESOP question. But before that, Nirav, if you can give us some view on, are fintech companies ready for, I mean, are they more ready now than they were before, in 2-3 years ago? And how are they solving the profitability question? What is the market thinking in terms of, do you think there is appetite for companies that are not profitable to go public?
So I think couple of questions, right? So one is, to answer your question straight, the fintechs are far more prepared than what they were about 3 years back, right? The fact of the matter is, I think everybody has gone through a COVID cycle. Businesses have become more sustainable. There is a frequent talk within the community with respect to the path to profitability right now. So I think sustainability and profitability, I think, are very, very key important points that most of the founders in India have now realized today before going for an IPO. The second important point, which, you know, what Kunal and Richa said is the fact that regulators have become very, very cagey about two things, and Mr. Governor also talked in his speech about it, which is the trust to build with the regulator and the transparency that you go to the regulator with, right? So we have also seen many entities flipping back their, you know, entities from US to India right now, right? And that is to ensure that some of these structures that are there out in the market are very, very clear in terms of who the ultimate beneficiary owner is. So there are 2-3 very important points, right? So one is on the business side, which the businesses have to be far more sustainable, profitable. The second is with respect to investors don't like regulatory hangover when they are going to the market, right? So which is where a lot of thought or clarity has to come in of what licenses they have, what are they going to apply for, and whether will they get those licenses, and are the capital structure in place to ensure to be more transparent to the regulator to get those licenses. I think these are 3-4 very, very important points when some of these you know, fintechs are looking at tapping the IPO market at this point in time. To answer your question with respect to the acceptability of these you know, IPOs in the public ecosystem, right? So I'll just like to give you a couple of statistics, right? So if we talk about from and IPO is all about demand and supply, right? So there are two things. On one side, we have, you know, roughly about 17,000 crore on a monthly basis in SIP flowing in the capital market, right? And about 25,000 of net inflows on a monthly basis, which means that at least 30 to 35% goes to the financial services ecosystem, you know, because 30 to 35% of the overall Sensex is kind of financial services ecosystem. We saw banks at one point in time, then we saw NBFCs tapping the IPO market, then we saw insurance and AMCs tapping the IPO market. I think what fund managers have now realized is they want newer and newer opportunities to invest in at this point in time because of the consistent inflow that is happening in the capital market space. So they are looking at opportunities which are fresh, opportunities where the nominal GDP is growing at 10 to 12%, companies are growing at 50%, right? So they want to be investing in those and actually ride the whole wave of the fintech IPOs in the market. So that's what we have been hearing from the public market investors. Also the fact that over the last 3-4 years, all of these fund managers have been able to show significantly higher returns on the small and mid-cap funds, and which means their ability to be more bold out in the market and take a little bit of exposure to some of these fintechs have become far more better. So I think there are on one side there are companies which have become sustainable, profitable, or there is at least an awareness of path to profitability over the next 2-3 years. And the other side, there is a huge demand side which is coming from the mutual fund ecosystem to invest in some of these IPOs. I think that is very important, and founders have now realized the importance of a regulated entity. They need to consistently work with the regulator, and being transparent and build that trust with the regulator is very, very important, I think.
Yeah. Follow-up question, how large do you think a company should be, a fintech company should be when they aspire to go public? And
so I think, so there is, so what we have typically seen, right, at Equirus we've done IPOs with companies which are really small, which means that some of these companies are roughly about 2,000 to 2,500 crore market cap. We've also done fintech IPOs in excess of 5,000 crore, and we are now talking to investors which are closer to 10,000 crore kind of market cap companies. So I think it's not about how large you are at this point in time, but it's about how large a market that you are addressing and how large you can potentially become, right? So that is very, very important. One other point or an analogy I would like to draw is, see, VC at some point in time, right, is a 3 to 5 year affair. IPO is a journey. VC will pay you a 15-year forward valuation wherein they are going to be invested for 3 to 5 years. The reverse is actually true for the public market investors. The public market investors will pay you value 1 year forward, but will stay invested maybe longer if you continue to deliver, right? So what is important is not about how large you are. Of course, there is reasonable size of the company, but at the same time, it's also about how large a market that you are addressing.
Kunal, talk to us about that, about the fintech market. Can these companies sustain the growth that they are projecting, and post IPO growth especially?
Yeah, I think is the growth sustainable? I think over the long term, if you average it out, so I think like Neerav also mentioned, if you look at what the industry is growing at, maybe the credit business, at least on the digital side, is growing at anywhere between 19 to 24-25% CAGR. And I don't think the growth of the industry is going to be any lower, at least in this decade. So now if you focus on individual companies, I think growth absolutely sustainable. The quality of the growth may be questionable in some cases. I mean, in financial services and fintech, capital is the raw material. I mean, the business is about, from a business lens, I mean, other than adding value for your customers, you have to ultimately show economics, but your raw material is money. And in the private markets, the cost of capital is sometimes hidden, because when you get an equity investment and you're not committed to pay an annual IRR, it's like you don't really feel the cost. It's like compliance when you start off as a company. Compliance is like a hidden cost, but it eventually becomes like one of the biggest costs. I mean, that's the joke that anybody who gets hit realizes later on. So is it sustainable? I don't think growth without sustainable unit economics is possible. So companies which have raised a ton of capital but have not figured out economics will soon realize that capital is going to run out. But eventually, if you are in the system for a long time, the time horizon, like Neerav mentioned, if that time horizon plays out for a private investor, then people start asking about getting the capital back. And then you're not able to get more capital in because your price on your valuation doesn't make sense. So I think the price is super, super important, which then decides your growth rate. So if you come in if you get capital at the right valuation or the right price, that sets you up for future successes, provided you can run the business responsibly. Post IPO, I think the expectations are more, I would say, sustainable expectations. we all know that public market investors, all of us, in some capacity, are retail investors ourselves, can be very flippant and also very ruthless. So I think the expectations are also a little bit more realistic. So as long as you have a trajectory to create a business which is going to be around for, let's say, 10 years, if that's your ambition as a fintech promoter, then the growth rates have to be sustainable with unit economics. If your unit economics are not there, you're just playing musical chairs with investors, and eventually the music will stop. And we are seeing this play out globally right now in the Indian markets, in the North American markets. We are seeing this play out everywhere where the music is stopping, investors are pulling out. A lot of investors who have exposure to public markets and private markets, and the cost of capital is very high if you don't deliver good IRRs. So the growth model is sustainable because the demand is there, but if your business model is predicated on just burning cash, it is not sustainable.
Given all that, what do you think is still easier now in India, raising capital from private investors or actually going public?
I think, I wish there was a very straightforward answer to that, but let me put it this way. Going public, I think while there is a major milestone and every promoter and founder does think of it eventually, I think going public is transforming your life into a different path. It's like you're probably going on a 6-lane highway, and initially when you accelerate, you think that, you're moving so fast that you've conquered it. Eventually you realize that this 6-lane highway goes on forever. So you cannot be in your first gear at some insane speed. So you need to switch lanes. So going public is change in your phase of life. And I think for you to be able to do that and then sustainably raise capital, you need a lot of things to get lined up, a lot of variables to come into place. So for good early stage ideas which are catering to the Indian market, if your fundamentals are good, there is a lot of private capital floating around, a lot of dry powder, which is ready to be deployed. So in the early stages, there will be, I would say, relatively higher ease of raising capital. But as businesses become a little bit more mature, they start getting questioned on profitability, economics, sustainability. Are you burning money? Are you making money? It becomes tougher and tougher. In fact, in Mint today's edition, there's an article about one of the investors talking about that beyond Series A, Series B, it's getting tougher and tougher to write checks because your bar is very high. So I think public markets, you are constantly under scrutiny. So it is not going to be super easy, but if you can set that tone that you deliver 4 quarters of good, predictable earnings, growth, economics, and be on the right side of the regulations, then I think you have a sustainable path. But then you have to make peace with the fact that you're looking at a 25%, 30% growth, not promising 300% growth to an early stage investor. So the game changes a little bit.
Right. Richa, over to you now. In addition to the promoter question, what is the wish list that that companies going public should be mindful of, or what should be their what is the reality also, if you can sort of compare?
Right. Okay, so I think promoter, like we discussed, that's like a journey that you need to begin much before you start your IPO process. There are other considerations also, but I'll probably just take up a few important ones. I think you're going to be raising funds by way of this IPO. The important point is to how to understand and how to put it in your document where this money is going to go. Now, for fintech companies, at least from what I have seen, a lot of your money goes into marketing. And more often than not, when we have advised fintech companies, if it were to them, they want to put 100% of their money, deploy it in marketing. Unfortunately, that's not allowed under the regulations. You can't do more than 50% of your fundraise. You can't deploy it for marketing. Even for the 50% that you have decided to deploy, you need to give a very detailed analysis of every single rupee, how you're going to use it, and the deployment period, how long you're going to take to deploy the entire funds, which gets monitored, by the way, post IPO. So that is one. The other option is generally loan repayment, but again, how much loan can you repay with the funds that you're raising? So these are some of the important considerations on what your objects should be of the IPO. One positive part of these IPOs are also that pretty much every fintech company has investors. It's increasingly becoming a more preferred way to exit the company, or at least partially exit the company, because, you know, one, they save cost to an extent that they're not individually, bilaterally preparing all the documentation that is required to be prepared. They get better valuation. And also, ultimately, it puts the company on the map, right? So it gives them a lot of visibility. So these are the two important points that's coming to my mind. The other consideration to keep in mind is also, now we were talking about valuation. What happened in Paytm was that, you know, it did fall. We all know that the prices fell, and there were conversations that probably it was overvalued.
Yeah.
Currently, now when you file an IPO document, you are required to give a comparison of your valuation as compared to your peer valuation. So now every fintech company that goes in for an IPO will probably have to compare its price and give reasoning as to why their price is this and Paytm was X, and justify that. So that's another point to keep in mind, and just, you know, when you're talking to bankers, have that point in your...
Neera, would you like to respond to that? Have companies learned their lessons with respect to pricing?
So I think it's a continuous evolution process is what I feel, right? Initially, what I've seen, right, is the fact that market is much smarter than what you think they are. Market actually can give you value, you know, when you perform, but actually it can also lose value for you if you don't perform. I think these are very immediate feedback loop that is given to the promoter on a consistent basis. When you are actually going to the public market investor and you are able to prove, and see, these investors have been there, they have been investing for umpteen number of years, they have seen promoters, they have seen businesses, they have seen cycles and so on and so forth. So when we are talking to them, they already know the fact that are they overpricing it or are they underpricing the issue, right? So over a period of time, there is a self-realization that has happened with some of the fintechs that we are going to go to the market, you need to really be more, I would say, acceptable to what the public market investor has to say. So you can't really go out in the market with an aggression of a VC funding where we are talking about a certain valuation and sticking to that valuation. Market is what it gives you. You have to take it and just move on in life. I think that's what we believe.
Yeah.
I think if you are hell-bent in terms of sticking to a particular value, I think market will not support. I think that's what we have been seeing over a period of time. We have been advising founders, if you feel the value is lower at this point in time, prove yourself. The market will actually overpay you at some point in time in future.
Yeah, just to add to what he's saying, you know, we have seen companies where, you know, they listed and look at their growth chart right now. You know, every single day they get listed at a premium, and every single day their price goes. We have companies like Mamaearth and all. Look at the way they're performing. So it's valuing correctly and not being very greedy at the time of the IPO. In the long run is going to help every company, you know, from a future perspective.
Right, right. On that note, we should conclude. But if there are questions for the audience, then I think we can take a few. Yeah, one question.
Hi, this is Sneha here from Mint. You know, any one of you can take this up. We've seen this kind of wave in fintech, especially. We saw, you know, 21, where a lot of BNPL companies were funded and, you know, they withered out. So what are the next challenges that, you know, you foresee? What are the business models that you see that would probably wither away, and, you know, how are people aligning their businesses for the future?
Where are the pockets of unsustainability?
I think the way in which business models are being evaluated by founders as well as investors has matured a little bit. To begin with, people's perception of what the market size is has changed. So earlier it would be like, let me look at the population of India, let me just broadly look at a very academic approach, build a pyramid, middle, upper, bottom, this is what I'm going to do. So my market is like some, insanely high number, and you kind of get started. And everybody wants to believe it because there's a, classic excessively high self-regard bias, psychological bias, because you want it to be true. I think that's changing. People are getting far more focused into micro-segmentation. So if you have a product, who is really going to pay for this product? Is it really behavior changing? So you mentioned BNPL. Who's really going to pay for it in the long term? The merchant is paying or the consumer is paying? Or the brand is paying? And there are so many parties. Is there enough money to be made sustainably without creating a credit bubble? I think people are asking these tough questions. So one is, I think the realization that the customer segmentation has to be a very deep micro segmentation. So you kind of look yourself in the mirror. Second, I think, is who's really going to pay for it eventually. And if your main customer segment is not going to pay for it, then what's your game plan? So I think people are asking these questions upfront now, rather than what used to happen earlier, wherein they said, we'll figure out monetization later. I think that's a major change, I would say, and that's creating all the ripple effect in terms of the shifts of evaluating.
Okay,
just to add to what Kunal said, I think what is also important at this point in time for any of the fintech companies that are getting listed is, today in an ever evolving environment, some of the disruptors can get disrupted, right? So which is very important for the founders to realize that the business model where you felt that you have built a very disruptive business can also get disrupted with a shorter period of time. I think nimble with respect to understanding and awareness of that on the ecosystem around it. Second is also being able to change your path in an ever evolving regulatory environment. I think this is very important even post listing to ensure that you have a business which is kind of a certain moat around it, and at the same time you are constantly evolving in terms of the regulatory environment.
We can't take a question.
Yeah, let's take one.
Okay, let me request you to please keep it short. Thank you.
I'll keep it short. Thank you so much for insightful thoughts. I have a question to the panel that we understand that there's a lot of issues in going public for a startup or for a venture capitalist company. The only thing which we find tough is the valuation part, and valuation on two sides. One, you rightly said, Nirav, that the private equity player will give you a valuation for 15 years. He'll value at 15 years and exit out of the company after 5 years, right? In listed space, we give a valuation for a year. How are we going to solve this problem going forward? That is one. Number two, in a private equity market, we give valuation on the revenue. But in listed market, we give valuation on the profit. How we can cover this journey going forward so that at least we all can invest in these new age businesses?
Yeah.
So I think to answer your question in terms of the reconciling yourself with what the market is giving and what the investor has given you, right? So on one fact of the matter is the investor in most of the IPOs, and this may be true not only for fintech but some of the other IPOs, we have seen that the OFS portion of an IPO has actually plays a significant larger role, and there is a very small pool of primary capital that goes in the company. Now what the investors would typically want to do is optimize his return when he is exiting. So he is expecting a certain valuation. At the same time, the primary capital infused is very insignificant from the company's perspective. So company believes that while on one side there is an exiting shareholder and on the other side there is incoming shareholder, I need to prove my mettle on a quarterly basis to some of the incoming investors, right? Because it's not about only just giving in return to exiting, but also to ensure that the incoming investors also keeps on generating return on the investment. I think at some point in time, as I said, is you have to listen to what the investors has to say on the public market front, right? Because See, ultimately in India, there are 6 large mutual funds. Unless you see a really good participation from some of these mutual funds, unless you know the size being very small, etc., you need to have those investors on board at a certain price point. And you need to take that, as I said, the bold call to ensure that your IPO gets listed, right? Which solves for multiple other situations as well, right? So you are giving an exit to the investors, you are monetizing a little bit, you are infusing primary capital, employees get a certain value, there's a cash currency available for the employees, so the employees will stick on to the company for a longer period of time and so on and so forth. So I think it's a balancing act. There's no right answer or wrong answer to that. But somewhere as a founder, you need to balance these two aspects.
My question is, are the founders realizing it nowadays?
They are. I think, you know, it's not about founders realizing, it's about how others make you realize today, right? Because they are in a constant process of meeting or doing these non-deal roadshows with investors in India and abroad, is when they realize that this is, and they take it as a feedback. I think they have been far more open than what they were earlier. They listen to what the investors have to say, what the bankers have to say. They ask for our advice in terms of what valuation we should be going ahead with, should we wait for some time, and so on and so forth. So I think a lot of advice is being taken by the bankers or given by the bankers as well as the investors onto that. Yeah.
Okay, so we will conclude on that note. Thank you to the panel, you know, for your patience and for responding to all these questions. May I invite all of you to give them a hand?
Yes, absolutely. Big round of applause, and for Ranjani as well. Thank you for asking some very pertinent questions on behalf of us all. And Ranjani, I'm going to request you to kindly present a token of our gratitude to our incredible panelists. Thank you once again for being here today. Stay glued to your seats, ladies and gentlemen, because we are going to quickly move into the next conversation before we break for lunch, of course. But this is one conversation we're really looking forward to. And meanwhile, yes, huge round of applause for our power panel on stage. Thank you once again, Ranjani, and to the panelists. Some time ago, the RBI had launched an experiment to create specialized smaller banks for the needs of the underserved and the underbanked. They were called small finance banks and payment banks. What has the experiment been like? Has it gone on to a stage where we can say that these entities are truly here to stay? Have they really served their purpose? And how are they growing? And what does the future for them look like? To answer all of these questions and more in just a few seconds, I'm going to invite our next panel on stage, ladies and gentlemen. And of course, while we're almost there with setting the stage up, I want to thank all of you for joining us in the online conversation that we're having. For those of you who are joining us recently, welcome to the room. And let's take all your thoughts, your insights onto your social media platforms. And when you do that, don't forget to use hashtag MintBFSI 2024. I can see that we're almost there with setting the stage, so I'm going to request the moderator and our speakers to be on standby. Quickly make sure we put the right name tags on stage. Thank you for your patience, everyone. All right, good to go. Let's welcome the moderator for this panel, Gopika Gopakumar, Senior Assistant Editor, Mint, who will be joined by our panelists, Mr. Rishi Gupta, Managing Director and CEO, Fino Payments Bank, and Mr. Indrajit Kamotra, Managing Director and CEO, Unity Small Finance Bank. Ladies and gentlemen, big round of applause, come on. Thank you. Over to you, Gopika.
Thank you all. I know we are coming in the way between you and the lunch, so we'll make it short, crisp, and meaningful as well. We have two experts here. As Xenia said, both the payment banks and small finance banks started their journey at the same time, but they have both traversed different journeys, different paths. Payment banks took around many years to become profitable. 5 out of 6 payment banks are profitable as of now. Whereas small finance banks, because they are much closer, the model is much closer to the banks, they have been profitable from a very early stage. But I have 2 panels. Before I invited Rishi, he was a full-fledged payments bank. Now he has applied for a small finance bank. So he is soon set to come onto this side and become a small finance bank. So Rishi, my first question is to you. You have been a business correspondent, the largest business correspondent, then a payments bank, and now you have applied for a small finance bank license. Do you think this payments bank model is sustainable over the next 10 years? It has been easy for you because you are not associated with a corporate, but several other peers of yours are associated. So do you think this model is sustainable for a long time?
Thank you, Gopika. Thank you, Mint. See, the way we look at payments bank model came out in 2014-15. In fact, differentiated bank licenses came out around that period. And the world has changed in the last 7-8 years. The payment ecosystem has evolved quite a bit. We didn't have UPI at that point of time. The payment infrastructure was still at a very early stage. The QR growth had not happened. So the world has changed over the last 7-8 years. The payment companies and the payments bank have also evolved themselves, looking at the change and the consumerism and the fact that small value transactions have become the main transaction volume for the banks and for the entities. I think if I look at from a payments bank model, if you look at the pure structure of a branch model, like a payments, like a bank, a normal bank, I don't think so that model can sustain over a longer period of time. What you need to do is you need to go back to your drawing board. You need to look at how you can break up the model and look at various products within that model which can make it sustainable. Obviously, some of the products around payments, which is your cash in, cash out, APS, micro ATM, are profitable in a way because there is a fees and you can charge that. Opening an account through a CASA and eKYC process itself is a profitable business. The payment services, the cash management services. So within the payments bank domain, it's not only the payment services, but being a bank license which you have, you are host, you are a lot of products which are available to you, except for lending as far as payments bank is concerned. So if you look at only QR-based solutions or only UPI-based solutions, then obviously there will be restrictions because, as you know, there is no charge on the UPI ecosystem right now, except for the meaty incentive. So over a period of time, the world has evolved. So what we have seen is a lot of payments companies and payments bank are now looking at how we use the data. So we have data of hundreds of millions of customers which come to our platform. Fino manages about 25 to 30 million customers on a monthly basis. And an ecosystem around payments bank would look at about 150 million customers who come and touch us every month. So that 150 million customers, we have a lot of data which is available. So you can do a lot of cross-sell, whether it's on the investment products, insurance products, or even lendings. And we have seen one of the large payment companies experimenting on the lending side in the last 6 months or a year. And we have seen a phenomenal growth. So the payments bank model is more of the data which they are capturing and how we can leverage it over a period of time. Obviously, the regulations have been tough. We expect that because the regulations came in 7-8 years back, there could be a relook, there could be some benefits which one can look at over a period of time. And as you said, Fino, because we are a growing organization and growth is an aspiration which any corporate would have. We believe the ecosystem which we have created on the ground, nearly 15 lakh merchant points, more than 1 crore of customers who transact on our platform, our own customers. I think it is time that we try to give them some products around lending and try to move them into the next growth. Because end of the day, the objective of differentiated banks was to deepen financial services and to bring in financial inclusion. With this objective, I think we have covered the payments and the liability part to a large extent. I think with lending we can further increase the growth and services to the last mile.
There are concerns regarding financial viability of this model even now. So how do you think this can be addressed?
So for financial viability, it's all about the business model and the thinking which you go beyond. So as a company, as we know, we were viable from the 4th year itself. We were probably the first payments bank which became profitable. We also are the only payments bank which is also listed on the browsers. I think the way you build up the model, we have built up the model around merchant ecosystem where there is hardly any fixed cost. Most of the cost which we incur is on the technology part. So because there is revenue from every transaction, so you have to start charging the customer. And the customer is ready to pay because we provide them accessibility, affordability, we provide them services at their doorstep. So for them to go to a bank and to do a transfer or a transaction will be far more expensive. So if you look at break the model in a manner that you control the costs, especially the fixed cost, and you start charging the customer, I think that is the time when you will start making money. Obviously, if you just focus on products which are at zero MDR right now, then there cannot be a profitability or a viability around it. But use that data to cross-sell other things. And that is what we have seen in some of the companies who are very active on the UPI platform. And even on the payments bank space, we have started to see people using the data for cross-selling purpose.
Let me come to you, Mr. Kamotra. You've had a big overhang from being a cooperative bank, now become a small finance bank. How has the journey been for you? And do you think that, again, the whole business model of small finance bank continues to be relevant?
Thank you, Gopika. Let me start by saying that, India actually is fortunate to have differentiated licenses. Regulator, Reserve Bank, has been visionary. There are just 7 countries in the world which have differentiated licenses. United States, Brazil, Hong Kong, Singapore, India, and a couple more. Why? It's because these countries are not small countries. They're very varied in size, structure, demographics, banked and underbanked people. That was the reason why Reserve Bank of India gave us differentiated licenses. Now to come to the small finance banks, which you asked me, Gopika, in the last 6 years we've been in existence. Amongst the 12 small finance banks, we have 25 million accounts. Average size of Indian family, let's assume 4. So we touch the lives of 100 million Indians as small finance banks. Population of India is 1400 million. So small finance banks in under 7 years touch the life of 7% of India. I think that's some numbers to show that this need was actually there. And it validates the fact that Reserve Bank gave out differentiated licenses. Question on whether it's been a survival or is sustainable. To my mind, it's very, very straightforward. The numbers speak for themselves. Touching 7% of India in such a short time, do remember, banks are established intergenerational. They're established intermillennia. Banks hang on for hundreds of years. Like my favorite rock star, Jimi Hendrix, would say, it's just a cosmic blink of an eye. That's the period we have seen so far, just 7 years. I think the best is yet to come. Small banks will serve the purpose they've been created for, the unserved, the underserved, and do a pretty fine job of doing it.
We are seeing a lot of consolidation in your space, the latest being the AU Small Finance Bank and Fintech. Do you think this trend will continue? What do you see that the geography and business products also diversifying for small finance banks?
I think it's a very healthy sign, what we have seen. My peers, AU Bank and Fincare, we have met up a few times since they announced their plans to merge. And both the CEOs have told us that there's great synergy in geographies which they serve. One serves mostly North India, the other serves in South India. One is very focused on MFI. The other one started as a vehicle financier, does not have any MFI. So essentially, it's great synergies which are happening in that particular merger. I think the combined entity will come out very strong. Regarding the second merger under RBI's observation at present is the merger of Slice into any Northeastern Finance Bank. I think that's a great one. A good fintech company going in to strengthen a bank which could use capital in Northeast India. Consolidation is always very nice. The government of India has done that with our nationalized banks. We have brought down from 36 nationalized banks to just 11 today. So sometimes size does matter. Consolidation is a good thing. And yet at the same time, I invite Rishi, who has put in an application to join our peer group. So the numbers will keep growing by inflows and outflows.
You also have a tie-up with another fintech. How has that experiment been? You know, we have seen, we are going to see the Northeast Bank and Slice playing out, but you've also had a similar tie-up with another fintech. So how has that experiment of a traditional, an NBFC, a bank and a fintech, how have you been able to leverage on technology?
Actually, I think that's one of the best things which happened to Unity Bank. Our major investor is RIPL, one of the leading unicorns of India. You know, we work together in many spaces. The fintech stack, we are working together now on merchant acquisitions. We've recently announced we will work on cards together, QR codes. You know, Gopika, in a way, it's the best thing for India to have its banking and its fintech integrated. In the previous panel, I was very happy to hear the fintech set talk about the great plans they have for our country. India today, being the 5th largest economy, steadily marching to 28, 29, when we become the 3rd largest economy, we'll have to grow 3x. Simple banking won't do it. Simple fintech might not do it. But a combination of both together gives India a recipe of success. I think fintechs coming together with BFSI space is the best thing which has happened for India for a long time.
My last question to both of you, so is this the next a step before becoming a universal bank? I know everybody has the ambitions to become a universal bank. So for both of you, is that the way forward that you see?
I think we should go one step at a time. And before moving to the next step, you have to prove yourself before you move to the next step. So when we look at the payments bank, and especially Fino Payments Bank in this context, we have seen a lot of things we have achieved. We have achieved a large distribution of nearly 95% districts which are covered, 1.5 to 2.5 crores customers coming to our platform every month. Our own customers crossing a 1 crore number, transaction volumes in range of about $8 to $10 billion a quarter. So there's a lot of depth and distribution which we have built up over the last 4 to 5 years or maybe 7 years. So when we look at going to the last mile, distribution is going to become the key. And I think gone are the days when you can set up branches to do businesses and grow and reach the last mile through branch ecosystem. Fortunately, the ecosystem around differentiated banks came when the India stack was coming up, the Jandan, Aadhaar, Mobile, Trinity, or the NPCI stack, or the entire UPI stack. So a lot of digitization is happening. The customers are actually moving up the value chain. We now contribute nearly 1.5% of UPI transactions. If somebody would have asked me 3 years, 4 years back, do you think your customers which are in the below the poverty, or not the below the poverty line, but lower part of the pyramid, do you think them using UPI? I think India is becoming very aspirational. The growth is there definitely. India is becoming digital. So from a payments bank, having proved ourselves from the fact that we have achieved a lot of tick marks, if you look at profitability, listing, viability, the fact that we have a large distribution, we have a large ecosystem of customers, I think those things are there. So we move up onto the small finance bank as per the RBI guidelines of conversion, and then see how do we shape up over the next 5 to 7 years before we even think of applying for a universal bank. But just obviously, if you ask any banker, he would always dream to be a universal banker, and he wants to provide all kinds of services to his customers. And we also obviously have the same dream, but one step at a time. From a payments bank, move to the next step of small finance bank, and then we see how do we perform there. Everything is performance based. I think if you perform well and you meet the objectives of the regulator, I think then you can think of moving up the value chain.
When do you see yourself? Do you have some timeline in mind?
So as I said, one step at a time. So for us, first step is we have already applied to the regulator for a small finance bank. We wait to hear from them, then we convert, and then we start our journey as an SFB.
Okay. Mr. Kamotra?
Thanks, Gopika. Let me start by saying Unity Bank is India's youngest bank. We are the most recent bank to have got a license of any format from the Reserve Bank. Early years for us. At the moment, we're very pleased with the markets we're operating in. We operate in the inclusive banking market with microfinance, 1/3 of our portfolio. We operate in MSME market with the small and medium enterprises, another 1/3 of our portfolio. We operate in supply chain, yet another small finance bank cohort. Essentially, we're very pleased to be working in the small finance space. 75% plus of our lending is conforming to small finance below 25 lakhs, and not simply because we've been told that's the way it should be. That's very sensible lending today. You have better margins when you lend smaller loans, as long as you keep your NNPA. Our NNPA is less than 1%. So if you control your lending carefully, that's the sweetest spot to lend in. Some of my peer SFB CEOs would prefer not to lend anywhere but MFIs. The issue here is, let's grow our given task well. We're all professional managers at helm of banks. Let's grow it safely, build a very robust, large format bank infrastructure, and I defer to what Rishi has said. It's not just branches today. It's reach digitally through our apps, through the net, through UPI. So let's follow that and become large, robust, and sustainable. Yes, when the time comes for us to graduate to the next format of banking and add some larger products, we'll be happy to step up. But at the moment, my task is very straight. Do small finance bank safely, well, and responsibly. So that's what we are engaged with.
Thank you. Before we wrap up, any audience questions? Maybe we can take, we have 2 minutes, so we can take 1 or 2 questions if there are any. Okay. So I think with that we can wrap up this session. Thank you, gentlemen, for joining us. But I think the key remains that although banks have this ambition of becoming a universal bank, in their own respective space, they continue to grow. Of course, payment bank model requires a bit of tweaking so that they become financially viable. But small finance banks, the theme is laid out to them, and it is important that they continue to grow and diversify their grow in terms of their geography and diversify in terms of their business products. So with that, thank you all for patiently listening in, and please join us for lunch. Before that, we'll have a photo op.
Thank you so much, Gopika. I'm going to request you to kindly present a token of our gratitude to our panelists. Ladies and gentlemen, the only thing between you and lunch is a big round of applause right now. So come on, go for it. Let's not save energy because there's a delectable spread of food outside waiting for you. Thank you once again. Well, it's time to give your taste buds the front seat. So please walk outside right away, grab lunch. However, we will resume with the next half of the summit at 2:30 p.m. sharp. So I request you all to be back in your seats at 2:30 p.m. on the other side of the break. Thank you.
Where could reinvention take your business? Accenture, let there be change.
Ladies and gentlemen, we will be starting shortly, requesting you all to please join us inside the ballroom and take your seats so that we can get started on time. We have an action-packed agenda to be covered. I request you all to please join us back in the ballroom and take your seat. Thank you.
Where could reinvention take your business? Accenture, let there be change.
हर पल करे खुशियों की सवारी, अब शान से चलाए हम अपनी गाड़ी।
Canara Car Loan, Canara Bank, together we can.
गोल्ड से लेकर बिजनेस, पर्सनल से लेकर होम, हर जरूरत को मिलेगा लोन। IIFL फाइनेंस।
Serving more than 20 million happy customers with around 1,000 branches and over 1,400 plus ATMs that are spread across...
Ladies and gentlemen, requesting you all to please join us back in the ballroom. Our panelists are on standby and they are absolutely ready to entice you with the next conversation. It's one we are really looking forward to. Let's begin on time so that we can catch up with the rest of the agenda. So please join us back in the room. And of course, don't forget to put your cell phones on the silent mode. Thank you.
To ensure our journey along with our stakeholders keeps moving to a better kal ki or.
आइए भारत की रचना करें, एक ऐसा भारत जहां हर घर में नन्ही परियों का स्वागत हो और हर घर की बेटी स्कूल जाए, पढ़ लिख कर जीवन में तरक्की लाए, जहां हर नागरिक देश को आगे बढ़ाए और हम हर जीवन को सुरक्षित रखें। LIC ऑफ इंडिया।
हेल्थ की कीमत क्या है? ये सवाल जितना अजीब है, जवाब उतना ही आसान। ओपन हार्ट सर्जरी के बाद दिल खोल के हंस पाना है हेल्थ की कीमत। थमे हुए कदम वापस बढ़ जाना है हेल्थ की कीमत। नन्ही शरारतों की घर वापसी है हेल्थ की कीमत।
इसलिए जो हेल्थ की कीमत जानते हैं वो मणिपाल सिग्ना हेल्थ इंश्योरेंस को मानते हैं,
क्योंकि ये है हेल्थ इंश्योरेंस एक्सपर्ट विद फुली लोडेड प्रोडक्ट्स और इजी क्लेम सेटलमेंट के साथ।
अब इससे अच्छा हेल्थ इंश्योरेंस और कहां? मणिपाल सिग्ना हेल्थ इंश्योरेंस। एक्सपर्ट की सुनो, सही चुनो। खाना बनाने का प्रेशर करे इजी सिटी प्रेशर कुकर। अगर ब्लड प्रेशर ऊपर नीचे हो गया तो हॉस्पिटलाइजेशन। जरूरत पड़ेगी मणिपाल सिग्ना हेल्थ इंश्योरेंस की, जो है हेल्थ इंश्योरेंस एक्सपर्ट। मैक्सिमम क्लेम ऑन ऑल हॉस्पिटल बिल्स। जो हेल्थ की कीमत जानते हैं वो मणिपाल सिग्ना हेल्थ इंश्योरेंस को मानते हैं।
सर, ये मणिपाल सिग्ना का ऐड नहीं है।
हाँ तो क्या हुआ? मणिपाल सिग्ना हेल्थ इंश्योरेंस। एक्सपर्ट की सुनो, सही चुनो। मच्छरों से परेशानी, नया गेट आउट लगाते ही मच्छर आउट। लेकिन हॉस्पिटल के आउट पेशेंट डिपार्टमेंट यानी ओपीडी में जाना पड़ा तो जरूरत पड़ेगी मणिपाल सिग्ना हेल्थ इंश्योरेंस की, जो देता है कैशलेस ओपीडी, डॉक्टर कंसल्टेशन, लैब टेस्ट और फार्मेसी भी। जो हेल्थ की कीमत जानते हैं वो मणिपाल सिग्ना हेल्थ इंश्योरेंस को मानते हैं।
ये मणिपाल सिग्ना का ऐड नहीं है?
नहीं, मणिपाल सिग्ना हेल्थ इंश्योरेंस। एक्सपर्ट की सुनो, सही चुनो। दिल का मामला थोड़ा पेचीदा होता है, इसलिए हार्ट प्लस कुकिंग ऑयल लेकिन पेचीदा तो ओपन हार्ट सर्जरी भी होती है। आपको जरूरत पड़ेगी मणिपाल सिग्ना हेल्थ इंश्योरेंस की, जो है हेल्थ इंश्योरेंस एक्सपर्ट। ये देता है ग्लोबल कवर, मतलब बेहतरीन ट्रीटमेंट, इंडिया में ही नहीं बाहर भी। जो हेल्थ की कीमत जानते हैं वो मणिपाल सिग्ना हेल्थ इंश्योरेंस को मानते हैं।
सर ये मणिपाल सिग्ना का ऐड नहीं है।
तो मणिपाल।
All right, ladies and gentlemen, welcome back. You know, the only thing better than all that delectable food we had outside is a super enthusiastic panel that's ready to take the stage. In fact, it was a challenge for me to get two of our panelists off stage and tell them, sir, it's an honor to have you here, and I will invite you in the most apt way. That's how passionate they are about what they're going to share with us. But you know, it's only fair that before I invite this power panel, I request all of you to kindly occupy the front seats first. And you all did amazing the last time. So can I please request all my friends seated there at the back to please join us and occupy the front chairs? It would really infuse energy into, you know, the next half of the agenda, and you all are absolutely fantastic. Thank you so much. How lovely. Thank you, sir. Thank you. Now, before I invite our next power panel, welcome to the post-lunch session. We also call it the graveyard shift in the event management industry. But, and usually it's a worrisome period for someone like me who talks on the stage for a living. But today, as you can see, I'm quite equally excited because they're going to take care of it. That's what they've told me. But before we invite them on stage, let's quickly thank our partners, associate partners, Equirus Capital, IIFL Finance, Union Bank of India, Jammu and Kashmir Bank, Canara Bank and LIC of India, our partners Manipal Signa and Bank of India, Enterprise Reinvention Partner Accenture, and Knowledge Partners How India Lives and Wisdom. Thank you so much. Also remember, hashtag Mint BFSI 2024. And with that, ladies and gentlemen, it is time to invite our power panelists. You know, once considered a silver bullet for tackling assets, bad assets in India, the IBC has taken on a brand new narrative, sparking discussions that resonate far beyond the boardrooms. And therefore, our next conversation is an initiative in that very, very direction. We're going to dive into a chat where we confront the IBC's evolving role and dissect its journey from swift resolutions to the current landscape where patience is a much-needed virtue. Please join me in inviting on stage with a thunderous round of applause our moderator for this conversation, Shayan Ghosh, National Editor, Mint, who will be joined by Mr. Behram Vakil, Founding Partner, AZB and Partners, Mr. Nikhil Shah, Managing Director, Alvarez and Marcel, and Mr. R.K. Bansal, Managing Director and Chief Executive Officer, Edelweiss ARC. That round of applause does not do justice to, yes, the Powerpuff Gang on stage. Over to you, Nan.
A very good afternoon, everyone. So, as we have been repeatedly reminded that post-lunch session isn't really the easiest to hold an audience's attention to, but then we have some of the finest in the industry as far as stressed assets, IBC, legal things are concerned. So, the panel, as you know, is on IBC, on the Insolvency and Bankruptcy Code, introduced about 7 years ago. So we saw a lot of large resolutions back then, when RBI sent a list of stressed assets to banks, nudging them to send them to NCLT. The discussion today we want to have around is, does IBC still hold the same promise? So we'll first go to Behram, who's one of the architects of IBC. Have you, having seen it since inception to now, how do you see the evolution of IBC, and has it panned out as was initially expected?
Thanks a lot, and thank you all for your patient listening, especially in this graveyard session. And I think that, if I may take it into two parts, so start with the happier story of pre-COVID, the first 3 years of IBC. I think it would be fair to say that in those 3 years, it surpassed anyone's best expectations. So that was the time that we were, there was the twin balance sheet crisis, and NPAs were at an all-time high. Now they are much less than half, I think, from, a quarter. So fantastic progress. We've seen that there's a very direct correlation between time taken and recovery. So there again, we were virtually at a global top standard, and we have definitely slipped from those super swift times. And I have to highlight that the first 12 cases were all billions of dollars. Nikhil can tell you more about it, but they were in billions of dollars. So the law started with the largest and most complex cases, and they still did it in a very timely manner, even though it went through NCLT, NCLAT, and say something like SR Steel went to even the Supreme Court several times, because there were so many challenges, constitutional challenges, and at each stage the judiciary was super efficient, it has to be said. And of course, even recently they asked that how will an insolvency professional manage a huge complex business. I don't say this because they are both good friends, but you can see the results. There's an IIM study which shows even during the IBC process and certainly post IBC on the other side, the companies have done amazingly well. If any of you all, had invested in some of these, you would have unbelievable returns. So that was the happy story. Now we come to post-COVID. Of course, during COVID, most countries had put the law in abeyance. And thereafter, we have never recovered that speed. And there have been several issues. I'm sure all of you know it well. There were some, with due respect, I think some pretty unfortunate judicial decisions. There were also, we do need some changes. They were imminent. We almost made it, but I guess with the elections around the corner, now we have to wait till the next monsoon session. So I'm hopeful that we will recover, and I just have to say that besides, first of all, it was never about recovery, but has there been a change, a behavioral change, credit culture change? I think that's a resounding yes. So, the amount of money that creditors have recovered because of the threat of IBC, that is really the huge, huge number.
To Nikhil now, he spoke about the threat of IBC, the threat of losing control of the companies. Does that still loom large on promoters?
Firstly, let me just thank Mint for organizing this event and inviting all of us to speak on this panel. I think that the threat of the IBC is very severe. I think it plays on borrowers' minds if they decide to get too aggressive or too ambitious with leverage, and they're not able to, there is in the back of their mind now a worry that they may lose their company if there's a default or a situation that may also occur. And so I have to agree with Behram that it is a story of two tales. However, I take a longer view that in the 6 or 7 years that we've gone by, a lot has been accomplished actually, from not having any system at all that worked to actually having a system that does actually provide a mechanism for people to resolve stress assets. In particular, where you have complicated capital structures with different kinds of stakeholders in the capital structure with different charges, this is the only way actually to resolve those type of cases. Having said that, there are some problems. And those problems I think are mostly around the time frame taken to resolve. Because the time frame has been extended so significantly, almost double what is expected, There is now a concern from the lender community that is it worth going through this process if it's going to take 2 or 3 years to go through from filing of the application. And so what we've seen is that there's an uptake of resolutions that are taking place out of court. And actually that's as Behram mentioned, that it is those settlements out of court that has been driven by the fear of the IBC, which is a good outcome because typically out of court settlements take much less time, much less cost, and most of the stakeholders are happier with those outcomes.
Okay. Going to Mr. Bansal, as an ARC, how comfortable are you in using IBC, and how helpful has it been for an ARC to resolve stressed assets?
Yeah. Good afternoon, everyone, and thanks to Shan and Mint. I think at our ARC, we were almost the second after SBI to use IBC when the IBC came into picture, because we had number of cases, and we are still comfortable in using it, though there are issues about delays as Behram mentioned and Nikhil mentioned. But I will put it in a different way. This is not only an NCLT delay problem today. I think this is also from the supply side. What is left in the system? Initial first round when we started, the recoveries were good, the assets were good, and there was interest from the potential buyers. So if I look today, most of those cases have got resolved, either through IBC, mostly through IBC, and then outside of the IBC also. So many cases today what is left in the system are difficult to resolve, or they may not have any great value left. So that is one reason which is delaying the whole thing, because you don't get the potential buyers, you don't get the resolution plan, so then what do you do? And we have seen that happening with the banking industry. They are not able to resolve many of the assets which are left with them because maybe the resolution is difficult or there is not much value left. So even when they try to sell to national ARC, they are not getting those type of good offers. So one problem is not only the NCLT infrastructure problem and the delays, but even if you take into account the delays, and if I compare before IBC, when as per World Bank study we used to get about 20%, and the time period average about 4 to 5 years. Today, even with delays, the time period is about, let's say, 2 to 3 years, and average recovery is still better than that range. So in that case, for lenders, it is still better. And behavior-wise, as Behram mentioned, it has really helped to change the behavior pattern. But what has happened in the banking industry, if you really see, last 4 or 5 years, or after AQR, Asset Quality Review in 2015, which is almost 8 years back, there has not been much lending in corporate side, because at that point itself, there was over-leverage and over-capacity creation, which took some time to get absorbed. Like say, if you remember the power plants. Once upon a time, there was no buyer for power plant. Today, there is again demand and there is just deficiency. So there is a shortage of power. So the value which we were not getting even at some point of time, 1 crore, 1.5 crore per megawatt, today there are buyers at 3.5 crore to 4 crore per megawatt. So, and which has changed during the last 4 years only. So the point is, it depends on the economy also. It's not, so what I'm just trying to say is, there are more delays happening because there are not many buyers available for the assets which are left in the system. If I find a good asset today and if I go to IBC, certainly there will be good buyers and the resolution will also be faster. So the experience is not bad. There are some delays which we can discuss further, what needs to be done. But I would say it has succeeded very well and it has changed the credit culture in the country. Thank you.
Okay. So, Nikhil, what do you think needs to be done, taking from that?
I just want to add to what Mr. Bansal was saying actually, which is that, which is a very good point. One of the parameters that's used to evaluate bankruptcy systems or insolvency systems is the percentage recovery related to the claims that are filed, and the time, of course, taken for the entire process. that recovery on the claim isn't just an outcome of the process and how long it's taking. It is also largely driven by the quality of the asset and the amount of cash flow that the corporate debtor can produce or is producing. And what is very easily as a headline number to assume is that, oh, recoveries have come down, so that must mean that the process is not working. I am completely in agreement with Mr. Bansal that that's not the case. It's actually the quality of assets that are there right now that are getting resolved are much lower in quality than there was. And in addition to that, there has been no new supply that has been created because there's been very anemic lending to the corporate sector for the last 5 years.
Right. So Behram, while large corporate stress seems to have significantly reduced, but then there is this option for MSMEs, of course, under that pre-pack. That also doesn't, seem to have taken off as was expected. What do you think could be done?
Yeah, I think, what happened was that the pre-pack again was supposed to be for everybody. And then the decision makers decided literally in the last 24 hours that we should start with MSME. And then we see how it plays. This time we don't start with the largest, we start with the smallest and then. But what we have now figured out, but MSMEs don't need it for two main reasons. One is that the cram down, what we call the consortium lending, in MSMEs that is super rare. There are 1, 2, 3 banks. So why will you go through such expense and hassles when you can do an OTS across the table? So, and it's now, there's proof of the pudding is that it's not being used. So I really hope personally, I think if pre-pack is opened up to everybody, I think there will be a lot of good use of it by the larger entities. So we just have to wait for that to happen.
Mr. Bansal, what do you think of the idea of opening it for everyone?
I've been requesting for the last 2-3 years to open it for everyone, but then there were some considerations that whether if we open for everyone, whether it will be misused. But we have seen in MSME it has not worked. So the point is, if we really are interested, and that is what happens in UK and some other countries, where, or even in US, let's say when we say Chapter 11, it's nothing but pre-pack. Now, if we have to resolve the cases fast, that is one good option. The only challenge which I still feel and why MSME also has not worked is, it requires a consent from the creditors in the beginning virtually to take a haircut. And while the others may get a better recovery, which I think goes against the basic concept of IBC, initially what was thought. So there we could face some challenges, but knowing if it is approved by everyone in the beginning and there are, let's say, more creditors which are approving it. So I'm just going against what Mr. Behram is saying. MSME didn't work because there is only 1 or 2 bankers. So then the responsibility is on me. But if there are 10 banks, then 10 banks are deciding, perhaps the responsibility get dispersed. And if it is, because it will have an NCLT stamp, so it's a judicial process in that sense. So I feel banks should not be concerned too much. So it will be very good. I think whatever we wanted as a country, there was an issue that there were too many NPAs, twin balance sheet problem, crony capitalism, whatever you call it. That has already got resolved. So I think now in future, we should think of pre-pack, which should be approved by everyone, and then you go to NCLT, and NCLT approves within very short time. So that can reduce the time span. I feel we should experiment with that and we should allow that.
I just want to add to what Mr. Bansal is saying, that in addition to the speed, actually, I actually personally believe that if the corporate debtor is in charge of actually finding its own resolution, that the values will be higher in that situation, because they're not a third party, they're not under having to assess each risk. They are in the business already, and they'll try and pay full value as far as they can in that situation.
Just to add here, half of the delays which are happening in IBC today, or more than half, are because the corporate debtor is not in control and he doesn't have a chance to bid. So I think in pre-pack, if we allow that and we go through a Swiss challenge method or whatever, and he also gets a chance and banks are agreeable with that, I think a lot of legal cases which are going on in the IBC system and NCLT system will also go down drastically.
But then doesn't it go against the idea of not allowing defaulting promoters to bid?
So I'm glad you raised that. I wanted to clarify to the entire audience because government is very, very concerned. One of the biggest hurdles I've faced is they go on saying then what happens to 29A, the old culture will come back. 29A won't go away because the idea is 29A in real life gives you 18 months. So definitely you have to come before 18 months. That's the idea. And as Mr. Bansal and Nikhil have said, most of that old story has now been cleaned up. So if there is a new story, new problems, I mean it's still a very volatile world, then please come in a timely manner. Even Governor today said early warning systems. We don't want you to come when you're already in ICU. The earlier you come, the better it is. So 29A will be there, but if you are not defaulted and met that 18-month threshold, then you don't get hit by 29A. So that is the idea. There will not be any exemption of 29A. I want that to be very clear. But certainly in that case, if you're a non-defaulting promoter, you have every right. And just one clarification, Mr. Bansal, maybe I'm misunderstanding, but the architecture right now for pre-pack is that is envisaged is that the base resolution plan is pre-agreed between creditors and the promoter. If he pays the OCs fully, then no Swiss challenge. And then that means it's a pretty much done deal. Nikhil and me were discussing in UK it takes 1 week, 10 days. We should finish quite soon. We should finish that in 30 to 45 days. Through the NCLT, chapa of approval. Now you don't have, 5 years later get a call from CVC and all this crazy stuff. So that's the, if you don't pay in full, I think that was the apprehension you had. Then you have Swiss challenge, but it's not that they get more than you. It's just that then you have to take the Swiss challenge, and again the promoter has the last chance to make the best offer. So it is definitely, he has got benefit.
Just to clarify that, sir, what happens is, typically, if you are saying that actually the borrower should come to banking industry or the lenders very early, at a very early stage. So he may not ask for a haircut from the creditors. He may just ask for a time. So if that is the case and OC is also getting paid, fine. But otherwise, suppose he comes to creditors, he wants a 50% haircut. I'm just giving an example. And then OCs are getting full, and then you want to avoid Swiss challenge, because then only the promoter will get it. Otherwise, Swiss challenge, if it goes, and if somebody gets a better offer, then there is a risk to promoters, which they don't want. But if he is giving the best value even with haircut, and there is no, I think nobody else is going to come, then Swiss challenge should also not impact him. So, but it depends. But finally, the problem is lenders have to agree in the beginning to take a haircut if it is there. I think that is where I find some challenge, though it will be a judicial scrutiny, judicial stamp of NCLT. I'm just talking from one segment of the banking industry, which then makes it difficult to approve it. Yeah?
Right. We don't have much time, but there's one question that I would like to ask all of you. We need to open it for Q&A also. The IBC hasn't seen really successful resolutions as far as the aviation sector is concerned. How do you deal with that? An industry where assets are leased and the lessors are very eager to take them back. The government has allowed that. And so, will aviation IBC ever succeed?
So you're right, we've had a super patient audience, so they don't want to hear bhashans anymore. We should open it for Q&A, but very fast. For Jet, I'm very clear that the time lost was a death blow. So the only people who believe Jet will fly again is my team and the IP. I think that it's, been dead in the water for a long time. But at that time, if you all remember, Etihad was very keen. They would have definitely been the white knight. We've all used it. It was, a very, very good service. So we just lost the chance. I think after that 6 months, that was a very crucial 6 months. That's my view. I mean, for Go, etc., it's still early days, but let's see.
I think there's one thing that is missing in our insolvency process, which is that if you want an airline to continue operating, which is how you're going to get the most value once it gets admitted into the process, there has to be adequate working capital available because the airline has daily charges related to fuel, airports, lessors that they need to make, and of course employees and staff. If they are not able in a position to make those payments, then I think it's a very low probability of actually finding a resolution. I think the cases that Behram mentioned had their own challenges, but the number one challenge for any airline, if it wants to go through this process, is that is there enough capital in order to continue operating?
I have slight different view here, Shan. Let me go back to the earlier point which I raised. What is the value of the asset? So the airline industry, unfortunately, doesn't own the planes, except Jet used to own some 12, 13 planes. Only Air India had planes, so even Air India had to take a big haircut. The government has to pay the money to sell it to Tatas. It has to work. As Nikhil said, you need a lot of working capital. Now even in Go Air, technically bankers tried initially and gave some money. I mean, that also might have gone down the drains. In Jet Airways also same thing happened. So even today the buyer is not really starting it because it needs so much working capital. And the planes had become old, the competition is huge. So even if you restart Go Air, it can't make money. I'm sorry I'm to use the names, but I'm just giving. So Air India also will take time for Tatas to make some money. So which airline makes money today in profit? Only Indigo. Because the Indigo model was altogether different and they made it in a different way. And you can't compete with them today, virtually. So whichever airlines has failed, and not only airlines, any service industry has this problem. If you don't have the assets and you are depending on a brand and marketing skills, and typically, unfortunately, in India, a lot of the consumer is very smart in India. And we are so cost conscious. We don't allow anyone to make huge money. Any day, if airlines increases the prices, we shift to AC tier 2 or AC 3 tier. So that is another thing we need to understand here. The consumer is very cost conscious. So I think a lot of people are losing money even today, whether it is in online marketing, whether it is Ola, Uber or whatever. But they are losing money and they can afford it because they have huge investors and they are looking at futuristic valuation or market valuation, not looking at profitability immediately. But the airline cannot survive that. If you have taken loans and if you keep on losing money every year, it is a difficult game. So I don't think IBC can give you a solution to airline industry. So my answer is no. IBC cannot work for airlines.
No, just in lighter vein, Nikhil may get a new client because if Spice bids for Go First, they'll go first.
Right. So we'll take a few audience questions. Please raise your hand and identify yourself and the institution that you represent. We'll have someone here.
So I have a question. Basically, I used to work with real estate companies. So we used to find problem that government authorities don't agree to be unsecured creditors. And they say, okay, so whatever you have done in IBC, it's there. We will take as per the dues. So how do you resolve that? I'm just saying from real estate, but it could be in other industries also.
No, I think that's a very good question, and that was one of the, I have to be super polite with the court system, but that was one of the cases where they messed it up. It was very, very clear, and government took a conscious decision. FM himself was in the meeting, and he said that I understand, but it's one hand or the other hand. I mean, if they take it there, I'll have to recapitalize the banks, because that was the situation then. So, and we showed a UK model, other countries. So consciously they put themselves number 5 in the waterfall. And I'm very happy to say that currently also, when we said this is a problem, as you say, across the board, it's not just real estate. In the amendments, they are clarifying that. They hope judiciary clarifies itself, because the law is very clear. But if they don't, the amendments will again say that government is number 5.
There was some confusion even with the rainbow judgment and which dismissal of the appeal. Appeal got dismissed on technical grounds, not anything else. And the judgment was specific to one case and only to GST of one state, which was considered as a secured loan. And even there, that doesn't mean they will get full money. It was supposed to be a proportionate to the secured lenders. But the media hyped it so much that every government dues will be paid full before the, because I don't know how it makes sense for them. But otherwise, in real estate specifically, the issue comes, the authorities who have given you land. Now, if you expect them also to be zero, to pay the money to secured creditors, they will not accept. But recently, Amitabh Kant committee has given its recommendations, and even Noida Authority and Ghaziabad Authority have accepted it. So they have agreed to waive some interest, and they have agreed to give more time. I think that was the biggest pocket where this issue was there in Ghaziabad and Noida. I think they have understood that.
Any other questions?
Yeah, hello. This personal guarantee issues, like whichever company becomes sick and ultimately resolution take through IBC, whether personal guarantee is being pursued, because we hear in the newspaper like all the probably 30 dozen and even other cases are being pursued now. That includes who is who. So original promoters will never come out of the whatever wrong deed has happened with the company. So like what exactly is the practice going on in IBC or courts about this?
So, one point there was that the personal insolvency, except for this personal guarantee, has not been implemented yet, because that's through the DRT system and they had some issues. I'm sure that will also come in the post-election. But personal guarantees, it's at the Supreme Court being heard. But that part has come into force, and as you say, there are some very big names that are already before the court. So I think that regime will add to the credit culture, because the promoter is now going to feel extremely cautious.
Add here, this question has too many questions in between. So my limited point is there are two types of promoters. There will be promoters who still have some assets after resolution of a case. But there are promoters, which is almost 95% or 97%, who have nothing in their names after the resolution. So you can expect to do some recoveries only from those 3-4%. I don't think you can expect any recovery from the other 97 or 98%, because they have lost company and they don't have anything, or even if they have something which will be not in their name. So don't expect great recovery from those cases. Only some people who still own some companies or some business somewhere, they may like to clear their names and I think pay some money. Yeah, Nick.
So you're not agreeing with former Governor Rajan. He said, India may you have sick companies but no sick promoters.
I agree, but that falls into the 2-3% only, no?
Right. We'll wrap it up here. It was thank you for so many interesting points, including some of the tidbits on aviation sector and answering audience's questions. Thank you.
Can we have a huge round of applause for our power panel? Because when they talk, we listen. Shan, I'm going to request you to kindly present a token of our gratitude to our panelists on behalf of all of us in the room. Thank you for sharing some incredible insights. Gentlemen, I request you to please come together for a group photograph. A group photograph, yes. So if you could please come together for a group photograph. One more round of applause, everybody. Thank you. Mr. Vakil, Mr. Shah, and Mr. Bansal, thank you so much for joining us here. Thank you. Few seconds as we turn around the stage to welcome our next panelists. Before that, I must thank you for joining in the online conversation and invite you to continue to share your thoughts, your insights on all the conversations happening in this room. And don't forget to use hashtag MintBFSI 2024. So as we navigate this brand new year, the arrival of Gen AI isn't just a technological leap. It's actually a seismic shift, unlocking doors to realms where possibilities are almost as unlimited, or rather limitless, as the digital horizon. But it doesn't end there. Gen AI isn't just a sidekick. It is in fact the superhero in the battle against financial crime. The question we pose today is not just about technology. Rather, it's about the agility of our banking titans. Are they moving at the speed of innovation, or is there even more potential waiting to be unleashed? I'm going to invite you, ladies and gentlemen, to stay in your seats and join us in this electrifying panel discussion as we unveil the reality of generative AI in the realm of Indian banking. Few more seconds before I can invite them. Good to go, sir? Okay, cool. Let's invite our moderator for this discussion, Gautam Das, editor Long Story, Mint Primer, who will be joined by our panelists, Mr. Shiv Bhasin, Chief Transformation Officer, IndusInd Bank, Mr. Milind Nagnur, Group President and Chief Technology Officer, Kotak Mahindra Bank, Mr. Ramesh Lakshminarayanan, CIO, Group Head, IT, HDFC Bank, Mr. Vipin V, Managing Director and Partner, BCG, and Mr. Pranav Arora, Managing Director and Lead Applied Intelligence, Accenture in India. AI and the banking stack. If you want some cool insights from this cool gang, please give them a round of applause. Come on. Welcome, and over to you.
Thank you. Thank you so much. Electrifying it is, and let me tell you, this will be the coolest panel of the day. And I'm not exaggerating, right? Ever since ChatGPT was released in December 2022, a little over a year back, AI and Gen AI particularly, has been the coolest topic in the world, right? And it's probably going through a huge hype cycle. Probably not. Maybe there's a lot of reality to it. But this is what we hear, right? It's going to change organizations in different ways. It's going to impact the revenue. It's going to impact operations and thereby profitability. But I think we are oversimplifying it. There are many nuances to Gen AI, and we have the right set of practitioners here today who will demystify the whole subject. Thank you, gentlemen. Thank you for joining us. But before we talk about generative artificial intelligence, right? We need to talk of classical AI as well. Don't forget there's something called classical AI, right? Let me go to Bipin, who can sort of set the context of how AI, classical AI possibly, is being adopted so far in India and within Indian organizations before we really go to Gen AI and how it will impact banks of the future. The bank of now, as they say.
Thank you, Gautam. So, I think like you said, Gautam, I think AI being in the industry, or AI is a very loosely used term. I would rather say AI ML at least, so that it covers slightly broader scope, not just AI part of it. But if I look at AI, ML as a concept, it's been in the industry for quite some time now. And if you look at most banks, or forget about banks, even broader industry as a whole, and specifically for this conversation, banks, I think many of them, at least, I'm not even comparing Milind or the rest of the team here, but even if I go beyond them, most of the banks in India at least have built a fairly good amount of capabilities on the traditional AI front and have at least a few set of use cases which are already implemented. So for example, if I look at AI, ML as a concept, there are if I look at a banking kind of context, there are use cases starting from, let's say, if I look at the entire value chain, starting from a prospecting of a customer to sales, to credit underwriting, to doing a pricing, to then monitoring, and then collections part of it. So through the value chain, there are numerous number of use cases which are available. And many, if I look at advanced banks, they have use cases implemented maybe across all verticals. But if I look at even less mature banks in that sense, they also have at least use case implemented for, let's say, for example, credit underwriting. Because one of the first functional areas which adopted AI is the risk function, wherein for underwriting as well as collections part of it, AI is getting used extensively right now. So if you look at a public sector bank or even some of the less mature banks, you will find that they have some level of ML-based underwriting models for unsecured lending or even for secured lending to that extent. Similarly, on the collections front, you will find that there are early warning systems which are being implemented to identify customers early on so that the collection efforts can be strengthened. So from that standpoint, I would say, while there is a long way to go for many banks to cover or implement use case across the value chain, but there is a good starting point already for majority of them. At least that would be my sense.
Right. Let's go to people from the banking side. Milind, would you like to walk us through what your bank has done with AI and Gen AI? What does the roadmap look like in terms of use cases?
Maybe we start with just a zoom out a little bit and a follow through to what Vipin was saying in terms of how things have evolved. I think that we have seen 4 generations of evolution overall. So first was software 1.0, where you have a business requirement, you write business logic, the machine executes it, and software engineers write the code, and that's how, let's say, our ERP platforms, core banking platforms, that's how most of the logic works. That was the first generation software. It's been happening since mainframes, then mid-segment servers, cloud, etc. The second generation was around statistical modeling, where people try to get more predictive about things, and then you apply statistical models, and tools like SAS came about. The third generation was supervised machine learning programs like random forest and so on, where that was the last hype cycle, and a lot was being spoken about feature engineering, for example, where data scientists become very prominent, and you take a certain set of input data sets, and then you try to identify key features, and you programmatically manipulate the features to get the right outputs. But the fourth evolution, the large language models, Gen AI, etc., generative transformers, I think it's very different. It's a completely new phenomenon in that you do not hear the words feature engineering at all, because with 70 billion plus parameters in the smallest model, you really cannot touch a particular parameter and say that you impact the output in a particular way. In fact, it is both exciting and scary. It is scary because nobody really knows why ChatGPT gives a certain output for a certain prompt, because there are deep neural networks now that have been programmed across the entire internet in terms of the input. The input data is the entire internet, and you really cannot control the features or engineer features to get the output. But at the same time, the output is magical, magical in terms of what it produces. And it is doing things which either of the first 3 generations of software are not able to do. As a simple example, if you take a software engineer and if you give him large amounts of data, and if you ask him to write a program to make that content child safe, it is impossible. It's an open challenge to any 10x engineer. It is impossible to write a logic or program for a human programmer to do it. but ChatGPT does it effortlessly.
Will engineers even have a job 5 years from now?
I think it's going to be very different. 6 years back, there was a paper on software 2.0, and then the term got so hyped and overused that people lost the original meaning of that. But that paper said that software engineering will change from traditionally how we are writing business logic and logic in the code for loops, etc. It will change completely to writing weights on neural networks. So you will have input data sets and you will have an objective. So for example, input data set could be a picture of what's in the refrigerator. An objective could be, I want to have burritos today. And then everything in between, looking at what's in your fridge, placing an order with Big Basket and getting all the other ingredients and a recipe for how to cook, all of that could automatically happen. So software engineering is likely to completely transform the way it is today to people who can work with large data sets, label them, be clear on objectives, and then train the weights of the neural network to do the magic. But even when we do that, we actually really don't know in these models what the logic is inside. So it is a very evolving space and very exciting actually.
Ramesh, your views on it, and how does HDFC approach the whole space?
I think interesting take. I think it's not my statement, but I think Google kind of coined it. I think it's very interesting in terms of how they look at AI and Gen AI and classical AI. I mean, if you think about it, one is the classical AI ML is and ML is important. I mean, I think we kind of left that out in that sense. That's the left brain, right? It's the analytical part. So when you're feeding in a lot of data and you want a decision out of it, and you want a decision in a way that it's human controlled and the understanding is far and deep, I think the classical side will continue to work. While on the other side, Gen AI, look at it like a right side brain, which is kind of throwing outputs, kind of taking questions and kind of answering that in an emotional question kind of driven world, right? So that's fundamentally, if you look at it, that's the difference between the classical AI and the Gen AI. Like Milind said, it is fast emerging. This is not hype for sure. I think one thing we must understand, the sophistication with which we have come up the gradient over last, let's say, 12 months is unfathomable, because you go to any industry today, if it's not into Gen AI, then there is a problem with that industry, because that's the level of magic that it can do. But having said that, there is a lot of challenge, especially for industries like us which are regulated, because often privacy is at the forefront of a lot of these discussions. Not just privacy, accuracy. There are clearly issues with hallucination that keep coming on the Gen AI quite regularly. And then of course the AI architecture. I think a lot of us are not focusing on AI architecture, because it's very easy to say I will go on Gen AI. Then suddenly when you see there are regulatory challenges, data localization challenges, there are model privacy challenges, there are trademark challenges. So how do you construct an AI architecture that's going to drive this in the right way is going to be the most complex item. From our bank perspective, I think very early days, but very interesting stuff. I think at least we've kind of saying that the classical part, there's a lot of work like Vipin said that you do, especially credit, marketing analytics, risk analytics. Those are very well, I think, organized today. Of course, more to do, but it's well organized. On the Gen AI side, I think it's largely driven by few areas. One, I think handing over the prompt to the customer is a very interesting, in that sense, it's a very interesting conundrum. Do you want to hand over the prompt to the customer? And I do think that's a very important decision. For example, we are very clear, as an example, can statements querying be handed over to customer? Why would you try and download your statements and then go to 10 different entries and then say, where did you do a transaction on that particular day? You should be able to ask that statement engine, saying, give me what happened, right? I think this is fascinating, right? So the mobile interfaces, the way we build, the mobile banking of the past is kind of going away. Again, amalgamation of that into non-traditional channels. For example, we finding very good use cases on WhatsApp banking, and how to look at conversational AI on WhatsApp banking using Gen AI actually. because it's far easier to interact on that platform rather than trying to go into a complex way of dealing with a user interface. So those are definitely the areas that we're looking. Then of course, writing a credit access memo, how can you write it faster, legal documents reading. So multiple cases right now, but I think as I said, calibrated in a way that it doesn't kind of come to a business decision that can get questioned at a very, strategic level, so to say. So,
but the contact center as we knew it is dead, right? With AI, with Gen AI, from whatever I could understand.
Yeah, in fact, the same bot, I mean, today we run the entire contact centers on the bots driven by Gen AI. The same conversation is happening on WhatsApp channel. You send an email, the same conversation comes back. You call, it gets converted into a voice bot. So it's the same engine that's talking, texting. So that's where we are heading right now.
Pranav, what about customer satisfaction? Has AI and adoption of AI and possibly going ahead Gen AI as it matures, do you see customer satisfaction going up? Do people like to interact with bots, or they would still prefer a human being picking up your call?
I think people are only worried about getting their work done, whether it happens through a bot or through a human. I think a bot or Gen AI can make life much more easier. I mean, I think Ramesh hit the nail on the head when he said that mobile banking has changed forever. I think customer service has changed forever. I think the whole RM interaction has changed forever. 90% of us get very poor RM experience. Our RMs are not really, not amazingly educated. They can't really answer any second level nuanced question. So I don't think Gen AI will change that. I think banks adopting Gen AI will change that. There is massive opportunity. How quickly are banks able to do it, whether the banks do it, whether other players do it, I think that's for us to see how it plays out. But you're absolutely right. It's not just a cost equation. There is a massive experience leg to this conversation also.
Shiv, would you want to comment on that?
Sorry, Gautam, if I may add one point to what
sure.
I think we did a simple experiment in terms of, voice bots have been in the industry for quite some time now. Even before Gen AI was there, voice bots have been there, and we have been using for collections and the sales, etc. Right? I think what has changed now is we did a simple experiment, right, in a collection context, wherein we did a reminder call based on normal voice bot and a Gen AI enabled voice bot. The difference was very simple. The customer said, "I'm at a funeral." Sorry? "I'm at a funeral." Okay. Now, the normal voice bot is not actually tuned for managing such exceptional situations, because it's ultimately a decision tree, and this funeral does not come across as a scenario, right? So it did not have a particular answer per se. It goes to a normal termination with a standard response. When you do with a Gen AI, the response is very different. It says that, yes, we understand you're going through a tough time. Maybe this is not the right time to talk to you about money right now. Maybe I'll call you back after a week. So what I'm trying to say is, moving from, let's say, normal bots to, let's say, Gen AI voice bots, the experience significantly improved. And now, as the time passes by, as some of these models become more and more mature, the difference between a human interaction versus a machine-led interaction will be very, very minimal. So to his point, one, obviously, if so long as my work gets done, I'm happy, and the process through which I get done also gets as close as possible to that of a human interaction. Sorry, I just wanted to add that.
I think that machine's response is possibly better than a human would probably manage in that
possible,
sort of
yes,
situation.
As I said, the Turing test was passed last year without any fanfare.
Right. Mr. Vasan, would you sort of enlighten us on how fast banks, the banking industry in general, could adopt Gen AI?
See, as my co-panelists have already mentioned, the AI have been into the use across various banking process. One of the oldest use case or journey have been into the fraud management, especially in the transaction fraud area. There have been the neural network based AI models have been into place for analyzing the various behavioral analytics and then making the decision on real time or near real time. So that has been a classic case, and there have been several improvements from there on, and various payment channels, electronic payments, card payments, and e-channels transactions have been augmented to leverage that model everywhere. And now the regulator is also been forcing the most of the domestic banks to adopt it. Foreign banks probably had started that journey 20 years back, and they have much more matured their models by now. While the Indian banks probably recently, last 5 years, they have been embarking on this journey pretty aggressively. Then, of course, as the customer service is another channel where some of the mundane responses moving on to the whether they started with a kind of very limited kind of a AI frameworks which were there, and now moving on to the Gen AI. Those have been the early on cases. But when we look at the contact center cases, that is a very perfect use case for Gen AI, where various speech analytics tool could be deployed, and they can have post conversation improvement in the dialogue by the customer service agent or call center agent to handle the various customer service requests. But at the same time, there are some of the real-time models where they are augmenting the awareness of the call center agent based on the customer responses to improve the experience or improve the conversation between the customer and contact center agent, and trying to cap the the conversation in least amount of time. So some of those analytics get provided to the contact center agent. So that is another very big use case have been. The other, I think, in the banking industry have been a very, very interesting use case in terms of frontline staff training and augmenting their with the latest products and offerings or latest operational processes change which are coming. So internal processes changing, process change trainings can be given using these tools. And as well as assessing those frontline staff, what is their knowledge of the business process, and telling them these are the areas where they have to improve. I think that is one of the very, very classic area where it can enhance the proficiency of the frontline staff to improve the customer service. Then fourth, one of the big area have been where I think the HR transformation, where I think there's a classic case study by the IBM. Means I'm not endorsing any such OEM or their product or service, but there is a one very popular where which may, I think, I'm sure that you will give me the next question on that, where they have optimized their overall workforce to 80% on the around their presence 100 plus countries. So that is I think another big area to look at leveraging the Gen AI for such kind of use cases.
Pranav, what sort of resources does an organization, particularly banks, need? And a follow-up question to the rest of the panelists should be, considering whatever your response is, right? Does big banks have an edge over the small here? And is there a possibility that large banks, with their resources, if they can implement AI and Gen AI solutions, there's a possibility of more industry consolidation going ahead?
Yeah, great question. So I think first in terms of resources, so the way Accenture frames it is that we say there are three parts to it, right? Are you enterprise ready? Are you data ready? And are you people ready? So enterprise ready, what that means is that do you have the right policies, right capabilities at the enterprise level to actually use Gen AI. Data ready is about, do you actually have been able to unlock your data from all your systems, because AI needs to leverage that data. You know, we want Gen AI to be very factual. When it is an RM or when it is a customer service agent, it needs to be able to talk facts with very low latency data. So are you data ready? Have you unlocked your data? Is there high quality data? Is the metadata associated with it? So that's data ready. And the third one is people ready. And people, it's not only about, do you have a select group of capability of really good full stack engineers or really good data scientists, but does your management understand how to take that change? Do you have the right change management capability to percolate this change down? If you think about it, right, when digital came in, or when even electricity came in, what inhibited adoption was not the state of technology, but was the change in management thinking. So for example, when digital came in, it still took us 20 years to get a pre-fill API. Most banks got a simple pre-fill API for an existing customer after 20 years, right? So it was the change in management, the fact that an application form had to look a certain way. So the whole people change, and especially management, going through that change of reimagining, and I heard some texture of it today, so I was very glad to hear that. So enterprise ready, data ready, and people ready is how we need to think about it. At least globally, we have seen a few banks making this really a board level agenda. So for example, to the point that Ramesh was talking about, the Gen AI based platform, seen at least a couple of banks make that investment upfront in terms of upgrading their data and AI platform landscape per se, building in a separate responsible AI layer, because without that, you'll not be able to move ahead only. So those are the three parts. To your second question around, big banks or other one, I think that's I don't know how that will play out, but there's an argument on both sides. So yes, we know tech is, very prone to scale economics, right? So definitely big banks have an edge. But then Gen AI is also a great leveler. It is not hard to imagine a 5-member great engineering team can actually put together out a great mobile app or a great digital lending experience fairly quickly. So there's going to be that dynamic. I think it will come down to the bold vision that the CEOs or the chief tech officers, transformation officers are able to drive to really make that shift.
One interesting anecdote I wanted to share, because it's kind of struck me when it's talking about change, cultural change thing, right? In fact, this is in our organization, when I did a kind of a presentation on Gen AI and to get all our senior management into the room. It wasn't easy, because it was a very difficult topic, because I had to kind of go through some of the fundamentals. And I think the only way I could kind of motivate, actually I sent out a mail saying, look, to some of them saying, imagine if you were to answer your kids, what would you do? Because, the generational shift has happened in a very, I don't think we've understood it. A lot of our generation hasn't understood the power of this, but a lot of the young generation, you ask anybody in the room who's got a 20-year son, daughter, they will tell you what Gen AI can do much better than what we can think about. So I think there's a lot of cultural angle to what he said. I just thought I'll kind of
I'll just add one point to what Pranav said, right? I think all the points he made makes a lot of sense. I think one thing we are underestimating is the power of the ecosystem. See, if you look at even digitization was not done, or adoption was not driven by only the banks and their internal tech teams. It was also driven by the wider ecosystem which was created with the fintechs or with the tech providers, etc., etc. So what we're already seeing is, while the popular LLM models are coming from Google stack or the OpenAI stack, but there are many startups and fintechs who are actually building layers on top of it for specific use cases, which basically means that the tech team of the banks need not put that kind of tech strength behind it, so that even the small banks can actually do it. But what becomes critical is two things. Like I said, the data should be available. If data itself is not available, then no fintech can help you. And secondly, the cultural change which he mentions becomes critical.
Milind, where are you hiring from? Where do you get your AI resources from? Do you see smaller companies, startups? as the resource base for you?
Actually, I was going to completely disagree with what Vipin just said about banks not having to have absolute top tier tech talent and engineers who will understand software 2.0 deeply, not superficially, because technology is very complex today. I think it's going to be very hard, and Ramesh and I talk about it often. It is going to be very hard for any bank, big or small, to simply treat IT as something that can be outsourced to some vendors and imagine that things will work just fine. Some of the nuances we spoke about in terms of how things are changing. Our biggest investment is in tech talent right now, and our tech talent comes from tech companies, from the FANG companies, principal engineers, distinguished engineers from reputed financial institutions, from fintech companies. So those are our sources, and we are investing deeply and heavily in that.
Just to add to that, I think it's not just about AI engineers. I think Pranav brought that point out. So the biggest challenge for any organization is going to be the data challenge. Because frankly, that's where the struggle is. It's, while I think we will be able to get some of the talents, I'm sure the larger banks, and even the smaller banks and smaller company arguments can be balanced out. But what cannot be balanced out is poor data quality. Okay, there is no panacea to solve that problem. I mean, and especially why I'm saying this, because banks would not be open AI driven, especially regulated entities, because they will need to train on their own data. They need to be very specialized. Yes, they can overlay it with some of the algorithms on the open AI side, but you have to get your data right. So I think while we are talking about AI and the benefits, and a lot of that will percolate into consumer space, into day-to-day space. But the banking side, I think there's a lot of work that needs to be done on the data organization side. And I'm sure I'll love to understand other panelists' views, but I do find that as a very...
But don't banks have years and years of data already?
Doesn't matter. They have years of your data, but look at what banks have done. They've all been traditional data warehouse guys. Okay, in today's world, the data has exploded. Okay, and the kind of data that we are seeing is very different from the data that we saw. Most of the banks, I can bet my life, 95% of the banks have still not figured out how to move to a larger kind of a construct of data lake. And not that I'm saying data lake is better, but the fact is that today you need compute powers to do transformations at scale, organize the data, because the size has gone up. It's not because we are big or small, but simply because the size of the data has gone up. So that is the challenge. So if you don't get that part of your organization construct right, or the tech construct right, you can do whatever AI you want to do. It's not going to work.
And it's a slightly nuanced topic, if I could give some more color. And those are the choices that folks like Ramesh and I in our roles have to. These are complex and difficult choices. Speaking of data quality, soon after ChatGPT came out, Bloomberg GPT, was a concept that came about where they did not use the model, ChatGPT model that was trained on the internet data. They took a basic model and they trained it with Bloomberg data, which was highly organized, good data quality, structured. But just 2 days back, and it was highly spoken about, big success. But just 2 days back, there was a study which compared Bloomberg GPT with ChatGPT, which has been trained on open data, open internet, but with what we call RAG augmentation, where it was augmented with an additional database of structured data, and that open model performed much better than the Bloomberg model, Bloomberg GPT, on financial questions. So now the dilemma that Ramesh and we have to make the decisions on a day-to-day basis is, one is a model that is highly specifically trained on very specific data that is structured. We are sure of the data quality, and it has a certain model output score. And here there is maybe a competitor decides to use the open model, takes the risk there, augment it with some of your own data. That is, a Wild West approach to some extent. It is risky, but from a consumer perspective, it could have better outcomes. but then we have to have the right guardrails in place, and therefore putting it all together, I think therefore also having the right talent who can make some of these
and just to add to that, I don't know if it's following the industry, like I said, the other part that I'm fascinated about is this thing called vector DB. There's an element called vector DB, which kind of allows you to segregate the public and the private LLMs actually. And that itself has rapidly evolved. Nobody heard about this maybe about a year back, right? I mean, today it's an industry by itself. Okay, there's a lot of work that's being done in that area, and that's why it comes back to the AI architecture. You have to get the AI architecture right to facilitate all kinds of cases, and that's not going to be easy.
Mr. Bhasin, what are some of the regulatory challenges that you foresee as you sort of progress towards Gen AI? Ramesh did touch upon it for a bit, but if you could just explain that a little better for the audience.
See, I think maximum challenges with the AI is the, over a period of time, how the biases get developed by its own modeling. And that is a key challenge. Normally, you have to be like treating fairly and equitably to all the customers, and that is where I think one of the responsive way of handling any customer services aspect or any journeys or use cases which we are working on. I think how to keep correcting that model, keep analyzing the model, and that's where somewhere you ask the question that what if the Gen AI comes, it takes away the various job opportunities. I think there will be the lateral job opportunities will be opening up to correct the behavior of the Gen AI, and that will open up much more opportunity.
Yeah, I asked that because this is possibly the first time white-collar employees are worried, because previous technology transitions have always attacked the blue-collar worker, right? The manufacturing floor. This is the first time people who do cognitive work are worried.
Right. So I think there will be still the human intelligence will be required. It may be the case that in a very lateral way of thinkers or creative thinkers may be required. You don't need to be necessarily knowing the sophisticated, the AI frameworks or technology how to enable those behavior using the technology. So that I think this Gen AI frameworks will augment that piece, but still how the process should be keep corrected all the time. So those creative thinking will only come from the human.
Got it.
A lighter note, humankind finds a way to be busier. I mean, that is the way it is, because it will create new jobs, it will create new skills. I think that is not seen, that's not visible, and that's why we are worried about it.
Right. I'll stop here and check if the audience has some questions. Can you raise your hands, identify yourself and your organization? The gentleman, the middle, yeah. I'll come to you, sir.
Yeah, this is Vijayanan from Lyra Network. Being offline will be peaceful, I read somewhere. But with all the AIs and everything coming up, okay, what could be the way forward for people who are in mid-age? We are not 20 and we are not 60. So what would be the way forward? Thank you.
Maybe I'll take that actually, because I kind of alluded to that question. I think you'll have to learn. I don't think learning is going to stop. There is no age to learning now. I think that's a given. I think a lot of us have to come to this new reality, because I find it very funny that people kind of say, oh, I will retire at 60. In today's day and age, if you think about it, and if you're a busy, fully kind of empowered professional, there is no thing that I will go and not do anything. So I think we have to kind of recalibrate ourselves. We have to, and I think Udemy and other tools are as good for us as for some of the other our kids, right? I mean, we keep telling them read books, do this, do that. We've done all of. Tomorrow's life is going to be. They are going to tell you, please go and pick up this course from Udemy and learn, and then come and talk to me. So I think it's a constant way of reinforcing to oneself to learn, I think. So that's probably the only answer I can give you.
So the age of lifelong learning.
So if I'm add one more perspective, see, I think AI is also very, very liberating, right? In the sense it gives you new capabilities and superpowers that you never imagined you had. You can today, for example, become a amazing, singer and creator. You could write lyrics with one thing, go to suno.ai, create a, song, become a content creator. So AI also is giving us superpowers. And, for people in 40s or, whatever, midlife crisis in a way, it can be very liberating also. So yes, the imperative to learn remains, but it can be very liberating. It doesn't only have to be about your own job.
And I think just one point, right? I think he's talking about adding new jobs itself. But if you look at it, instead of seeing it as a threat, if you see it as a enablement for you, what it does is basically shifting your job from menial work, which is more manual work, to actually doing value-adding work. So you actually become more intelligent, and you do actually work which actually adds value to the organization, rather than actually maybe transcribing a document or summarizing a document, etc. So I think it should be seen as a positive that you are actually shifting your job profile from something which is very menial to something much better in that sense.
Okay, we'll take one last question from the gentleman here before we wrap up. Mike?
Thank you. I'm Sunil Mehta. Okay, most of the bankers are over here. When I'm using ChatGPT, over there I'm if I just put a question of just giving different banking products, what answer we get is basically somewhat traditional sort of answer. Like if HDFC Bank is having, say, 50 products on the asset side, like maybe on loan for the client and all those things. But if you really go through that, so what I feel that even at this level, AI is at a very elementary level. Maybe this is a powerful tool which people may not have seen, so that's you're praising more. But probably we don't get most of the answer in financial services sector.
No, that's because, that's a good question, because like I said, most of our models are open. And look at what the data it's picked. You go to ChatGPT, it would have picked up HDFC Bank website, and that website is drab. I mean, to be honest, it's got 30 different products in this way and that way, and it's kind of giving the answer. Any other bank, right? That's why I think you will have to start looking, let's say, what will be the future of a website for a bank. It has to start from, product construct, the manuals that you have, the product knowledge that you have inside, build it up, grounds up, make it as a knowledge-based model, and then expose it outside. See, today and that's why I said the data sitting inside has not come out. You're only allowing the data that's available. That's a challenge for a lot of banks as they go along, because how much data they want to put out in the open, how much they can train on the existing model, and how they refine the model. That was the discussion that we had actually. That will determine how we do it.
So when we can expect bank like HDFC Bank to put data more on their website, so we can integrate with ChatGPT?
So you will see that, like as I said, for example, I spoke about statements, right? I think you will see something coming out very soon from us where you could just go and ask, where did I go on this day? Tell me how much of shopping I did at this particular place. Tell me, what's my total of deposits, So those kind of things you will start seeing quite soon. There are certain conditions, like I said, data localization comes into play, because there's still the compute power that you need for AI, the GPUs and all. Putting them on-prem and scaling it up is a challenge. So we have to be very careful in terms of how we use a cloud construct to build our models. So there are challenges to adopt it. It's not like, okay, ChatGPT come, just pull it and put it inside and it will work. But I do see whether our bank or any other bank, I think, give us about 9 to 12 months, you will start seeing very interesting things coming.
We need more data centers in India within the borders. I think that's the bottom line. Gentlemen, thank you so much. Time's up. And it's been a cool discussion, right? Great.
Super cool. Let's give a huge round of applause to our power panel. And Gautam, I'm going to request you on behalf of all of us to kindly present a token of our gratitude to our super cool panelists. Thank you so much for sharing some incredible insights and also for giving us a lot of food for thought. Gentlemen, please come together for a group photograph. Let's capture this moment. And for all of us, I'm going to request you to stay glued to your seats because the up-and-coming panel is one you do not want to miss. Thank you once again, sirs. MFDs now find themselves at a juncture where commissions have plateaued, leading to stagnation in their numbers at around 1 lakh. Simultaneously, the torchbearers of financial advice, the RIAs, are grappling with their own set of challenges and also facing a similar stagnation. To add to a twist to the plot, platforms like navigational tools find themselves incentivized to guide investors towards broking rather than the scenic route of mutual funds. As we stand in the midst of this financial crossroads, we are confronted with a very critical question, which is, what is the road ahead for mutual funds, MFDs, banks, RIAs, or the platforms that shape our collective and individual financial journey? To answer all of these questions and much more, it is my absolute pleasure to invite on stage our next panel, ladies and gentlemen. And I'm going to wait for just a couple of seconds for my team to turn the stage around. We're almost there. And I expect nothing but a thunderous round of applause. First up, we have our moderator for this discussion, Ms. Radhika Gupta, Managing Director and CEO, Edelweiss Mutual Fund. Our speakers for this conversation, Mr. Amit Bivalkar, Founder and Director, CPN FinServ, Mr. Rajiv Thakkar, CIO, PPFAS AMC, Mr. Vishal Jain, CEO, Zerodha AMC, and Mr. Vivek Banka, Co-Founder, Goldteller. Thank you so much for joining us here. And Radhika, over to you.
Have you guys figured out your places? Yes, there we go. All right, the last panel claimed they were super cool. Let's move from super cool to ultra cool. Very excited to do this panel. I don't think I agree with everything in the introduction. But Mint team, thank you. I think I've been speaking at your conferences for so many times that you decided to throw me off the panel and make me a moderator. And I'm actually very excited to have this discussion. Gentlemen, I would warn you, I'm quite a sharky moderator, so pun not intended. But I think the title is Financial Wellness in Changing Times. And one of the interesting things about this panel is that it does represent a bunch of people who are upstarts in some way. Amit, of course, is a trailblazing MFD who has not built out of a traditional city like Mumbai or Delhi. Rajiv and I both represent AMCs that don't come from large brands and have at least grown to some size. Vivek represents a new age platform, and Vishal also represents a new AMC. So we are all in that sense representative of a changing world. I want to start by exploring this space of market expansion, because I remember when I joined the MF industry 5-6 years ago, the constant narrative was there are 5-7 major asset management players, there's going to be tremendous consolidation at the top, and there's no hope for anyone else. And you know, Vishal, you're the new guy in the pack. 2 questions. How easy or difficult do you think the journey will be? And one of the narratives that is very popular among newer AMCs, especially that come from a distribution background, is, you know, we have a set of customers, they could be lending customers, they could be broking customers, etc. We now have something else to offer these customers. Do you think that cross-sell story will work?
So I think we're at the tip of the iceberg. I think at this point of time, you know that penetration is limited. We have to figure out, how we can get more and more people to start investing in mutual funds. I think it's already happening. Last 30 years, we've got about 4 crore investors coming into the market. We need to get many more people, to start investing in these products. And our belief is that until you don't kind of simplify the products, you will not find scale up happening, across the industry. And that's what we are trying to aim and trying to kind of solve and look at. And that's something that we are spending a lot of time with. I think the market is there. I think it's a matter of creating the right kind of journey for the investor who's going to be coming in the next 5, in the next 10 years, and building the right kind of journey for him. Until you don't understand what is the journey that he requires, you will not be able to catch, his bandwidth and getting him to start, investing in mutual fund products. So I think it's basically, keeping in mind that there are, new age people in the market, there are a new segment of people in the market. It's important for you to create products and journeys for them that is relevant, and that is what will lead to scale up happening as we go ahead. So I'm pretty excited about the market in that sense.
I think you sidestepped my cross-sell question, but anyway, I will forgive you and come to Rajiv.
No, regarding the cross-sell, I mean, our objective is not to, use just our investor base to sell, but to see how we can get more and more people to start investing in the products.
Okay, got it. So Rajiv, let me come to you. I think, if you look at 30 years ago, there were perhaps 1 or 2 dominant styles of investing that were at least marketed. Value manager hai, growth manager hai, etc. And one of the exciting things that I see happening as more asset managers come to market is that you will really see a variety of investment styles and products come to market. What are the goods and bads of this, and what do you think investors should look out for?
So I think the bad part is if people get sucked into something which is very, very ephemeral, which will last maybe 3 months, 6 months, or a year or 2. So let's say late 90s there was this eyeball related valuations, or in 2007 we had the style of investing in land banks. So I'm all for innovation, I'm all for a variety of styles, but those styles should not leave a bad taste in mouth for investors, because once they go away, it's very difficult to bring back those investors. So to that extent, us as an industry, we have to self-regulate, and regulator also has a hawk's eye as to what is offered to products. I am slightly skeptical on the innovation part, given that now we have very, very well-defined categories, especially in the mutual fund architecture. Maybe in PMS or AIF, you have more scope to innovate. But today, one offer document looks very much like the other offer document from a fund house, because there is very, very limited variety that you can offer these days in the mutual fund architecture.
And there may be an argument that there is not even a need for more innovation, but we'll come to that. So, Amit, let me pose a trickier question to you. We went from 40 to 50 AMCs. I think India may have 70 AMCs. Why don't we see that kind of frenetic activity in the number of new ARNs and distributors coming to the country? Because I don't know if India will grow without distribution.
I think I'll just answer it with one thing. Last 13 months, we have seen the industry grow from 40 lakh crores to 50 lakh crores. Have you seen the distributors grow in the same percentile? The answer is no. If I am a MFD, have I grown 27% in the last 12 months? Answer is no. I might have seen as an industry that 10 lakh crores came mostly from mark to market, came from new age fintech companies, came from the direct RIA plans, and very limited number on net sales came from MFDs. Point number one is that. Second is, I think life's barely long enough to get good thing and to be one good thing what you want to become. So many people are trying a lot of stuff within distribution. So I think the focus somewhere, I mean, Bill Gates and Warren Buffett, when they met first, both of them were asked, what is the one factor for your success? And both of them said focus. I think that focus is not there in distribution. We are trying to do many other things. We are more worried about how fintech will, upset my Apple cart. I think in India, up to a certain size, people don't mind going to fintechs. But if you have a portfolio of 50 lakhs, 1 crore and above, you need to probably give galis to the RM who have not performed. So you need a person there, you need a face to the name. Why people are not coming here is because if I do a parallel between investments and insurance, I think the commissions there are much higher. B, in the last 3 years, you have seen upfront income in stock broking much more than a trail income in mutual funds. So people who are saying that अरे daily इतना आता है, ये तो साल भर में 5 पैसा आएगा liquid fund में, who's wanting to wait for that? Instant gratification over delayed gratification, that is a problem in distribution. Third, lot of changes in regulation over period of time tells you that I have just set up my model and I want to change it again. So if you look at all of these factors, the growth in the last year, you remember we went from 10 lakh to 50 lakh in 9 years, and we went from 40 lakh to 50 lakh in 1 year. Earlier legacy AUM has grown. I don't see the net sales going up. If you take the industry as well, if you deduct the SIP numbers, I think the net sales are pathetic. So nobody wants to work because trail has made you lazy. And that's why distribution is not growing and people are not coming here.
You know, in insurance, I'm on the board of our life insurance company, they calculate the lifetime value of an insurance policy because, of course, a lot of amount is paying up front. I think someone should calculate the lifetime value of an SIP. But to your point, I think we are in a world where 5 seconds is also too much on a YouTube ad, so instant gratification is important. Since you mentioned online so many times, let me come to Vivek. And I'll ask you the counter question. So I think there is wide recognition that online platforms have done a fantastic job in increasing the reach of the industry, particularly post-COVID, bringing a lot of people into the industry. Let me ask you a question and then I'll get other views here. Have they got it right in terms of the way they are selling to customers, the longevity of those customers, and the kind of funds those customers are coming into?
So, if you see the last couple of years, most of the funds have given extraordinary returns. So the individuals that we speak to...
You might need to pull your mic up.
Yeah. So the individuals that we speak to really don't bother about the fact that whether a fund is underperforming, outperforming. The absolute returns they've made is significantly good. You know, average portfolios are 25-30% up for the last couple of years odd. And most of these platforms that have actually deepened the reach are platforms like Grow, maybe Kuvera. Most of them are on the direct order of things. The problem in this model is that the investor is not getting advice. So we get customer portfolios on a daily basis and we see them peppered with 10, 15, 20 funds, which I personally feel is an overkill in terms of what a user should need. And in fact, the latest trend over the last 6-12 months is that a lot of these platforms, I don't know which platform, but they're selling a lot of thematic funds like maybe the PSU story, the EV story, and all of these things. And I think that is extremely dangerous. When the tide will recede, I think these platforms will have a hard time in explaining to their users why these funds were sold. And lastly, a lot of funds with very high volatilities are getting sold based on past returns. Funds with algo trading, etc. I think we need a 6-month period of depression where, you know, the truth comes out.
He's calling for a 6-month market crash. Wow. Okay. Amit, do you agree with him? You are in the non-online world. Do you think it's known that they've done a good job of customer acquisition? Do you think they've done acquisition the right way? And I don't have a view, so I'm asking you.
No, I think they have definitely gone and penetrated the market and brought new customers. And MFDs should be happy because of such platforms, you get new customers. Because after a certain point of time, they will graduate and come to advisors. So it's a very good way of replicating the transactional ease when it comes to platforms. But when you have to graduate beyond the transaction, then obviously you will need somebody where you go and discuss your portfolios. So a pure transaction-based online platform will take away all the rigmaroles of execution. But I think going beyond that, you will not look at how to do a knee surgery on Google, right? You will still need to
Hopefully.
go to a doctor, yeah. And that robotic can stop, the drones can fall, everything can happen. Does it mean that the MFDs have done the right job all throughout? I think the answer is no. For me, it's clearly that if you look at the Squid Game series on Netflix, there were 456 participants and they were trying to get ahead of each other, and the one guy will get $45.6 billion. What is more important is, in India, only a click model will not work, neither a brick model will work. If you have the manpower and the wisdom of MFDs, and if you have the technology of the online players, and if they form a JV, I think that can be one model which is going to work for India as a country. So it cannot be either or, it has to be with. And an online platform with the RM lineage of the offline MFD, I think that can create a very successful one.
You're hinting at a JV between Sapient's new entity and an online platform, but that's for the news guys to pick up. Okay, Rajiv, I'm going to come to a question that has bothered me a lot in the industry, and I think if there is one most useless and damaging data point, it is the last 1 year performance. All of us know that when a fund does exceptionally well for 1 year, we get a gush of money, performance is mean reverting. I think one of the things I really admire in your journey as PPAFS is that you've tried to build a little bit of a Teflon coating around this. But can you speak from the learnings of your own journey as to how we get investors to actually stay invested, talk a little more decadal, and get rid of this 1 year menace? And I think it's, by the way, gone from 1 year to 1 month.
Absolutely. Unfortunately, Radhika, I don't have a magic bullet or I don't have a clear answer. And this transcends any of the vehicles used, whether it's MFDs, whether it's a online platform, whether it's a RIA. So in late 90s, there was no direct plan, there were no platforms.
This still happened.
Still the industry launched the tech funds. People invested there, lost money. 2007, we launched real estate funds, commodity funds. People invested massively there, lost money. So there's no clear answer. Some of the portals put out the most popular funds bought and sold on a weekly basis. Today, you see most of the small cap names over there because they have given a 12-month return. I think to some extent, it's a tuition fee that newbies pay to the market. There is a clear segmentation. So speaking for ourselves, within our client base, we are not in the middle. At one end, we have investors who have an average holding period far higher than the market average. And at the other end, you have people who look at past 12-month returns and come and go.
And even you have those guys.
We also have those guys, unfortunately, yes. So no amount of communication seems to be solving that problem, but I think we make all the attempts possible. We try and shift conversations to rolling returns, to long-term wealth creation. We clearly try and communicate that 1 year return can probably 1/3 of the time will be negative rather than beating even the bank FDs. So we try and communicate as much as we can, but there is a segment of people who will come for the short term. The only saving grace, Radhika, there is, I'm happy they are at least coming to mutual funds rather than writing options in the F&O market. So
or buying crypto or doing online gaming.
Yeah.
I mean, it's the least of the evils.
Just to add to what Rajiv sir said, कि लाभ और लोभ इसमें एक ही मात्रे का फर्क रहता है.
Correct.
So लाभ और लोभ में वो 12 महीना और 5 साल. That is
correct. And I'm telling you, it's coming to 12 din. Okay. Let me come to Vishal and come to your favorite topic about passive funds. And ask you a little bit of a contra question. So you said the industry has only 4 crore investors. We have 12 crore crypto users, equivalent more online gaming users, 40 crore people who subscribe to Netflix, equivalent amount of food delivery platforms. And there is a lot of media that focuses on regular versus direct, active versus passive, etc., etc. Do you think we are trying to divide the pie too early rather than focus on expanding the pie?
I think so. The market is still very nascent. I mean,
Then why debate active versus passive?
I don't know why people debate active versus passive, because at the end of the day, the investor doesn't understand it beyond a point unless he's a very evolved investor. I think we have to change our narrative, move towards the fact that, look, today if there are, last numbers that I got were 57 crore people who've linked their Aadhaars with their PAN cards, right? So a huge number of people out there who we have to reach out to. And I think that's what the focus should be. So whether it's MFD, whether it's RIA, whether it's online platforms, I think all of us should be out there, contributing towards the financial inclusion bit, and stop worrying about whether it's active, passive. As Zerodha AMC, I mean, we have chosen the passive path because we just find it that much more easier to talk to an investor, and is that much of a more scalable product than an active product. That's the only reason why we've chosen passive as our way to reach out to more and more people.
So I want to come to the last bit in the 10 minutes we have left, which is focusing on the businesses we run, whether RIA, MFD or AMCs, and them as businesses, because a lot of the criticism around new age businesses post 2021 is we are acquiring users, we are building top line, but the reality of life is bottom line. And how do you really build profitable long-term institutions in this environment? And Amit, I want to start with you and then come to Vivek and then Vishal. You started out of Pune, and one of the challenges with people coming into the MFD business is it takes years to build a book. How do you build a profitable MFD business?
I think rule of 52 is what has helped us. And what is rule of 52? Is when your kid will get married and when you will first think of who to invite for his wedding, you will probably think of 52 names. And everybody can go home and do this homework, that you can remember 52 names whom you want to invite for a function at your house. So we three, me, Janak, Rahul, we sat down and we wrote our 52 names whom we wanted to contact. And every of those 52 will have their own 52. So we started with local, we started with hyper local, then we went local, and probably then we went to corporates and then to family offices. Initial 3.5 years, when you start a MFD business, you should focus on breaking even, and that time generally what it takes to break even in a MFD business is between 30 months to 42 months. When I left my job in an asset management company and started the distribution, it took me exact 30 months to take home the salary what I was drawing 2.5 years ago. And that time upfront was just banned, and then I started the company. 10,000 rupee SIP at 12% with 1% brokerage gets you 5,000 rupees in 10 years. If you're willing to wait for that long to make money, then you should be here. Everybody is saying we should start retail. The cost of acquisition in retail is not what a MFD should actually look at. So you should have a healthy mix of high net worths, should have a healthy mix of retail, which is a large SIP. For me, a 1 lakh rupee SIP is retail, not a 5,000 rupee SIP. Industry is going, Radhika, the other way with doing 100 rupee SIPs.
Correct.
Neither the AMCs are going to earn anything, neither the distributor.
Yeah, because we'll pay more in costs.
Correct. So the acquisition cost is higher, and online platforms, I have seen myself, we are getting 700, 800 rupees as a acquisition cost on online. So to build a proper MFD, profitable MFD business, I think it takes minimum 3 years to break even. And from there on, it will take another 3 to 5 years to actually get handsome returns on your capital deployed. We don't require money to run the setup, but you should have a team. And I have an acronym for that. We call it the torch bearers. And torch stands for technology, operation, research, customer service, and human resource. So you need to spend your money there. If you spend the right money on torch, you will probably have a good way ahead.
Thank you. Now, Vivek, can I come to you? Because, of course, online platforms have been asked this question even more than offline platforms. You've also seen Sebi recently introduce EOP 1 and EOP 2 guidelines. RIA has had its own challenge as far as monetization in terms of clients paying fees. How do you see someone building a sustainable, profitable, online-driven, technology-driven business?
I have some very radical views on this subject. I think over the next 5-10 years, the way I foresee the landscape is that there'll be two large entities that will exist. One is the manufacturers and second is the online people. I think even the MFDs or the guys who are offline will either hop on to people like, guys who give software as a service, etc. In terms of the unit economics right now, clearly it doesn't work out for anyone. I don't think anybody, the customer acquisition costs are upwards of 5,000 to 7,000 rupees per user. And that's extremely bleeding for everybody. And this is across the board. I don't think anyone is devoid of this fact. The only thing which I think in the next 3-5 years will actually change this whole paradigm is the evolution of regulations. I think the account aggregator regulation is a big step towards that front because, as they say in software, garbage in, garbage out. So today the problem with tech platforms is that they are largely execution platforms. Advisory platforms on the tech side are practically zero right now and not domestically, globally. And the problem with this is, even we face this, is the fact that we don't have proper data of the user to give them proper advice on. And I think this will change with the account aggregator coming in. Already we've got mutual funds, we've got insurances, banks, everything live on this. Of course, it's not extremely seamless right now, but I hope over the next 12-15 months that will happen. So this information or data that we get, this will help a lot of us scale and actually get value-add payments from the user. I think this is what will change. Plus, I think there will be consolidation in the industry. Once we see a small period of depression, I think there will be a large consolidation, which we have seen in all cycles.
Okay, Vishal, let me come to you. Lots of talk about building AMC businesses, and it's not just in the context of Zerodha, but with increased competition, higher customer acquisition costs, and of course, declining margins because of regulatory pressure. How do you build an AMC business that is profitable if you're starting today and you don't have the benefit of a back book from 1990?
Difficult question, Radhika, and I think you guys are far more experienced at this than I am. But I think one of the positives that we had was that, we started the AMC from scratch. And I think one of the things that, gave me confidence was the fact that we were very clear in what we wanted to do. So we said that we will do passive, we'll do retail, and we'll be direct, right? And when you know that philosophically, these are the three things that you want to do, you build the organization accordingly. Now, if I say that I want to do a passive product, but I have a high cost structure internally, it's not going to work. At some point of time, that's going to come and bite me in terms of profitability. So I think we've been lucky in that sense. At this point of time, it's very early to say, but I think philosophically, because of the fact that we know what we want to do and where we want to do, where we want to be in the next couple of years, we've built the organization accordingly. I hope, as we move ahead, that plays out, and maybe in a year, maybe in 2 or 3 years, I'll be able to come back, and tell you a little more about our experience on that.
Yeah, someone told me break even for an AMC business today. Amit, you said 3 years for distribution. I've heard it's 8 years for asset management and 15 years for insurance. But let me come to Rajiv. I know we are running short.
Can I just add on what he said is, whether you are an asset manager or a distributor or a RIA, there are 3 things, and out of that you can only choose 2. Those 3 things are good, fast, and cheap.
Yeah.
So if it is good and fast, it won't be cheap. If it is good and cheap, it will not come fast. His returns come in the long term. And if it is fast and cheap, definitely it will not be good.
Correct.
So as an asset manager or as a MFD or a RIA, this is what we should think, that whether I want good and fast, then it will come at a cost. It cannot come cheap.
So Rajiv, I want you to look at this now as a CIO. And asset management businesses are listing on the stock exchanges, wealth businesses are listing on the stock exchanges. And I know how you think about companies and how you think about value. But what is your advice to any new player in this space, asset management, online, MFD? about building a business that meets the parameters that finally someone like you will invest in? Because I think that is the gold standard.
So I have some positive news to share here.
Very good.
Unlike the brokerage business where everyone is virtually moving to that 20 rupee per trade or zero delivery, here pricing is not the only thing that matters. There are a lot of things that go beyond pricing, both on the advice side and on the asset management side. So I was looking at some of the financials of traditional brokers, very reputed names who have been around for decades. They are barely breaking even today with with all this disruption that has happened with the discount brokers coming in and banks getting into it. These are generational brokers and who's who of the Lal Street. That is not the case with asset managers. New asset managers running a AIF, running a PMS, running a mutual fund, raising 1,000 crores, 1,500 crores, run a very profitable operation. Trail commissions are still there in the distribution business. I think he put it beautifully. You have to focus on the non-fast aspects. You have to do it slowly. That's the only way to build a sustainable profession. You can't be in a hurry to achieve scale. If you give that initial 3 years, 5 years, I think things work out as long as it's a product or a service which is good for the client.
Thank you.
Yes,
go ahead.
One thing, I think most people in this business were coming in the online side. I think the basic premise is sooner or later they can cross-sell higher earning products. And by higher earning products, largely it's insurance.
Yeah.
Right now, I don't think there is any other product which is so lucrative in terms of unit economics. And I believe that the regulator has come out with a direct quote option on insurance also. So I think it's a matter of time that will also get addressed and sorted out. So I think coming in to just look at cross-selling and make a business out of it, I think that is very, very dangerous.
That's a very tricky thing. So Neil, by the way, we do have 5 more minutes. So I can't let you go without doing something that I really like to. I have this fascination with coffee with Karan. So I've got this equivalent. It's called Rum with Radhika. Sorry, Hindustan Times, I know it's evening. So I'm going to ask you some rapid fire questions. Neil promises to give the person who's the best here a really nice hamper of Edelweiss mutual fund units, a very good gift. So let me just start. You've got to be rapid, you've got to have fire. I think I'm going to start with you, Vishal, because I like ragging a new AMC CEO. So let's just start with you. Okay, so Vishal, your rapid fire starts now. Give me a 30-second pitch for active management. Come on.
Sorry.
Okay. Hashtag epic fail. Okay. Question 2. How much of your portfolio is into passive funds?
100%.
Okay, that was easy. The best passive product to come out in the MF industry in India in the last 5 years?
I mean, I still like a top 100 fund.
Okay,
top
100 fund. The MF industry AUM split between active and passive by 2030.
By 2030?
Yeah.
Probably about 40% passive, 60% active.
Wow, active still wins. And last question, if I made you Sebi chief for a day, what is one change in regulation you would bring out?
Make it simpler for investors to invest.
Okay, what's simple? Simple बहुत बोल रहे हो, simple ही बोलो.
I mean,
Okay, I'll take your answer. I am still waiting for the pitch on active funds. Okay, Vivek, over to you. Okay, a fintech in India that you admire?
I think grow.
Grow? Okay, that's a nice one. If you look at MF equity AUM, what do you think the fintech share will be by 2030?
I think it should be 80%.
80%?
Yeah.
Wow. Okay. A 30-second pitch on why one should use an MFD like Amit Birwalkar to invest in mutual funds.
Well, I don't know. But I think largely it is because of relationships. I think most distributors that are coming into the market recently also purely are ones who have friends and family and do not want to lose out on the opportunity of making commercials from them. Of course, there are very few like Amit who might actually be imparting advice, but that also because of the Sebi regulations is very difficult right now. So I would still go with the RIA, which we are, with that bias.
You also twisted my question.
Better off than MFD.
Not applicable. Okay. I'm going to come to your fourth question. So you've got to react to the following big topics in the fintech world in just one or two words. UPI.
Game changer.
Geo.
Hopefully a future game changer.
Crypto.
Avoidable.
Avoidable. And again, if I made you Sebi chief for a day, what is one change you would want to make?
I think I would make most of the banks and financial institutions more tech empowered. Right now, a lot of the regulations are not able to come in properly because their tech is not able to keep pace.
Okay. Now, Rajiv, over to you. Okay. Use a Hindi film song to describe your investing style. You can sing it if you want.
It'll take a while. I can't think of any.
Idhar chala. No, that is not him. Okay, let's do the next one. A 30-second pitch for passive investing.
Passive funds will generate the average returns of active funds. That's mathematics. And they have lower TER. So mathematically they win.
Well done. Very well done. Vishal Jain, please note. An Indian investor you admire.
Sanjay Bakshi.
Sanjay Bakshi, I love him too. One word to describe a few investing things. I'll just give you some names. Momentum-driven investing.
Statistically works.
Statistically works. Growth at reasonable price.
Works.
Works. Charlie Munger.
Rational.
Rakesh Jhunjhunwala.
One of the greats, OGs.
OG. And last one again, if I made you Sebi chief for a day, what is one thing you would do?
Moratorium on issuing new circulars for 3 years.
Oh. Oh. I think Rajiv is winning that hamper, but Amit, I'll just give you a shot, okay? So, one word to describe the following few things as they stand today. Asset management companies.
Partners.
Partners, lovely. RTAs.
RTAs need to improve.
Finfluencers.
Influencers, good way to earn money.
Good way to earn money, not bad. The best product to come out of the MF industry in the last 5 years from a client usefulness point.
Multi-asset.
Multi-asset. Okay. India has about 1 lakh registered ARN holders today. What do you think this number is going to be by 2030?
2030?
Yeah.
I think should be 5 lakhs.
It should be 5 lakhs. Again, go to 2030. What do you think the split of regular versus direct AUM is going to be? Equity.
Should be 70% direct.
70% direct? Wow.
Yes.
Okay. And the last same question. If you were a if I made you Sebi chief, what is one thing that you would do?
I am on leave today.
I'm on leave today. So with that, I think we wrap up the panel. I will not decide who the winner is because that is too dangerous. I will leave it to Neil. But thank you all, gentlemen. You've been wonderful panelists.
And also, let's have a huge round of applause for Radhika. Radhika, thank you for asking the most pertinent questions on behalf of us all. I'd like to invite on stage Alokesh Bhattacharya, Deputy Managing Editor, Mint. Please join us to present a token of our gratitude to our uber cool panelists. Also, Neil, I'm going to invite you. You can quickly come to the stage. I know you have some thoughts to share. Hop on. Can we have the music pause, please? Yes, thank you.
So, Radhika, fantastic job moderating the panel. So, next few sessions, we're going to get you for moderator for sure. But moderators should get one question directed at them as well. If everyone can have a seat for 1 minute, it's a very interesting topic that we haven't yet covered, which is EOPs.
Yep.
So you were Amphi vice chairperson, and Amphi has set 2 rupees as the transaction fee per transaction for EOP category 1. So do you think this is sufficient to energize, to make it viable for EOPs?
I trust you to ask me a tricky question that is out of syllabus. I think it is sufficient at scale. That's the right answer. I think if you are building a business fresh today, it seems like a very small amount of money. But remember, and the gentleman on the panel said 70% direct, fintechs will own half the industry, all of that. I think if you're building at scale, it will be sufficient. And I think it is an answer that is correct. See, finally, this is a solution that has to be win-win-win for all, for asset management companies, for partners on platforms, and for investors. I think it's a solution that works for everybody, because remember, the per transaction costs of asset management are actually very expensive. Someone made the point, you can't do a 10 rupee, even if we do a 100 rupee SIP today, we lose money on it. And if you really want to sachet things down, as chairperson of Sebi has been talking about, this is perhaps the right way to go.
Right, and one final one, and this is open to everyone else on stage as well. Out of the 2 models that Sebi has outlined, EOP 1, where the AMCs pay the platform, EOP 2, where the platform can charge customers but offer allied services like RA, research or advice, which of the 2 do you see flourishing going ahead?
I think individuals will take a call. I think one model is exchange-driven AMCs, and some of the, I don't think people who are large will make substantial changes in their existing business model, and they will adapt. So if you have been working on an exchange-driven platform, like BFSI Star, you will use that. It is difficult for people to charge the customer, let me tell you. I think that is a well-accepted belief, that it's difficult to charge a fee to the customer.
No, it's not difficult to charge.
Charge an upfront fee.
Clients don't want to pay. It is very easy to charge.
I was saying it thoda sa more politely. It's difficult to charge and earn the fee.
Great. If no other thoughts, we can conclude. Thank you very much. Thank you, everyone.
Thank you, Neil. Thank you so much. Can we have a huge round of applause, ladies and gentlemen? Thank you, everyone. I'm going to request you to please come closer together for a group photograph. While the rest of us can stay glued to our seats, we're moving from one interesting panel to another. And don't forget to share your thoughts, your takeaways, the insights you've had today onto your social media platforms and use hashtag MintBFSI 2024. Ladies and gentlemen, in the realms of insurance, our regulator IRDAI has a grand vision, which is insurance for all by 2047. It's like promising a financial umbrella that not only shields every citizen's life, health, property, but it's not just only envisioning, but it's rather also making moves, creating digital platforms like Bima Sugam and Bima Satark. It's like bringing the insurance world into the digital age, one policy at a time. At the same time, insurance companies too are talking the digital talk. However, the unkind thing would say that they are talking too softly, they are moving too slowly, or, are they really making a real difference? What is the real picture? That is what we are going to find out in our next panel. The stage is almost set, and so are we. Please put your hands together as I invite on stage the moderator for this discussion, Aparajita Sharma, Assistant Editor, Mint, who will be joined by speakers Mr. Mahesh Balasubramaniam, Managing Director, Kotak Mahindra Life Insurance, Mr. Mahavir Chopra, Founder, Beshak.org, Mr. Prasoon Sikdar, Managing Director and CEO, Manipal Signa Health Insurance, Mr. Anush Dyagi, Joint Managing Director, HDFC Ergo General Insurance, and Mr. Karthi Purushottaman, Partner, McKinsey and Company. Insurance, the digitalization imperative. So looking forward to this panel. Aparajita, over to you.
Hi, good evening, everyone. So today, the topic of my panel discussion, Debashish Panda, IDA Chief, he has already set the context that insurance industry is taking a lot of digital initiatives to innovate in the industry. But what is the real picture? Are we seeing difference on ground? So based on feedback that I receive from my Mint readers and people, generally people around me, then they say, no, it's not the real picture. So today I have my esteemed panel here. Let's see, will they give convincing answers? Looking forward to hear some real thoughts on it, exactly what is happening on ground. So I'll begin with Mahesh. First of all, in life insurance, okay, a lot of digitization is happening, but very important issue when people have to surrender their policies. Okay, so they have to visit physical branches. So we talk about digitization, but if someone has to close a policy, then they have to go to a physical branch, and not just any branch, you have to go to your home branch. And people, NRI people, just imagine they are abroad, and for this purpose, they have to come back to India and take time out, and probably they may have taken the policy way back in smaller cities. Then what do? So your thoughts on it, why can't we have some digitization there?
Okay, first let's understand an insurance contract, then we'll understand surrender, and then we'll get to why things are the way they are, right? First and foremost, an insurance is a long-term contract where the customer normally signs up for a policy. We believe it should be at least for 10 years because life insurance is in the long-term business. We are not in the instant gratification business, right? So when a customer wants to surrender a policy, invariably it is bad both for the customer and for the insurance company. That's why all of us focus so much on persistency, right? That's a big initiative the industry keeps on improving, and I think the industry has definitely improved over the last few years. So when it comes to surrender, when a customer is coming to surrender a policy, we would like to understand why the customer is surrendering, right? Very often an attempt is made to retain the customer saying, look here, this is not good for you, because invariably when you surrender, right, you're not going to get the money that you would have got at the time of maturity or even for the amount of investment that you have made, right? So given that, surrender is normally something that we would like to talk to the customer, understand the reasons, try and persuade him to continue the policy because it is good for him first.
But that can happen digitally. And if
No, so I'm coming to that, right? So therefore, we would like to make sure that the conversation happens, right? And those conversations have moved digital in some way, right? It's not that everybody has to go to the same home branch to do it, right? You could hear explanations like that once in a while, right? But having said that, today, our important thing is to have the dialogue with the customer so that we are able to understand what is the reason for surrender. And believe you me, very many times we are able to tell the customer the reasons why he should continue, and the customer continues as well. So it's not that every surrender which comes in, the payout happens.
But sometimes genuine people with advice from their financial advisors, they know that they have to surrender it probably because they are not going to get as much money on maturity as they can through other financial products. So do you think that in a sense you are restricting people to surrender? They can very well surrender.
I'd say we are making efforts to make the customer continue the policy. I think that's a very positive way of looking at it, right? Because persistency is something which is good for the customer as well. Tell me, if you signed up for a 10-year contract, or you paid 5 premiums or 6 premiums, we would want the customer to continue so that he gets the full benefits of the policy he contracted for. It could be a child's education, it could be something else what he bought the policy for. So I think, having said that, I agree with you, I have to write balance between friction and positive friction and negative friction. That I completely buy your logic on why you're asking this question, right? Yeah. But our only intent is to have a conversation with the customer and make that effort to retain the customer.
All right. Now, coming to Prasoon, in health insurance, when people talking about claims experience, so in hospital they are admitted and doctor approves their discharge, and now they have to wait for 5-6 hours in the hospital, in some cases even more than that, to simply get in what insurance companies and hospitals, they are exchanging documents between them. This process also needs digitization. It's very important for policyholders. So what is happening on that front?
Yeah, so thank you for this question. So glad that you have actually asked me on the timing of the, customer going out of the hospital and not the claims being paid. Just to tell everybody that the health insurance industry has paid close to 90,000 crores of claims last year. During the COVID time, 30,000 crore of COVID claims have been paid by the same industry without asking for any help from anybody. And this 30,000 crore is estimated to be the next 5 years profitability of the entire general insurance industry and the health insurance industry. So I'm glad that at least the perception is not around that the insurance industry is not paying claims. There are evidences and data to provide that, the insurance industry is not only paying claims, but during COVID time, what was not accounted for, what was not priced for has also been paid. That's really the first point. The second point is really the question that you're asking, the time required for a customer to get out of the hospital. Now please understand that insurance industry, while it is regulated, the healthcare industry of the hospitals are not regulated, point number one. Point number two, there is no standard process as of today of actually, the payer provider language with different hospitals, with different insurance companies are different. So if the hospitals are not being able to accumulate all the bills together after the doctor has given a discharge, then obviously it takes time at the hospital end to even put the claim forward for the insurance company to adjudicate the claim. So really the issue, there may be some issues on the insurance industry side also, I'm not negating that thought, but larger issue is that how do we ensure that as a healthcare industry, which is really the hospitals and the insurance industry put together, how do we ensure that we actually have one common language between the payer and the provider? How can you digitize this entire claims adjudication process or even the claims settlement process? And to that, what is happening to the industry is that, some of you may know that there's something called NCHX, the National Health Claims, that has got formed. And all insurance companies, the TPAs, the hospitals are trying to do an API integration on this open source, which is the NCHX platform. This will ensure that on a go-forward basis, the language that the payer and the provider will basically communicate is one language. It will be totally digitized, and therefore the time that is now getting taken for the discharge will obviously come down dramatically. Point number two, since the entire claims, the country's claims will basically come on this particular platform, the insurance industry will be in a much better position to do analytics on the data that is there, and therefore will be able to basically bring down the time required for any kind of investigation that may be required or some kind of a declaration that the customer is not given. All that will come down, and therefore hopefully going forward, this entire issue of the time that is taken will come down, and therefore the claims experience would go up dramatically.
So you're talking about Health Claims Exchange and Bima Sugam platform. So tell us more about it and the timeline to it.
No, the Health Claims Exchange system has nothing to do with Bima Sugam. Health Claims Exchange system is just an ABDM initiated process where the insurance industry, the TPAs, the hospitals, and for that matter, the entire ecosystem for health claims only will come on that particular exchange. So this is different from Bima Sugam. Bima Sugam, if you want me to answer now, I can actually, just spend some 2-3 minutes on that. You see, India has taken a lot of stride in the last 8-9 years in creating what we are now calling as the digital public infrastructure. Aadhaar is a classic example where identity basically got digitized. On top of it, you had eKYC. This helped the Jan Dhan, initiative of the Prime Minister. And we today, India from a most non-banked country has now become one of the most banked country in the world. 80 crore, accounts got opened on the, overall. And what was actually assumed to be a zero deposit account, what I last know is that 2 lakh crore is the deposit that is there in those Jan Dhan accounts. On top of it, obviously, then UPI happened, what has happened and how the democratization or universalization of the payment processes happened. Top of it, you have some of the other examples of a DPI would be the FASTag, the mobility that you actually go through today, which is a great public good that, the government has basically done. The ONDC platform, and there are BBPS platform, there's so many other things. So, just want to say that in the Bima Sugam that, the industry is trying to do is a private-public partnership governed by the regulator, where you are trying to create a platform and a protocol, which will be an open source, and a protocol where, the different stakeholders will be able to communicate to each other digitally to ensure that, there is a seamless experience to the customer. This particular protocol will get connected to the India stack and whatever I spoke about to ensure that we'll have a far better understanding of the customer. So the insurance industry moving forward can move from an asset-based pricing to a customer-based pricing because you'll have a much bigger data of the customer. And therefore, this protocol is really the big innovation that the insurance industry is coming together to ensure that the customer gets a far better experience. Imagine that in that protocol, all stakeholders, whether it is NCHX or whether it is the UPI, the NSDL, the UPI, everything gets connected. So from an insurance company perspective, rather than trying to API integrate with 5 different integrators or 10 different integrators to basically have a better understanding of the customer, will come and integrate on this particular platform. This would be built on an open architecture, which will obviously have its interoperability, which will obviously have a rail that will get created on the digital mission, on which top of that innovation can happen on the private side, and the fintech can also take, for example, today if you look at the UPI, a phone pay or a Google Pay, it doesn't matter, it's all interoperable, isn't it? I mean, end of the day, everybody is taking advantage of that particular UPI open stack that has got created. Similar to that is what really the thought process around this. This will ensure a much better, not only an onboarding experience, but much better servicing and claims experience for the consumer. So this is really all about. Apart from that, the platform definitely will ensure that all insurance products will be available on that particular platform. The consumer can come directly or through his distributor to ensure that he can actually buy whatever products he wants to buy on the platform. So the platform will ensure that you will be able to buy, you'll be able to service, and you'll be also able to claim on the same platform. Imagine having a golden ID of insurance. Today you may have 2 life insurance, 2 health insurance, property, casualty, accidental. You may have 3 credit cards on which you have an embedded insurance. All that basically comes together as one golden ID. And once you type in, all those insurance will be available. Imagine that you can do an endorsement. If you do endorsement on that golden ID, then all the addresses will change together. If you do a claim, all things will change together. Imagine that the protocol will get connected to the death register, and therefore if there's a death, the question around unclaimed and all that stuff will get solved. So really, this is a very large innovation that we are trying to do as an industry, and I personally believe that this will do a lot of distribution explosion because tier 3, tier 4, tier 5 markets, there is an issue of awareness of distribution of health insurance. Forget about buying health insurance or buying any kind of insurance. So this will create distribution explosion. This will create, trust, which is also a big missing element in the overall insurance industry. And this will therefore ensure that the chairman of IRDA, whose dream is to ensure that we have insurance for all by 2047, will hopefully, get done much before than 2047.
All right. So a lot of things are happening, but the timeline to it. So I'll take this question to Anuj. The same question about, I want you to expand more about health claims exchange and as a company what you are doing, to what extent has it come forward, the timeline to it. And also, Prasoon talked about lack of digitization in hospitals and that is the reason why people face delay in their hospital discharge. But at the company front, claim settlement process, why can't we look at the status of it online? We have to write mails, we have to make calls to customer care. So at insurance companies end, why is it not digitized, let alone hospitals? And then second point, health claims exchange.
I think collectively as we stakeholders, we need to do a bit of more work in trying to change the perception of the industry. Now imagine the question that you asked, the perception that you carry, the industry is doing all of it. It has not been spoken about it. We keep talking about, digitization, AI, blockchain in the industry. The fact is this industry is doing it all. But the outside perception is that it's as if we still sit in the offices with pen and paper and issue cover notes and look at everything physically. Now let me address each one of these points. The delays happen at the hospital's ends or at the insurance company's end. We will not get into it. The fact is delays happen. But if you look at that's one side of the picture. The first step also is how fast the claims are getting approved at the time of hospitalization. Let's not miss that point, right? So industry has done a lot of work there where today, I can tell you that in cashless situation, the STP claims for us are taking an average of 28 minutes. Now, a few years back, nobody could have thought of approving a cashless claim in 28 minutes. But the pain point is, people are not taking cashless. IDA chairman's vision is to have 100% cashless. We all have a big target of ensuring that, we become 100% cashless. But the cashless claims in health in India, in the country, are still low because customers are not coming forward. You're managing their cash flows, you're giving them convenience, but people are still not taking cash.
No, they don't take it because they face delay. So they would want their patient, the person who is sick, they want to have them home as soon as possible. So which is why they pay and go home.
Do an assessment in the event of a reimbursement and in the event of a cashless. The delayed in discharge is not a big difference. Because there are processes at the hospital's ends which we are not aware of. There are processes at our end also, and the collective result is some delays in the discharge. But let me assure you that the industry is working on it. I only can speak of our example. We've finally, and as it pains the customer, as it pains you as an important stakeholder in the chain, it also pains the insurance company, because at the end of the day, every insurance company, and I can speak on behalf of the industry, is today talking of giving a differentiated customer experience. We no longer call it the customer service. So we went to a very large, we've been going to the hospitals and saying, why do you wait? Why do we not simplify the processes? If you think we are a company who you can rely on, work on our guarantee, discharge our patients as fast as possible, we will do the paper later on. We obviously, didn't get the takers. Finally, with a very large corporate hospital chain in the country, we've actually launched a zero-wait discharge process. We're saying whatever documentation needs to be done, whatever process need to be complied with, we will do it later on. Let my patient go. Let my customer go out the moment the treatment is done. So my point is that the industry is working on it, and very soon we will see even that leg getting addressed. See, few years back, even approval of claim hospitalization entry was also a pain point. The industry has addressed it. So it will certainly get addressed. The second point that you made is why the customers can't see the status of the claims. But frankly, they can.
How?
Today, all our motor claims, all our health claims on the IPO, which is the app we have, and I'm sure all the other companies will also have, or through a bit.ly link, the customers can actually see the entire process flow. At what stage is the claim, what are the documents pending, and as the machines are learning, it is also getting more and more refined. We are promoting our customers to lodge claim through the insurance portfolio organizer app that we have, so that they can track the claims. So there is also, and I think you make a very valid point, and I go back with the learning that we also need to then popularize it. We've also not done our job of making you aware and the customers aware that you can track your claims.
Yeah, because even agents, they also highlight the same issue, that they have to physically go to insurance companies, speak to people, and then claim settlement.
No, can I come in here, please? We went through the world's largest BCP during the COVID, a BCP of enormous proportion which none of us bargained for in March 20, right? Cut to 2 years of COVID. 70,000 crores of life insurance claims. He said 95,000 crores last year. The entire claim settlement during the COVID period happened without anybody stepping out of their house. Right? I think we get very little credit for what this industry achieved. In one of the testing circumstances, the claims settlement ratio for most companies went up. I can vouch for my company. Exactly. During the COVID period, our settlement ratio actually went up. Right? We had an avalanche of claims, but the claim settlement ratio went up. Everything was digitized end to end, and we must thank the regulator for giving us a dispensation of doing things digitally. You could log in a claim digitally, you could scan documents and put it there digitally. We did all the verification, and sitting in your home, you got the amount credit in your bank account. No, this happened under very testing circumstances.
There are positive and
negative. At the peak of its volume.
Absolutely.
So I think to some extent we require people like you. Also your help, since you're the media. Please give us a little bit of credit where we have managed things, right? Right? Some things go wrong sometimes. We're not saying we're in a perfect world, but I think the industry is a testament of...
Out of the 30 lakh claims in COVID, a few claims would have seen, it's the end of the day a large thing, but that gets highlighted, not the... But again, the point that you were making, and it's still, we still go back with valid feedback that we need to popularize it, we need to do a lot of, some more work today to make the customers aware. We've been telling, and by the way, since you spoke of agents, I think I need to take you to our agent, who will give you exactly the opposite feedback. So I don't know which agents were you talking about. Today, my agents work on an application which is country's first generative AI-driven app. Of course, I will. Well, you should also speak to Mahavir. He'll also give you the feedback. End of the day, he rates the products based on what servicing we do. But trust me, A lot of work is happening, and I'm not even talking about our organization, I'm talking about the entire industry. The industry is today talking about a differentiated customer experience. We're not calling it servicing anymore. Have patience. Work with us, as Mahesh said, also portray the human side of this industry. It's a very sensitive industry.
Can I just add one point to what Anuj said? I can say this on behalf of the health insurance world. If it's cashless, there is no problem. You know, there's a problem of delay and all that. We have already answered some of those issues. The reimbursement claim, today, all insurance companies accept reimbursement claim digitally on their website. So you can come to any of the insurance company's website. You don't need to send the original papers also. This is something that we started in COVID and we continued with that. So
I don't think it happens in all cases, because I also...
at least people sitting out here, I know for him it happens.
I think we need to certainly give you, spend some time
that.
with you.
So you can actually just now go to the website and you can upload all your documents. You will get a claim number immediately.
No, I was told to send all my original documents along with film, CT scan, everything. X-rays, all...
No, not anymore. I think most of the people have started doing what
Just I'm talking about March 2023.
I can't comment on the specific situation that you've seen. We will deal with it. But not only website, as Prasun said, you also need to see how insurance companies have taken WhatsApp as a channel to create a wow experience to the customer. You can actually lodge claims there. You can forget lodging claim. I mean, that you can do in any case, in any of the form. You can go to WhatsApp today, in my case at least, in 12 languages, you can check the status of your claim. You can you can download policies, you can download endorsements. So we are trying to touch the customers, we are trying to give the experience to the customer in every possible medium. Of course, is it a standardized experience across the industry? The answer is no, right? But few people have made these initiatives and, it catches. It's a very, end of the day, the others who are not doing the FOMO will catch up and they'll also get onto the bandwagon. You will see this industry getting completely changed in the next few years' time from now.
Hoping for that.
Of course.
Now, Mahavir, so moving on from claims experience to some other pain points, you being a B2C company,
Hello.
what are some other pain points that people are facing and where digitization can help?
Right. So while I was thinking about this event in the morning, I did expect this clash, if I can call so, to happen, where the insurer side would talk about how they are doing a lot of great work, but there being a perception that there is a lot of problem, right? Anuj did mention about perception, right? And he also mentioned about, I think Prasoon mentioned about trust. In our view, the way we look at it, because we play an independent role in this space and we've basically decoupled ourselves from distribution so that we can take the customer's lens. What we see when we talk to customers is there are 3 large problems that still exist, and all of them basically create the trust deficit that exists in the industry. The first one is the dependency on the customer for data, right? In our view, the world has moved really, really ahead, and insurers today still need to do a lot of work to solve for capturing data that is not dependent on the insurance company. The burden should not be on the customer, to be able to draw data. For example, the biggest problem that we see in claims is the non-disclosure of diseases, right? And most of the times the burden is on the customer or basically through the agent on the customer. This data actually by now, the privatization of the industry has happened like 22 years now. This should have been captured in a way that you don't need the customer to that extent to basically give you the information that you need to underwrite. That's the first thing. The second is, I think on the messaging side, we did speak about WhatsApp, but on the messaging side, we see a lot of issues in terms of the customer's expectations and what insurers are delivering today. Case in point being, let's say I am living in a world where I see on a Swiggy where my food is right now, And even if he's taking a U-turn and not coming to my location, I can see that. And you cannot blame the customer for having an expectation. Now the customer has this expectation that I want to see a claim also in the same manner. Our experience dealing with a lot of customers, we do a lot of interaction with customers on social media and otherwise. We see that this expectation, there is a mismatch in terms of what customers feel they should get and what exactly is available through insurers. And this is not any specific insurer, it's about the industry, right? The third is equally and very, very important is on the complaint side. I think there is a huge issue. Most customers need to learn to write an email to a CEO to solve for complaints where there is a nuance. Complaints are not solvable at a call center level or at a chat level, and wherever there is a little bit of nuance, it requires to a large extent, it's become standard, and I'm sure there are 3 CEOs sitting here who will agree with me, that write a mail to the CEO, and the CEO then, when the mail reaches the CEO's office, then action happens. What this shows is that there is intent, right? There is great intent. So whenever a mail goes to a CEO and then it's getting responded and then the claim is getting paid, that means there is great intent. But somewhere there is a huge gap in all these 3 places. One is data, the other is basically the entire communication messaging problem, and the third is complaints.
Right. Now coming to you. So since you work with insurance companies, you have a B2B connection to them. So talk about what is happening at the back end. What sort of digitization? So AI, blockchain, ChatGPT, all these big words. But what's the real use case in terms of
look, I mean, given that we spoke a lot about digital and all of that, you have to realize that insurance is still like in the country, only 5% of policies are sourced digitally, right? It's still an intermediated industry, which means people need to be made aware of the product, it needs to be sold. So in fact, if you take the entire country, only 27% of our premiums are even sold through agents compared to countries like Thailand and Korea, which is more like 50%. So a lot of the companies are still trying to figure out how do you empower the agents with digital tools and technology to reach the end customer? Because at the end of it all, if you look at the chairman's vision for insurance for all by 2047, it's not going to get achieved by just digitizing my backend. It's also about digitizing the people who can reach the customers. So there is a ton of work that is happening specifically on getting agents much more digital, and that might involve generative AI tools, scripting, being able to translate your policies into simple language so that every single customer and layman can understand. Along with that, there is also a lot of effort happening on engagement, because as we all know, we don't wake up opening up an app like GPay or like, you know, Amazon or anything. Like, you don't open an insurance app. You hardly open it, only when you need to claim. So the point of how do you engage frequently with customers? So there is a lot of digital work that is happening on getting users onto your platform, and that won't happen just through insurance products. It's insurance combined with a lot of things that customers want. It could be a lot of marketplace offerings as well. And the third thing I would say is there is also a lot of focus on making sure claims, which is the source of truth, and we spoke about it in extent, it is as seamless as possible. Now, yes, we can wait for everything that the government is doing, but despite that, the industry has made tremendous strides to actually figure out how do you make, you know, claims T-1 discharge? How do you actually figure out who is the real fraudulent person in there, right? How do you actually like not withhold claims but actively search out on who do you actually pay out claims to? So there is a ton of actual work happening on that front as well. So I'm not even touching on the servicing aspect, which is table stakes. Everybody has a chatbot now, everybody has conversational AI, but technologies like blockchain can simplify fraud to a great degree. It is, yes, it is maybe another 4 or 5 years out, but even with simple digital data sharing with National Claims Exchange and other stuff, and Bima Sugam, you could actually detect fraud much easier as well. So 3 things, one on the agency and how do you actually get much more of that digitally enabled. The second is on customer engagement, and the third is on claims processing. That's where I see most of the digital conversations happening.
All right, and now coming to Mahesh, unclaimed insurance money in life insurance industry is a major problem. So while insurance companies do disclose this data on their website, but people, if they are not aware of their hidden fortune, so they are not going to check it on just any insurance company. They cannot go through all insurance companies' website also. So what is happening on that front? And as an individual insurance companies, what initiatives do you take to reach out to those policyholders or beneficiaries?
Okay, first let me take a minute to explain unclaimed, right? See, unclaimed primarily comes from the fact that we are unable to pay the customer back his policy because we don't have a bank account or we are unable to contact the customer. Intent is very strong. Obviously, it's the customer's money. We want the customer to claim it, right? And this is also a little bit, in time, we have a problem. It's not that the policies which have been sourced last 2-3 years we have unclaimed. It's because these policies were sourced, I told you it's a long-term business. 10 years back, 15 years back, I am paying maturity proceeds for a customer who bought a policy in 2002 from me, right? From 2002 to now, a lot of things have changed in the customer's life. The agent has moved on, customer's address has probably moved on, he's probably not updated it. Mobile numbers didn't exist in those days. So I think we must understand the nature of the problem. It's largely coming out of inability to contact, and we don't have the right bank account, right? Sometimes we even mail checks and the checks come back because it's not delivered, or those checks are not banked, right? So this is a specific problem pertaining to a policy sourced in a particular time frame, right? Do we have problems of unclaimed for the recent policies sourced? I think answer is no. Every insurer will say that we all have bank accounts. Without bank account, in fact, we don't even source a policy. Now coming to what are we doing about it, right? Since it's a number out there, what are we doing about it? Multiple initiatives are being undertaken by companies. First and foremost, we are trying to now, at least at Kotak Life, we have been able to keep that amount at a very, very low level. The number is actually very small for us. The primary reason being that A, we try and do every effort to get the customer details. In fact, today, we have a whole team pursuing with the customer details on social media. We are seeing whether he's got a LinkedIn footprint, whether he's got a Facebook footprint, whether he's got an Instagram footprint, right? Does the agent have a footprint? So because we are desperate to contact customers, somehow or the other, to get their bank account. We're also working with our partners, banks, etc., and other corporate agents to see whether we can repeatedly watch this data to see whether bank accounts are there. With account aggregator coming in, that ability to do that will also go higher, right? And in those days, there was no common KYC. Aadhaar number did not exist 15, 20 years back, right? So the industry is doing everything possible to contact the customer and get the claims paid. Even if it's a small mobile number we get, we immediately do a GPay and say, okay, we don't even want the account number, we can pay with through UPI, right? So these are the efforts being put in. But I think the Bima Sugam initiative and the insurance repository initiatives, if they come out in full bloom, I think this problem can be very largely reduced, right? One is the insurance repository. I think there is a lot of discussion around making that as part of the ecosystem, where every policy, old or new, is put in the insurance repository, right? Then every customer can go and check in the IR to see whether a policy exists in his name, right? Most of the time for us, it's surrender maturity payouts which are stuck, right? So the customer can dial in and see across all insurance companies through that golden ID whether he's got any unclaimed, and he can immediately give us a bank account and we'll be able to process that claim. So that will happen through the Bima Sugam and the insurance repository that we are creating, right? But let me tell you that there is enough focus on this. Even the regulator in the last 1 year, 2 years has stepped up their own efforts in terms of tasking insurance companies for reducing the unclaimed, right? So I think a lot of work is happening. The intent is very strong. Improvements are being seen. I think it's a matter of time before we reduce this number to a very, very low extent.
Right, so we are running out of time, but before I wrap up this session, I really want to understand the status of account aggregators. So in today's speech, IRDA chief also talked about it, that 27 insurance companies have onboarded on the platform and rest are yet to do it. SDFC Ergo, I think they have done it. So what's the status? Exactly what impact will account aggregator have in the insurance industry?
I'm glad you asked this question because account aggregator, by the way, also addresses one problem that Mahavir highlighted and the big problem that you threw in Mahesh's direction. So everybody understands account aggregator. In my opinion, if I take a step back, I think something which started with Aadhaar and now with account aggregator, I'm not surprised that Bill Gates said that India has the most comprehensive public stack in the world. I mean, this makes it truly comprehensive. Now what it does, to start off with, the insurance companies will be the financial information user. So it allows us to actually dip into the account aggregator and take the information that we need right from underwriting the customer till the payment stage. exactly addressing the point that Mahavir was making. I don't need to wait for the customer to give me the information that I seek, to prove whether a particular event has happened or not, and don't look at account aggregator in isolation. Also integrate it with the National Claim Exchange. Integrate it with ABHA and see what beautiful ecosystem we've created. I don't need to actually go to the customer to prove whether the ailment has actually happened. You are on ABHA, you are on National Claim Exchange. I would have the entire, the medical history of the customer. I would have the financial information that I need to pay the claim. Press the button, it goes out. A lot of information that we seek today, starting with KYC. KYC for general insurance industry, life has been doing it for decades. For general insurance industry, just started. Honestly, we are struggling. The customers won't agree to give KYC. The channels would still struggle and say, why do you need? Because you've not sorted so far. The industry is tirelessly working to do KYC. Account aggregator comes in full bloom, as Mahesh said. You have information available to you, KYC done. And behind everything, there are a lot of efforts, time, money, efforts which are going, to procure this information. Account aggregator has it all. Fraud. I mean, you can actually do a customer persona dipping into the financial information. And by the way, the beauty is all of this is happening with complete control in customer's hand. He or she decides whether you want to give me this information or not. The entire customer persona gets created using account aggregator information. I can actually design products which are suited to you rather than designing and underwriting products for a larger cohort. Products like credit insurance, where I need hardcore financial information of an entity. I don't need it anymore. I can procure it from account aggregator. So in a nutshell, account aggregator is the genie, which will actually solve a lot of problems which the customers today feel pained about, and also the insurers feel pained about. So that's how account aggregator is evolving.
Okay, Karthi, yeah.
If I may just finally add, I think you asked about blockchain and these complicated technologies. This beautifully solves what a complicated technology would need to solve, right? So all of the use cases that he mentioned is what blockchain is intended to solve, which could take 10 years, but account aggregator could be here in 2 years, which could solve a lot of these problems as well. So
why do you think the delay happens? So for example, Bima Sugam was supposed to get implemented last year, January, and 1 year has gone by, and we are still talking about it, Bima Sugam will come in. So why the delay happens? I want to hear it from you and not from insurance companies, maybe, because you can, as a...
Karthi can answer that, I'll be very happy.
no, look, I think again, as a consultant, I have an outside-in perspective, not the privy of all the LI council.
But you would understand that why insurance companies take time.
No, I think this Bima Sugam as a vision itself, let me put it this way, it is first in the world, right? We as consultants have also studied different models, and I was in New York and in the Europe, and I've studied different models. Personally, I don't think such a comprehensive platform exists anywhere in the world. So you have to first understand the magnitude of what you're undertaking. That's number one. Number two, the vision is it actually requires collaboration of different data parties to come together. So even the formulation of the concept as well as the blueprinting will take time. Now, that said, the vision has evolved into something more comprehensive than initially just a purchase platform. Now you could do everything on that one platform. So in at least my humble opinion, it's the vision that has evolved into something that will solve majority of issues that the insurance industry faces, which is why the delay has happened. And when I say delay, it is not people are sitting idle, right? People are actually thinking about what it needs to happen, onboarding partners, actually doing pilots. So in the near future, when it gets launched, it'll actually get launched in its full entirety, right? And that's the hope for the insurance industry.
Would you like to add upon something?
No, I think Karthi rightly mentioned that this is something of massive proportion, never done before in the world. There is no parallel model to Bima Sugam anywhere in the world, right? So I think therefore the grand vision needs to be thought through, and the plans have to be made up. And I think a lot of work is happening. All we can say is that I think a project of this enormous proportion needs to be given some time, right? And I can only say that some of us are working on it, and in full earnestness, things are being worked out. And I think when it comes out, the baby will come out beautifully.
Hoping to see some improvement, and maybe next year when we discuss the same topic, we have some improvisations to talk about. Thank you so much for joining us here. Really great conversation. Thank you.
Thank you.
Thank you so much, Aparajita. Can we have a huge round of applause for our panelists on stage? And Aparajita, I'm going to request you to please present a token of appreciation on behalf of all of us in the room to our panelists. Some incredible insights came out of that conversation. Thank you. Requesting our panelists to please come together for a group photograph. What a phenomenal day it is turning out to be here at the Mint BFSI Summit 2024. Thank you once again, gentlemen. Thank you. Thank you, Aparajita. And before we move into our full and final segment at the summit and the awards, ladies and gentlemen, I think एक cup chai coffee तो बनती है, right? So this is your chance to go and grab that cup of chai and coffee, re-energize yourselves. This is a very, very short break. We will be resuming with the next conversation in just a couple of minutes from now. So please get your mugs, your cups, and join us back in the room. Thank you.
Hello, check.
Where could reinvention take your business? Accenture, let there be change.
हर पल करे खुशियों की सवारी अब शान से चलाए हम अपनी गाड़ी
Canara Car Loan, Canara Bank. Together we can.
गोल्ड से लेकर बिजनेस, पर्सनल से लेकर होम, हर जरूरत को मिलेगा लोन। IIFL फाइनेंस।
Serving more than 20 million happy customers with around 1,000 branches and over 1,400 plus ATMs that are spread across 18 states and 4 union territories. The bank's well thought out initiatives ensure security and growth for its customers.
The conversations percolated like a freshly brewed pot of coffee and chai, both minds and palates. It's time for us to take all of that energy and to delve back into the invigorating world of BFSI discussions. But our topics are as robust as that strong chai and coffee that you've had. So let's start by talking about companies that are not banks, but they also lend, the NBFCs. The RBI recently clubbed a group of leading NBFCs into what is called the upper layer. They are strong, big companies, often backed by industrial houses. They are as strong as sometimes stronger than banks. What is their agenda and what drives their growth and their future? All of these questions and many more will be answered in our next conversation. And what's exciting about this conversation is that we don't have one but two moderators, co-moderators. Let's welcome them on stage. Ms. Gopika Gopakumar, Senior Assistant Editor, Mint. Ms. Sonali Kulkarni, Managing Director and Lead Financial Services, Accenture in India. And please join me in inviting our speakers as well. Mr. Rajiv Sabharwal, Managing Director and CEO, Tata Capital. Mr. Ramesh Iyer, Vice Chairman and Managing Director, Mahindra Finance. And Mr. Vyas Chakravarti, Managing Director and CEO, Sri Ram Finance. I thought there is more energy in chai and coffee than all the distilled alcohol in the world. Everybody, come on. Thank you. Over to you.
Thank you, Xenia. Well, Sonali decided to answer my questions rather than be on my side and ask questions. So I'm going to be the moderator for this session. Thank you, gentlemen. Thank you, Sonali, for joining us. Well, I have 3 of the top 15 upper layer NBFCs, all constituting of assets worth around 5 lakh crores sitting here on this stage. So clearly these NBFCs are systemically important, and that's why regulations are tighter around these NBFCs. So as the question is, how will these NBFCs look at scaling their operations from here on? What is their business strategy going forward? So let me begin with Ramesh sir. You know, we've seen that over the last 10 years, the NBFC business model changed from a monoline business to more multi-product business. And this is, you know, we've seen this transition happening across NBFCs. But you have sort of maintained your hold over your traditional business. How do you see your evolution going forward?
Hi, good evening. Thank you for having me here. I think fundamentally what we should realize is NBFCs are built around needs of the consumer. I don't think NBFCs are built on, I have this product, whom can I go and sell? I think we've always looked at, this is the geography, this is the segment of customer we want to attract, and therefore do what they are asking for. Historically, for a very long years, probably they didn't ask for more product. Right? They asked for vehicle, tractors, maybe some machinery loan, and we all did that. They have progressed. The customers have progressed to wanting from an organized sector, because the segment that we work with, initially they didn't even believe they are eligible for credit. So how will they even ask you for more product? Right? But now, over a period of time, with their own track record, right, having taken loans, having repaid loans, they have now come forward and said, I need more loans. And then when we look around, we see that they have been fulfilling that need from a very unorganized sector. And today they realize that they can get from an organized sector. So I would see it as it's an evolving opportunity that the consumer has offered us. And we are just capitalizing on that opportunity, being there, having set up a branch, having set up people, having set up product, etc. And it will continue to evolve this way. And similar questions were always asked to us. When we started only with vehicle, they said, oh, now you've gone into tractor, are you evolving? You've gone into cars, have you evolving? I somehow always worry, for an NBFC, the product is not car, tractor and all that, right? For us, the product is money. So we actually sell money, and therefore we have to sell money to those consumers whose needs are met through that. And I think that's the way we have evolved, and that will be the direction in which we go.
Rajiv, you have always been a diversified NBFC. Where do you see your strategy going forward? Becoming more younger, maybe?
No, actually, we've always been
a company which was being present across segments, and I feel that gives us an advantage. We've seen in India that there are business cycles, and you will see at different points of time one sector doing better than the other. For example, retail has had a long run of of good times post the GFC, but when COVID came, I think when you couldn't meet the customer, or you couldn't be there at the dealer's place, or dealers couldn't open their shops, the retail business got impacted, and the growth of retail business got impacted. And at that point of time, we saw the corporate business doing well. Similarly, the SME business got impacted. But when things opened up, we saw growth coming back in all segments. So I feel being present in all segments gives us, or puts us in a position where we can take advantage of what the need of the market is at that point of time, and suitably focus on those segments while retaining our overall strategy of being largely retail, but you can tweak it slightly because you are present in those segments. And that is what we've tried to do. And as far as the future is concerned, I think we want to be present in all the segments with a strong bias towards being on the retail side and being in the secured business side more. That's been our strategy, and we will continue with that strategy.
Chakravarti sir, you have just made the transition with the merger, so to speak. So how has this journey been post the merger, and how much of this, how much more business are you able to do with your own customers in terms of cross-selling different products? How has this journey been post the merger?
Honestly, I think the team is happy because now, particularly the commercial vehicle team is very happy because now they are able to offer, a lot more products to their customers. Earlier also, the commercial vehicle team was not just into funding commercial vehicle, they were actually funding for, say, a tire. The customer needs funding for a tire, for fuel, for bill discounting, transport bills discounting, funding for FASTag. But then today they are able to give them a two-wheeler loan, a gold loan, emergency purpose, they are able to give a gold. So they have a lot more products on the plate to offer to the customer, so that the customer is not going out of the ecosystem and they are able to retain the customer within the system. Whereas on the earlier Shriram City's side, which was largely MSME customers, there are a lot of MSME customers who are operating vehicles for their captive use. So that was actually, that's an additional business line for the executive, where he is able to actually earn better incentives on products, other products also. So all in all, I mean, honestly, it was much better result than what we expected. In fact, the biggest worry for us was the team integration. 75,000 people coming together was the biggest risk factor to be in this business actually. But that actually happened very smoothly. So.
Right. Sunari, so we've seen that over the years, RBI has harmonized regulations for NBFCs with respect to banks. What is the advantage that NBFCs have now vis-a-vis banks?
See, I think if you look at traditionally where NBFCs have played well, and I think the niche that they operate in, right? I think one, obviously the segment that they serve needs deep domain expertise, right? Whether it's, whether it's the rural segment that, Mahindra serve, or the commercial vehicle tractor owners, operator owners that, Shriram serve, right? It needs deep domain expertise, which I think has been built over the years, and that's, I think, a big differentiator versus the banks, right? I think the other advantage, and again, it's a very deliberate, strategy, I'm sure, which has been followed, is I think their ability to operate at very efficient cost structures, right? To make sure that the cost to income or cost to serve for that segment is affordable. right? And I think third, their understanding therefore of that segment in terms of risk, in terms of their ability to collect, and we were just talking before this, session that, banks are in the lending business. I think Ramesh said that, whereas NBFCs are in the collection business in some sense, right? So their ability, I think, to collect from the last mile, from that consumer segment, I think these are something which they've been able to differentiate and build a very sustainable, business model around that. I think if you look at the market, the economy, I think growth is there everywhere. I think both banks, both NBFCs will continue to grow, and I think these capabilities, will allow them to, grow at a faster rate perhaps as well.
But we've also seen, somebody was mentioning NBFCs like a treadmill. So they are in the space where traditionally banks considered as risky, but now banks have started entering that space, say gold loans, vehicle loans, and they've brought down the lending costs. So with banks more and more entering these kind of spaces, where do you see this? Do you see NBFCs and banks coexisting in the same space? There is a lot of competition that banks bring in because of lower costs. Where do you see the coexistence happening? One of you can take.
I don't know why this question gets asked every 3 years, 5 years. And we are now 30, 35-year-old. Sriram will be another 10, 15 more than that and all that. I think fundamentally, please understand, any financial services provider as an intermediary is supposed to expand the market. When this question gets asked, it is assumed that the market size will remain same and the number of players will go on increasing, and therefore what will happen? If you just look at vehicle as a number, what it was 10 years back to what the number today is, the number of people buying vehicles have gone up, right? So I think all of us have an ability to expand the market. That's the first thing. I think second is, there are different segments of customers served by different players, right? So we don't overlap. Wherever there is a overlap happening, co-lending will happen, right? So I think co-lending is a good solution to how to come together in a common kind of overlap situation. Otherwise, each one of us have a very specific segment that we want to serve. And I think all of us have a prime position in which we are good at, and everything else is a secondary position. So if you look at Mahindra as a company, we are very, very dominant in rural. We are there in 400,000 villages. And we've been there for 30 years now. I shouldn't fear a competition coming. I must look at it as a complementary to say, okay, if one more guy comes in, he will bring in more discipline to the market, more customers will get more organized. So I think if we all start looking at that there is a need for everyone, and more products can be introduced, more customers can be brought into the formal system, I don't think coexisting is a big challenge.
Right. Raju?
See, we are all enjoying the fact that India is a large market and it is growing. If you look at the size of the credit market, if I add, the size of what the banks are or the NBFCs are, I think our size will be close to about 180 lakh crores, give or take a few lakhs here or there. If it's 180 lakh crores and it is going to grow at 15%, that's about 25 to 30 lakh crores. And if you factor in the fact that this 180 lakh crores has an average tenure of about 4 years, then which means about 45 lakh crores is getting repaid every year. So if you have to lend 45 plus 25, about 75 lakh crores every year, how many institutions India has in terms of large entities who can lend 75 to 80 lakh crores every year, which will increase every year. When we, at times we put the same color to all banks and all NBFCs. So there will be, if you go beyond the top maybe 5 or 8 banks, then top NBFCs will be as competitive beyond that. In fact, maybe more competitive than some of the banks. So I think the market is large. It is growing. I feel the country needs more large institutions to meet the credit demands, because I'm sure when you meet people or you go to different markets, there is still a huge desire to get credit. If India was a saturated market, if we had more institutions than what we needed, you wouldn't be in this situation. It's the other way around. We need more large institutions to support the credit growth of the country. That's how I look at it.
Well, in an interview to Mint, Shriram Group founder, Mr. Tyagarajan happened to mention this, that with over the years, competition from banks is going to increase, and that NBFCs will have to look at diversifying into other businesses, maybe insurance and so on, to sort of have a sustainable business model. What is your view on that, Mr. Chakravarti?
I think what he meant was that your fee income is going to become a very important component of your business. So typically, we all try to sell to our customers insurance, life, or vehicle insurance, health insurance, whatever. So I think his idea is that when your cost of funds goes up and because of the competition, your margins get squeezed. You need to supplement those margins, and the best way for that would be insurance. I think that's his. That's what he was meaning to. I think you only interviewed him, right?
Yeah.
Okay.
Yes, I only interviewed him. And that is why my question to the panelists here is that what we see? He was looking at a 10 to 15 years down the line, a sustainable business model because of competition from banks. Do you agree with that view that the NBFC model will become unsustainable because of...
No, he didn't say unsustainable. He said you need this to become more profitable.
I think we will all have to also look at our cost side, right? We have to become more efficient and make it affordable for customers. Then why will they not take it from you? Right? I think for very long the model has been NBFCs are costlier than bank and whatever it is. Today banks are also finding it difficult to compete with NBFC. Right? We also have our own strength. They want a certain customer, they are not able to get the customer. So I think don't forget that NBFCs are also getting super efficient. Let me give you another example. I mean, if all that we are discussing is true, there should be no money lender in this country, with so many banks come up, so many NBFCs have come up, we have all opened so many branches. If we are really serving the full need of the market, then the money lender should not be existing. Families giving loan to their own family members should not be anymore a practice, but they are all coexisting. So I think not to forget that you have to design the right product. You will have to make it affordable for customers to be able to take it. You have to be accessible that they can reach you or you can reach them either digitally, physically, whichever way you think. And you should be available to them when they actually need. Then they will choose you. They'll choose you. If all this was true, I don't think we would all be surviving. This question has been asked over and over and over time. And we are all growing even after that question is asked. So please keep asking this question. Probably that's a good question for us to continue to grow. But the fact is that I think everyone has a role to play. They need to understand their role well and execute to that role perfectly well. We shouldn't get swayed away by saying, oh, banks are doing this, should we try and do that? Or somebody else is doing this, should we try? And I think you should have your own well-set strategy. You must have an excellent execution plan, and I'm sure that all of us will have a great role to play.
And Gopika, if I can come in, I think if you see from a sustainable perspective and the larger or the upper layer NBFCs, right, I think at that scale, the benefits of scale we've seen tremendously. I mean, if you look at the cost ratios, for example, or their ability to then serve a larger market at a very affordable cost, or be the go-to financier in that market. I mean, today commercial vehicle market leader is not a bank, right? Or similarly, maybe two-wheelers as well. I think as NBFCs from the smaller segment or at a smaller scale go into the higher scale, I think that's where we've seen a big multiplier effect. And today, if you look at valuations, the upper layer, a lot of the upper layer NBFCs are actually more valued or have a higher price to book than some of the banks as well. So I do think, therefore, I don't think there is an existential crisis yet. I think the market is very large. And I think, last 2 years evidence does suggest that, this segment is probably growing faster than the traditional, banking lenders as well.
No, I was just saying the same thing, that the market is large, the market is growing, the per capita income is growing, the customer needs are growing, the product and services available are growing. I genuinely feel there are less number of large lenders than what this country needs for the credit demand of the country being met. And that is what I think the regulator is also trying to move people, where they're saying that more branches should be opened in rural markets. We should go deeper into markets and ensure that credit needs of everyone are met. I think that is, we are far, far away, not in the next generation also, I would say, of mine, that we will be, be in a state where all credit demands will be met. If you look at even large economies who are very large, they are also growing at 3 to 4%. And we are a much smaller economy and we are growing at 6 or 7%. I think we should be growing at a much faster pace based on our potential, and the needs of credit are much larger.
But agreed, but then how do you bring down your funding cost? See, banks have been investing in technology and they are looking to bring down their cost of operations. But things are getting tighter for NBFCs with RBI increasing risk weights on bank lending. So how are you using technology, and how are you looking at bringing down costs so that you're able to also bring down overall costs for customers?
I think if you look at it, number of steps everybody is taking. The increased cost pressures are being felt by everybody in the system. Whether it is NBFCs or banks, everybody is seeing a increase in cost of funds. Risk weight increase has been there for anybody who's present on the unsecured side, on the consumer side. So that will increase, one will have to increase the interest rates for those products to be able to absorb the increased risk weightage, and which will impact the growth rate of some of those segments. But few ways are, like, for example, we are all diversifying our liability base in terms of raising money from different sources. And we believe that's the right way to do, so that you are well diversified as far as your liabilities are concerned. Two, you're also looking at what is the mix of products which you should have in your portfolio, so that you get the desired margins in your business. For example, if you look at housing business, there's been a lot of focus on growing affordable housing. In fact, most of our branches, we are opening in tier 2, tier 3, tier 4 cities. So clearly, the product mix also will determine, what margins you have in your business. Third is, a lot of investment is happening on technology. Today, the cost of servicing is coming down. Cost of acquisition is also coming down. And, some of the large banks as well as the large NBFCs have significantly invested on the technology side to bring down in the cost of servicing the customer. The fourth thing which is probably the most important thing in our business is the credit cost. We all know that we are in the business of risk management, not in the business of lending. A lot of focus has gone into, a lot of analytics has gone into, in fact, a lot of AI engines are getting built in, so that we can, keep reducing this credit costs. I think a combination of all of these factors is helping the margins to be sustained or improved. Another thing which was just mentioned was about how do you increase your fee income. If you can create structures which will allow you to increase your fee income, that also adds to the bottom line. So I think these are a number of things which entities are doing. Some will do it well, some will not do it well. That will always happen in the industry.
So on behalf of Sriram, how are you using a technology? How are what ways are you bringing down your costs?
I mean, there's no magic formula here. It's basically, as Raju said, it's basically how do you reduce your cost of acquisition, how do you reduce your cost of servicing the customer. And of course, the most important thing is cost of collection. That's a large piece. So how do you reduce that? So basically, as you said, effective analytics, understanding a customer's payment cycles, his financials, and making sure that as you said, you keep your credit costs down. So technology, basically, if you ask me, I mean, a lot of people used to earlier ask me, what is the technology you're using? What is the people have this obsession about technology. For me, technology is, if it makes my customer's life easier, that is technology. First thing is, how do I make the customer's life simple for him to borrow or to pay and to get a service. So that's what we are endeavoring. Of course, we have also soft launched our super app. So probably we will start pushing it after this financial year. Reason is basically we are testing with about close to about 1 million customers, million downloads. So we are testing it within that, and probably which will actually help the customer for an end-to-end process, including digital. For my existing customer, it's any fresh loan, it's a paperless end-to-end digital. A new customer, most of it would be digital, but then we would also like to see and feel where the customer is living physically. We are still a little old-fashioned in that, but we would still like to build a relationship with the customer, not just on the airwaves or whatever. So,
like one of the big areas where investment has gone is in the area of analytics. How you can use data better so that it can impact all businesses. For example, we talked about cost of collection, but cost of collection comes in only after the payment is missed, while the ECS bounces or payment does not happen. So if you can decrease your missed payment rate by even 25 to 50 basis point, that can have a significant impact. So how do you create or do things which will allow you to not make wrong decisions? In this industry, we can never make all right decisions. But how do you make less wrong decisions? For example, if you open a branch, a lot of times a branch may get opened in a place which will not give you the results. How do you invest enough time to know where you should open a branch? What sort of customers you lend to? Even after you've lent, how can you bring down even the missed payment rates by 25 to 50 basis points? Or for example, if a customer has gone delinquent, what is the best way of collecting from? So I think data can help us in so many ways, and we are just evolving on that from ML to now AI to everything. We are just evolving and trying to make things far easier and simpler to operate.
One question I wanted to ask is on the housing space before.
I want to make a quick comment. For very long, NBFCs were built on knowledge, right? And that's why the cost was high, because we had to be closer to customer, open more branches, visit the customer more number of times, because the data was not so much available. Now, genuine data is available, proxy data is available, and you have gained experience over a period, your own data is available, right? So now it's moved from pure knowledge base to knowledge plus database, and that automatically brings down the cost, right? Second is, I think customer knowledge is also substantially gone up as compared to past. He thought if I've taken a loan for 3 years, I have to repay in 3 years' time, because there was no credit score and his next borrowing was not impacted and all that. Today, he also realizes that I have to pay every month. So he also is putting enough effort to bring down your cost of collection. Right? So I think you must look at it how things have changed over a period of time and therefore how the cost is coming down. And of course, competition anyway pressurizes to be more sensible and more productive. I think all of us price the customer for our inefficiencies in the past, and we will have to now price it right, putting in all efficiencies. So that was one comment I want to make. And on the coexisting, I wanted to make a comment, which is I think banks will continue to lend, at least on the vehicle and all these spaces, they will lend to people with aspiration, and NBFCs will lend to people who need them. So we'll be need-based lender, they'll be aspiration-based lender.
So just on that one, from a data perspective, I mean, completely agree. I think today we have access to a much richer data ecosystem, and one is the data which obviously consumers themselves are generating, but also a lot of institutional measures. I mean, today you have Udyam, where we've seen record SME registrations. You have account aggregator with GST data coming in. I think so. The ecosystem of data providers or ability for NBFCs or any lenders to capitalize on that is much better than what it used to be. And I think that's the opportunity, not just from a reduction of cost, but also better discovery of customer, better discovery of risk, beforehand itself. And any investments therefore in data to do that at a much institutionalized way will obviously pay rich dividends.
So I think we are towards the end of the session. So a quick word. So clearly RBI is making NBFCs look like banks, so to speak. But do you all want to be banks? I mean, what is life after being an upper layer NBFC? Become top layer, become banks? What is it that you're looking at?
How will you run an NBFC panel if all of us become a bank? So allow us to be an NBFC.
We'll have new players coming in then.
I don't know why this question again and again gets asked to industry houses whom the regulator does not allow to become a bank.
Yeah.
But the fact remains that all of us will look at that as a format that we want to be in. But it will be a very considered decision at the end of it if we still think that we can make a difference as an NBFC and can continue to grow. I don't think we will force ourselves to become a bank. But if that opportunity was to come our way, you think we'll turn a blind eye and say, no, we are not going to look at it? My answer would be no, we will look at it.
What about?
I think that question is hypothetical at this point of time. The way we look at it, we are an NBFC and a housing finance company, and all our plans, all our future, we are looking at how we can grow and provide better customer service. If ever the regulations change, we will evaluate it at that point of time. But as of now, we are happy being an NBFC, and we are trying to grow that business. Next panel, you should ask bankers whether they want to be a bank or they'll be happy being an NBFC.
They would probably say yes, considering the kind of compliance and regulations that they have to face. What about you, sir?
No, but today I don't think there is any difference between upper layer and a bank in terms of compliance. I think probably we are actually targeted more strictly than a bank today. I mean, basically India is IGAP. So I think bankers are lucky that way. But we did consider, as you all know, at a point of time under different circumstances. But as of now, I don't see a reason why I should become a bank.
Actually, I don't think so either of them should become the other one. There is a role which is being played by them. There is a role which is being played by NBFCs. There are areas where both of them are collaborating. There are areas where they are complementary to each other. So I think we are growing as an economy. Credit is growing. The market is doing well. Why do you want to change it?
And like I said earlier, the valuations for a lot of the upper layer NBFCs are probably higher. The size is higher, the returns are higher. So the incentive, and as Rajiv, you said very rightly what we discussed earlier, there is a very definite niche and consumer need that is being met. So I think coexistence is there. I don't think there is need to transform.
Rajiv also has put it beautifully. Today, if you look at a money lender, as he said, money lender, gold loan, you look at gold loan, pawnbroker, the guy opens his shop at 6 o'clock in the morning and closes at 10 o'clock in the night. Who can give that kind of a service? No organized sector can give. I can collaborate with him so that the interest cost to the end customer comes down, he does business. I actually get business. I mean, it's a food chain, end of the day, all the way up to the bank. So I think it's an ecosystem that needs to, every partner is important.
Okay, on that note, any questions from the audience before we call it a day? Yeah, just one.
Hello, yeah. Hi, this is Prasad from Mint. Just one question to maybe Rajiv. Rajiv, you spoke about 75 lakh crore that India would need every year, right? My question is, do you think India should walk the way that US has walked, where there is a problem of burgeoning credit, right? And there is a risk of, the economy getting blown up, right? Whereas on the other hand, India has always played the role of, being very tight when it comes to credit, right? So in order to achieve a certain percentage, let's say if India has to achieve, let's say 10% in GDP, right? Lending will have to play a much bigger role, right? So it's a very fine line or a thin line that everybody will have to walk, but the emphasis should be on credit, or should it be on liberal lending?
Actually, everything has to be sustainable and something which has to work for the economy. If you look at, credit is the raw material which supports whether it's industrial growth or whether, prosperity of the customer. In India, we've had the smartest regulator across the globe. Not only intelligent, but very smart and proactive. And they have allowed the market to grow without creating any bubble or any challenge in the system. I think the industry, the banking industry and the NBFC industry has also responded well to that in terms of creating an ecosystem which has allowed this. See, if you look at simple ratios, which is credit to GDP or the indebtedness of customer compared to the income which he or she has, I think we are far, far away from where, at the place where the large developed economies are, far, far away. The fact that we are growing much faster than them, even if we are far, far away from them, we still have to grow at a better pace, because as an economy we are growing more. The per capita income is becoming higher. And at every right threshold, it leads to a surge in credit demand. I feel the model which we have followed up till now is fine in terms of ensuring that credit grows at somewhere close to 2 times the GDP growth rate. We've also ensured that most of our credit growth is towards productive purposes. If you notice, the unsecured credit is still a very, very small proportion of the total credit in the economy. So we've worked the right way. We've had a regulator who really, puts us in the right position if we ever make a mistake. So with that in place, I think we have to allow the credit to grow. We have to have a responsible, the industry and a proactive regulator to ensure that this happens. I don't think so we are going or walking the path of really making the customer overburdened. We are far, far away from that. I don't see that happening over the next 20, 30 years. Beyond that, I can't imagine.
I think a quick comment would be, Indian borrowers are also very careful. While lenders do what we have to do, Indian borrowers don't borrow just because money is available. They are also very careful. So I think you should keep that also as a factor why we do well even in difficult cycles.
Any more questions or? Okay. So thank you all for patiently listening in. Thank you, gentlemen. Thank you, Sonali, for joining us in this conversation. We'll move over to the next session. But before that, a quick photo op and...
Yes, and Gopak, I'm going to request you to please present a token of appreciation to our panelists. Can we have a huge round of applause, ladies and gentlemen? Please come together for a quick group photograph. And as they do that, I want to draw your attention, ladies and gentlemen, to the feedback forms that have been placed on the table. Each and every one of you should have one. Now, your feedback is extremely crucial for us at Mint. Please take the next couple of seconds and, in fact, the next few sessions to make sure you give us your complete and honest feedback so that the next time we meet you, we can ensure that our next event is bigger, better, and grander and more meaningful. And you can leave the feedback forms there. My team will be collecting them in just a few minutes from now. India's banks are on a roll. The sector clocked 15% credit growth in 22-23, primarily catering to the seemingly insatiable appetite of retail borrowers. Now, although housing loans form a sizable chunk of this, what has caught the RBI's attention is the brisk pace at which unsecured personal loans have increased and has also introduced some measures to keep things in check. The bigger point is banks are growing their profits like nobody's business. Every quarter we are dazzled by the numbers. Is this for real? How long can this keep up? How long can banks keep up the growth run in the face of reticent corporate borrowing and repeated regulatory warnings and personal groans? All of these and many more questions will be addressed in our next conversation. At first, I'd like to invite our moderator for the discussion. Please put your hands together for Mr. Rajrishi Singhal, senior journalist and former executive editor, Mint. Joining us are panelists, Ashwani Kumar Tiwari, Managing Director, SBI, R. Subramanya Kumar, Managing Director and CEO, RBL Bank, Pralay Mondal, Managing Director and CEO, CSB Bank Limited, and joining us virtually for this conversation is Mr. Baldev Prakash, Managing Director and CEO, J&K Bank. Welcome to the stage, gentlemen. Over to you, Rajrishi.
Hello, check. Thank you, Senior. Thank you so much. Good evening and welcome to this CEO round tables. It's not a round table, but anyway, we'll call it a round table. This is one of the highlights of this event, and I hope we have a scintillating conversation this evening. As we enter 2024, we're just in the second week of the new year. We can already feel some of the risks that confront us throughout the year. The geopolitical conflicts, the wars in Ukraine, the wars in Levant area of Asia don't seem like ending anytime soon. We are faced with economic headwinds. The Eurozone and China growth is stagnating. They're desperately trying to drum up some growth. There is uncertainty in central bank policies from advanced economies, which will have its rub-on effects in India. We don't know when RBI is going to have a tough time in trying to balance A, inflation, B, its liquidity and monetary policy. On top of which, the biggest risk is political flux. We have 50 odd elections across the world next year. If we look at elections, nothing can beat India next year. We have a general election,
and on top of which we have 7 state elections next year. I have a list. So that's in Jharkhand, Haryana, Maharashtra, Andhra Pradesh, Orissa, Sikkim, and Arunachal Pradesh. So if you look at the number of seats, that's 545 in the Lok Sabha, plus more than 850 for the assembly elections. That's more than 1,400 seats up for elections next year. So, politics is going to be the big ticket item next year. And if you have elections at this scale, I don't know, but maybe I'm teaching to the converted, but every time there's an election, we have monetary flux in India. Money supply goes up, inflation goes up, and therefore, even this time, next year, we will be thinking, how did RBI manage A, increased money supply, B, increased inflation. And so, the RBI has a tough task on its hands, and so do banks, because banks will have to face the direct and indirect impact of these elections. So, as they tread a fine line, we have a stellar panel of experts here to tell us how they're going to negotiate the next 12 months. What I'm going to do is ask a question to each of them. Okay, we've got Mr. Baldev Prakash who's joined us. Welcome, Mr. Prakash.
Thank you, Raj.
Okay. He was supposed to be here, but he's got stuck in Srinagar, I suppose, and he's...
I'm in Jammu, Raj.
Yeah. So thank you for joining us.
Thank you.
So what I'm going to do is ask a piece to each of the panelists, and then throw it open for discussion. And after the end of all the questions, I'll throw it open to the floor. My first question is to Mr. Tiwari. What will be, you're the largest bank, and you have the largest market share in the country. So what will be your bank's strategy to counter the slowdown in corporate loan demand, which will now be accompanied by a slowdown in personal loans also, given the regulatory strictures that have come about? How will you, increase your book?
Is that a presumption that this demand will slow down? We are actually seeing a pickup on the corporate side. So we are seeing a pickup, and we are hoping for better, because 2-3 things. One is the cash sitting on the corporate balance sheets, they had deleveraged, has come down. The debt equity ratios are much better. They are now planning for investments, and when these plans take place, it takes about 2-3 years to fructify into going beyond sanctions into disbursements. And we are seeing that activity happening. I mean, talking to a lot of leading industry players in cement, steel, and so on. Everybody is looking to expand capacity. So, and many of them have already approached us. We've got sanctions as well. So it's moved beyond renewable and roads and all to the core sectors, if you will. So I don't think we are going to see a slowdown in corporate demand. And all the geopolitical events you talked about, yes, they are happening, and they could have an impact, maybe through the oil price, but so far, no significant impact on India at least. So therefore, my sense is the next 12 months, corporate side should pick up more. Retail, yes, the unsecured portion RBI has come up with steps which essentially tell the players to be more cautious, not go all out and grow much more. But as far as we are concerned, we always were cautious. So we have been explaining this, that our loans are largely to our salaried customers. So we don't see too much of an impact there as well. Of course, the returns will be lower because there is a provision which has to be made. So overall, I see our bank and generally banking in generally growing better. I don't see any slowdown coming in any form or shape.
Well, data suggests that growth in corporate loans, large industry loans, has been slow.
Has been slow, but it will pick up. That's the.
Is that what you're sensing? Are they? I mean,
yes,
you're saying
yes. Core
sector, you're seeing some movement, right?
Yes, yes. So I'm saying the growth will pick up.
Okay.
Yeah, from whatever it is now.
Okay. So you want to add something?
Yeah. Just supplementing with what Mr. Tiwari said. First of all, the corporate balance sheet has become stronger. You don't see the signs of weaknesses what we have been seeing a couple of decades before, or even 3-4 years before. What I see is it's a journey. First, strengthen your balance sheet, plan your capex growth, then move for the injection of the corporate loan. Our assessment is, although we are not as big as SBI, nevertheless, we also have a share in that ever-growing economy. The two factors which we firmly believe that it is going to grow in mid-segment as well as in a big corporate, the two reasons. Economy per se is growing. We are moving towards a 5 trillion economy. We are talking about the GDP growth of 7.7 plus the next year. And you yourself said in the previous conversation, they were telling that the GDP has to be at least twice. 2 times will be the growth of the bank predict. The thumb rule, the best of the time, is always 3 times. So you have enough opportunity for growth, and it cannot come from only the retail. The retail is always in detail, right? There is always the apprehension about the unsecured. Every unsecured need not be for consumption. You always have an unsecured which is also used for the micro servicing and micro growth. You go to a village in MFI, everything is not for marriage or a shadi or anything else. They use it for the purpose of doing a cottage industry, which in turn just trigger the supply side of it. Why the supply side has gone up is there is a demand which is coming across. There are 2 major factors which will trigger the growth in this year is that the living standards of the individual is growing up, which trigger a demand for every product, be it a consumer product, be it a retail product. The second, when the demand is going to trigger the supply side demand, which has to necessarily go into in terms of corporates and manufacturing industry. So when you put all the things 1 plus 1, there is going to be a positive growth. Maybe that uptake, you don't see it in this quarter or last quarter, but it is going to come back in the next 3 quarters.
Yeah, but if you look, I'm quoting RBI data again. If you look at capacity utilization for industry, it hasn't gone beyond 75% for 4 or 5 years now. It's stuck at between 74 and 75%, which means there is little growth in demand. So if corporates are not, sweating their machinery beyond 75%, then they won't have demand for extra capital, right?
That's the overall number. So in sectors, you're already seeing utilization much more than that. So
yeah, that's what I want to know. So what sectors do you see that spike
So I explained that initially most of the action was in renewable energy, solar, wind, etc. Then followed by roads. These were seeing quite a significant action, and roads is obviously on the back of government spending on roads, etc. Some more logistics areas like ports. Now it has moved on to the broader economy. So I see steel, I see cement, I see a couple of other manufacturing industries. They all have plans to expand capacity significantly. You talk to the top 3-4 players in all of these industries. All of them are planning to expand in the next 2-3 years. They have a short-term plan the next 3 years, then a medium-term plan, so on. So we are seeing that happening already.
So when you, on your opening remark, I'll say that I'm a little more optimistic about the country and the economy. And the challenges, of course, there will be challenges because there are global challenges around. And hence there are segments like export-oriented industries, and already exports are a little bit of a challenge as you're talking. But India is basically a consumption country and consumption economy, and very few countries in the world has this advantage what we have. So given this perspective, if you look at the slightly bigger picture and look little ahead, yesterday only Honorable Finance Minister talked about 30 trillion economy by 28, FY 28. And we also know the ambition of 7 trillion by FY 27, not 28, sorry, 47. FY 47, the 30 trillion economy. And FY 27, 28, we're talking about a 7 trillion. And as we're talking about a 4 trillion. So this will not happen without upwards of 7% kind of a growth. And go to any country in the world and say 7% growth, is it very pessimistic? Answer is no. So given that perspective, I think we are pretty optimistic the way things are looking up. There are a lot of foreign investments coming in. The domestic markets today, the DIIs are actually contributing more than FIs and hence little more stable. So, and banks have cleaned up their balance sheet completely across and has been a sweet spot in the last few years. So we have all the ammunition to support that growth as and when it comes. It has been a little bit more on the consumption and retail side of the balance sheet, which has grown in the last few years, as you rightly said, because corporate growth has been slower. But as the other panelists said, that come post-elections, I think some of the capex will start picking up. We can hear that in the market, and so far the government spending and government capex has been supporting the system, but gradually the corporate capex, I believe that will come post-elections because that's natural. And then the entire process will go through a complete transformation. So I'm very, very optimistic about the way we are looking at the growth in this country and the kind of levers which are, and the productivity, PLI, so many things when we talk about, and it's all looking extremely good. So to that extent, I'm a lot more optimistic that there is a huge opportunity ahead of us. Coming to banks, the second question, what banks has a role to play, I think banks' roles don't change much because we have to just ensure we manage risk well, we manage compliance well, and we keep our head on our shoulders and do the right things all the time and grow the business in the right direction. And if we do that right, and banks are much better capitalized than what it was a few years back, so the growth capital is there with the banks right now. So overall, I think it's a good picture going ahead, and I'm sure that we will look at that 30 trillion by 1947. It will become a reality.
Yeah. Mr. Prakash, would you like to add something?
Yes, Raj, I think I would like to add the perspective of Jammu and Kashmir in this entire debate. And what I'm seeing is something unprecedented in this part of the country. That the growth in our area particularly is led by two very, very important factors. One is the infrastructure, the type of infrastructure which is being developed in the shape of roads and tunnels is something which is driving the economy big time. The other thing is the investment policy of the government. And with this investment policy, lot of the entrepreneurs are coming in Jammu and Kashmir and they are investing. This is a very attractive investment policy. I mean, giving the benefit of interest subsidy also, as well as the capital also. So these two factors are driving as far as the corporate banking is concerned. The retail side, as Ashwini has just now mentioned, we are also in the similar segment as far as the unsecured personal loans are concerned. So we are financing to the permanent government employees of Jammu and Kashmir and the corporates of Jammu and Kashmir government. So from that point of view, I think the portfolio, though it is unsecured, but since the cash is coming to us every month and the money is being deducted to the extent of EMI and the rest of the amount is made available to the customer. So from that point of view, the risk is very, very limited. And these products are going on in the industry. In our case, it is more than 15-year product and hardly any slippages are there. So from that perspective, I think we are quite bullish. And for ensuring that we are ready for this growth, we have a very successful QIP very recently. And to support this growth, I think the bank is ready, quite ready.
Question is to Mr. Subramani Kumar. You know, your bank recently sold its portfolio of credit card, dues, and my question is not about that, but I'm just using that to say that, there is report that there are signs of incipient stress in credit card, personal loan, and MFI portfolios. Maybe very initial stages, but there are reports that the signs of stress can be seen. What kind of risks do you see arising in the retail finance segment, retail lending segment basically? Apart from the RBI's recent regulatory strictures and the increased risk weights, what other measures do you think are required? In short, do you think banks need a heavy dose of antacids after having binged on unsecured personal loans?
First, I want you to understand this ecosystem on this first. The percentage what you are talking about today is minuscule and it is hardly around 8 to 9% of the total credit which is going out here. Why it is happening today? because the world order has changed. Now we are the new normal. We don't look outside. We started looking inside, inward. India started looking inward. Why? There is a demand for consumer durables. There is a demand for consumption things. Even the credit card is also considered as a consumption. Consumption doesn't mean that I buy a 5 kg of rice and then cook it and then eat it, I don't repay. That's not the consumption we're talking about. The consumption, what we are talking about, is enhancing the standard of living of the people in the rural and urban. Why it hasn't happened in a couple of decades before or 5 years before, why it's happening today? We have started putting money in the hands of these rural and urban people. Simply by us, the friend from J&K made a point. Investment in infra, that money doesn't come to us. Metro you see everywhere. Today also it would have been delayed by a couple of hours because of metro digging iron in Mumbai. That was the case some time back. Go to any city across the country. Where do you get the labor from? The labor comes from your rural and semi-urban and urban areas. So the enablement for them to earn a decent has gone up. The moment you are in a position to earn better than what you are just beyond a survival, your mindset changes from save and spend to that of the spend and save. Why? I want to enhance my living standards. That triggers demand. These demands are always met in terms of the retail loans, retail advances. Starting from your two-wheeler, there was a talk in the previous panel that saying that ambitious and the need-based. In my view, the ambition drives the need. Otherwise, there will not be any need at all. The people wanted to make their lifestyle easier, better, by using all these consumer goods. So there is an opportunity which wasn't there earlier. So the opportunity, when you start leasing it, there will always be a bump up, provided you are in a position to have a strong risk underwriting. It's not that you are going to give somebody who is not in a position to earn money at all. I'm sure that every bank has a very strong risk underwriting. That's one of the reasons that you would not have seen that SMA zeros and SMA 1 and 2 is a clear indication of that. You look at that collection efficiency in terms of the bracketed unsecured loan is also, it is in the range of around 99 plus, right? Which clearly indicates the efforts for collection at the first installment is good. When that ability to collect the 0 day, ability to collect the 130 plus is dips, then there is a sign of risk. Today, the market is growing at maybe around 15 to 20% depending on the size of that portfolio. Lower the portfolio size, you have around 20-25 plus. The higher the portfolio, around 17-14%. Overall, if you look at it, the demand for the size of the cake is improving. It is increasing. More number of customers are onboarded. NTC, we call it new to credit, and the new to banking is just going up. When you have a NTC and NTB, you need to sharpen your skills for understanding their ability to repay. So the risk underwriting plays a very, very important role. And it depends on the behavior of the consumer. It depends on the behavior of the geography. It depends on the collection efficiency of the portfolio. And it talks about the segment behavior. So I'm pretty sure that every bank will have its own risk modeling, which is going to throw out. So if the risk model is in a position to substantiate, supplement this growth, and you have a very strong collection efficiency, or collection mechanism and recovery mechanism, this is not an area to be worried. But however, anything you do it in retail, you have to go very detailed. And anything which is given in retail, you can't afford to sit back and then relax in the chair. You have to be the edge of the chair always. When you have these two visibility in front of you, I don't think this will cause any stress on the balance sheet of the banks. This is how we approach, and I'm sure that others will also be approaching the same way.
If I can just add to what Mr. Subramanian said, I partially agree and partially disagree what he said. I'll tell you why. I agree that on a slightly big picture industry level, is there any major risk evolving? Answer is no, because some of the larger ticket sizes which are there, their risks are much lesser. And but when you look at the entire portfolio and say that if you quantify by number of customers and not by the value of the portfolio, I think there is risk emerging, because there are so many customers who are below 50,000 and there are customers below 30,000 also, And today in the underwriting, a lot of underwritings are happening based on algo-based kind of underwriting which is happening, where algo can only do based on what data is available. Algo can never predict what is going to happen in future. And because we didn't have a cycle on the unsecured side of the business in the last decade or so, the algo will not pick up the cycle of 2008 to 12. And I have gone through that phase that time as an HDFC bank, and I've seen that personal loans were having 26% delinquency and credit cards were having 13% delinquency. So, and none of that is in the algo anymore. I asked this question to somebody in analytics, so he didn't have an answer. So the question is, and fundamental principles, whether you do corporate banking, retail banking, SME banking, whatever, is we need to get the money back what we give out. Okay, that's the fundamental principle of lending. And second principle of lending, which is not followed as much as it is to be followed before in terms of discipline, is where the money is going. Okay, and in algo-based trading, algo-based lending, will never know where the money is going, and you know the end use of the money. So, for example, in credit cards, to some extent, you will be able to figure out where the money is going, because you know the merchants, where it is going, what the end use and things like that. But in a personal loan, rarely will know this. So, given this entire perspective, the risk emerging is not necessarily the banking system risk, but my worry is something different. We talk about NTC. NTC leverages themselves very fast and accelerated leverage very fast, and we don't know whether he's paying his previous EMI from the next loan or he's paying his EMI from his earnings. And NTC becomes NTB very fast, because as soon as he takes the second loan, he becomes the NTB. So the next bank is looking at the NTB and looking at a very, very good score, and as long as he pays this very good, and one fine day drops. The other challenge in unsecured is, unlike secured businesses, corporate, SME secured, is once it drops, you cannot stop the flow. Okay, it just very little you can recover once it drops. Given all this, the bigger issue is a social issue in my view, being that my question here is, and I was seeing that a lot of this digital lending which is happening is also going into the deeper geographies. Okay, given this, my question is, how much of credit understanding these guys have? Okay, do they understand there is a credit bureau? Do they understand what happens to them, especially if it's an NTC customer who doesn't have this knowledge, how much education is being imparted to see that how much, what will happen if they default? And then the smaller ticket size loans which are there, but they are a lot of customers right now, and then they will become a little bit of a difficult situation tomorrow. So my view is that it's not so much of an industry level issue that the whole portfolio will become a huge delinquency, but if you take, instead of the value, the number of customers, the delinquencies can start going up once there is a little bit of a cycle. And is it coming, not coming, nobody knows, but we need to be careful given the leverage which is happening.
See, there is a two different perspective than what Pralay said. First one, whether it is secured or unsecured, what decides the repayment is the cash flow. How many secured are always fit? If all the secured are good and secured, our NPA should be zero. Na? Last decade spoke about how the banks struggled, how we went in and went out. We all are secured. They should have cash flow. See, it is not the unsecured. See, it is a question of classification, how I deploy the funds which I have taken. This is where the prudence of the banker comes into. You can all, faceless loan is the one which caused this tremor. You had apps. And in my anxiety to increase my loan through an app, I'll give you a loan in 4 minutes, I give the loan in 4 minutes and 4.5 minutes and 20 minutes, hardly it matters. If you get into that kind of the race between 40 minutes loan and 4 minutes loan and 4-day loan, then we are getting into the trap, right? So principally what we follow and what I have very strong views on that is, faceless lending will land you in a trouble, be it secured or unsecured. So the apps are good for ordering on my online. They are not good for ordering for a loan, right? That is the biggest difference one has to appreciate, rather than thinking that whether it is a secured or unsecured. If I be able to identify my borrower, identify the KYCB, know your customer's business, even he may be making a small pot, he may be a small chai cup. West Bengal, I am ready to give all the matka, no? Matka, I will give, I am ready to give. because it is going to be consumed. But I can't give it in Tamil Nadu. Nobody will eat that. If somebody says that I'm getting a small micro industries, gave me around 20,000, 40,000, 1 lakh, 10,000, whatever the amount. That is exactly the prudence of the bankers comes. Today's bankers are not somebody who was just born yesterday. They are there around 4 decades. The country has seen multiple cycles. We have seen the best of the time and we have seen the worst of the time. We are also seeing the moderate time. Today the time is good time. So during the good time you tend to make mistake. During this time if you are able to hold back your views. And if you provide for, like an ants, like if you are able to store for the winter season and the rainy season by providing little more than what you earn, I don't think you will be going to get in the trap of the down cycles.
The only issue here is, sorry, please go ahead.
Yeah, just to contribute to the discussion which is going on right now, I will give you an example actually to support the point of view. We had this loan, which is the unsecured personal loan to the government employees. So it was basically the manual process, and then the customer satisfaction was not up to the mark, and the business which we were getting was almost half. Say 12 crore, 13 crores per day. And now we have shifted this entire thing, of course, with the logic to STP. That means in a few seconds, maybe 15, 20 seconds, this money is available to the customer. Now, I'm telling you that the amount of business has gone double, and around 65, 70 people we were deployed. Now, no human intervention. All these people have been spared for different other activities, and the business has gone double. The customer satisfaction has gone to the next level. So it is the question that what type of logic is there, what type of underwriting skills you are having, and what type of business you want to do online or through app. That is more important. You cannot have it run of mill type.
Except, I'll just take on what Mr. Subramani Kumar said about KYCB. But if you don't, you can do KYCB, but if you don't know the end use of the funds, I think you have very little control on, on repayment schedules and, ensuring the sanctity of that loan. Let me ask you, Mr. Prakash, you in a recent interview spoke about competition for deposits and how that is impacting your cost of funds. But beyond that, at a broad industry level, we have seen credit growth far outpace deposit growth. We have seen the credit deposit ratio go out of skew, and RBI has also voiced its concern about the nature of the ratio. We've also seen another interesting phenomenon where banks which are expanding their brick and mortar footprint through branches are increasing their market share of deposits. So very clearly there is some kind of shift happening. There is some kind of movement of distribution of deposits happening in the industry. Do we see, so what kind of scenario do you envisage? Will banks that have large branch network get the maximum share of deposits, while banks with lower branch network have to depend on the capital market for funds? Or how will this all play out?
So my view on this is a very, very important point actually. So as far as, yes, the branch network is concerned in the deposits, that plays very important role, because customer want to interact with you than before depositing the money in the bank. That is true, but one thing is there, the loyalty and the comfort of the customer is equally important. Even if you have 3, 4, 5 players at one place, the customer will prefer where he will have more the comfort level as far as deposit is concerned. I will again bring to my point, these are the live cases. So as far as our people are concerned in our area, we have been consistently maintaining a CASA ratio of above 50%. And this is a real CASA. This is not a 7% CASA or 6% CASA. So this is the real CASA, and we have been consistently maintaining. Now how can we do that? So this is basically the connect and the service and the culturally, the synchronizing the culture of the people who are at the counter and the customers. So this has been a very, very strong point. Yes, Of course, it has been for the last around a few year or so, the credit, the cost of credit has deposit has gone little high because we have to align the interest rates with the other market players. But going forward, I think this trend may continue for another 6 months or so. But I think after that, it is likely to be, normalized.
See, I subscribe to your view. You just take the simple example, the British era tall and strong building instilled the confidence on the public first. Otherwise, some of the front-end private sector bank would not have changed. A decade before they said that we can have one at somewhere in Bombay, South Bombay, I'll have a branch, but I'll be able to reach to the corner of India and mobilize a deposit. Now they are going to the nook and corner of India. So the reality in our environment is that. That's what I understand and I try to infer. You need to have the presence of the bank, brick and mortar building in a town to instill confidence, instill the brand recall, to feel that yes, there is a branch building, my deposit is safe. You need to have the brick and mortar in order to create that brand recall in a city. You don't have to multiple. Once that kind of brick and mortar expansion takes place in a city, thereafter you can substantiate it with a multiple sales team on the floor. Then it will work with the combination. The digital comes third, right? Without any branch, without 3 branches or 5 branches, we would not have grown to this extent what we have. We have just grown it. So definitely the combination of the branch will give you a entry. Then your sales team and the ability of your servicing and your superiority of the product will make them to look at you. Then your digital will play a role for amplifying it.
Mr. Tiwari.
So we are seeing 3 broad trends. One is that since here, whatever one offers on CASA, and he mentioned about 7% CASA, in our case, still a 3% kind of saving account. People are moving those balances to the fixed deposits. That's one big trend we are seeing. So growth in fixed deposit is very strong, partly a movement away from saving bank, partly of course the new deposits. Secondly, we have to look at the growth in the capital markets. So the number of demat accounts opened, the mutual funds flow, 50 trillion, the mutual fund balances have crossed. People are moving big time into equity, all that. So I think move away from the banking deposits which are paying less to these things are also taken place. The third thing is that in certain senior citizens deposits, for example, the one which had a cap of 15 lakhs had been 30 lakhs. So all of those things add up, and that's why the competition for deposits has grown. And of course, the final thing is the need for deposits to support the credit growth, which is, as mentioned, has been in excess of the percentage growth of deposits. In fact, for the much of last year, it was almost double or more of the percentage terms, but also in few cases, absolute terms as well. So clearly, if there is a need to support that growth, it can't just be done on borrowing, it has to be done through deposits largely, and therefore the need to pay the depositors more. And that's the reason why the deposit growth, there was a pressure on rates as well. But I would also argue that the Indian depositor needs a fair deal. And now at least there is a positive inflation-linked return, which for a long period he wasn't getting.
So I want to address it a little more structurally. Structurally, 2-3 things are changing. One is, of course, the system liquidity has been negative for a while now. And with that kind of a liquidity, obviously it's the reason why the system liquidity is kept low, A, to manage inflation, and B, to look at a brighter future that is being done by RBI themselves. Given that perspective, ultimately if the system liquidity is low, there is always going to be scrambling for deposits. So that is one thing which hopefully, as one of the speakers said, that in the next 6 months, we have better control on inflation and on the global rates, what Fed does, etc. That part should ease out a little bit, and hence hopefully we'll all breathe a little more easy that time. The second structural shift which is happening on the CASA, and this happened many years back on CA actually, was when CMS was implemented, and a lot of things which was because of system inefficiency, there are a lot of floats which used to be in the CA. When ATPA checkbook were issued and then digital things came on, etc., CA floats vanished, but that was replaced by fees in the banks. Same thing is happening with UPI, with that kind of unprecedented growth that is happening in UPI. The efficiency and the quick turnaround time, customers having, ultimately savings is also a float of salaried and savings accounts, and that is based on a consumption. Today the consumption, you don't need to worry about it because it's either a standing instruction or a UPI which happens instantly, and hence customers are a lot more knowledgeable and are able to use it, and then structurally there is a shift in happening in CASA, both on CA and SA, and that's technology that's good for the system from an efficiency perspective, and also because deposit rates have gone up, automatically some customers, especially the larger customers, will move money where they get better rates, and hence that happens in every cycle when rates goes up and goes down. The third thing is ultimately the stock markets has been doing very well for a while, and a lot of money is going to the stock markets. In a way that comes back, I mean SIP, unprecedented growth, that comes back to the banking system itself through a structured process, but that's not exactly deposit, right? I mean it's a different either CD or borrowings or through some process the banks come back. So to answer the question, your fundamental question, these are structural changes which are happening. But if the country has to have a 7.3, 7.4% growth in this FY, and FY26 also, maybe there is a little bit of FY25 slowdown and then it will pick up from FY26, that's what economists are saying. If that happens and if we take a 7 to 8% kind of a growth, then, and the nominal GDP is somewhere around 11%, kind of a nominal GDP 11-12%, then you need a credit growth of somewhere around 17-18% consistently to achieve that kind of a GDP growth and that kind of a 30 trillion GDP by 1947 or 7 trillion by FY27-28. So if we have to do that, the fundamental strength of a bank is not either how much personal loans they are doing or what digitally they are doing, but what is more important is what is their liability franchise? How much customers, liability, wealth and all these businesses they have, and liability franchise will decide the quality and the strength of a bank, and based on that the entire banking system will grow. So some of the larger banks obviously have a very strong liability franchise, and if you look at it carefully, a lot of larger branches, including some of them sitting here, they never stop branch growth, okay? And obviously it has gone up a little bit more, but the format and form of these branches have changed. It's no longer what used to happen. There is to be operations, there is to be service. Now a lot of these operations have moved off the branch, a lot of services have moved off the branch. It's mostly sales, wealth, those kind of things are happening, assets cross sales and all this. But branch is required because when customer has both the options, branch and digital, he will obviously not choose one of them, he will choose both. So in India, customers will ask for both, and banks have to invest into both. So branches and digital both will be required. Having said that, I think deposit growth is going to be the fundamental strength of any bank, and rates is only a matter of time, but eventually the deposit franchise is about customers, what service we offer, how to ensure to retain our customers, and how to ensure we cross-sell more, because once we have more products, especially on the wealth side or the asset side or card side or whichever way, then automatically the balances goes up in the accounts. So I think that's fundamental strength of a bank that has always remained, but it is only going to become more stronger.
So if credit has to go by 17-18% on average every year, how much of deposit growth do you think we will
That's
need?
an issue. So if you look at it, there are 4 or 5 parameters on which a deposit franchise is measured, right? One is CD ratio, one is NSFR, one is LCR, one is CASA ratio, and obviously how the deposit growth is happening. Now, the question here is, if you look at last few quarters, almost a year and more, okay, the credit growth has outpaced deposit, including this quarter. Now, I think if I'm right, the private sector banks are now around 87-88% kind of a CD ratio at this point of time.
One private bank at 103.
Yeah, but I'm not talking about specifics, I'm talking about a slightly larger picture. Obviously, banks like SBI and some of the other banks are very good on that front. But the truth is that some of the banks which are aggressively growing the assets book, okay, the liability book has not grown that much, and hence we are seeing 88%, and there are some banks above 90 as well, and hence regulatory concerns are not, obviously is important. And also more sophisticated is the LCR, by which you also look at the quality of the deposits and the quality of the funding, I'll say, because borrowings also comes into LCR and calculations and things like that. So given all this perspective, this cannot go on. The deposit growth has to pick up, and it has to match, because once you are closer to 90%, there's no choice, right? You have to somewhere catch it. And I think it's a question of once the liquidity comes back in the system, I think deposit growth and asset growth should be matching each other.
Yeah, I think, yeah, with elections coming, I think you will see surplus liquidity in the system very soon. My next question, direct question, is to you, Mr. Mondal. You worked in various companies. You worked in FMCG, if I'm right. You worked in IT, and then a large part in the banking system across different kinds of banks. And you're now heading a bank which has seen a change in its management structure, in its governance structure. You know, so a broader question, the governor today said, while standing here, and he's, you know, said this in the past also, he's concerned about gaps in corporate governance in the banking industry, you know, in terms of management and as well as the board level. As a senior and experienced banker, you know, can you tell us from your experience, where do these gaps exist and how can these gaps be, you know, filled up? What can be done by the banking industry to, you know, close this credibility gap? I mean, because if you have a governance gap, then there is a credibility gap.
No, I think this is a great question. So, between various industries I've seen, I personally think it's not that banking has the largest governance issue, but the key question is that banking cannot afford to have a governance issue.
Yeah.
Because we are dealing in public money. What is a raw material? It is public money. When you're dealing with public money, you cannot have even a 1% governance issue. That's where the challenge is. And given certain things which we have seen in the banking system in the last decade or two, the concern is not unfounded because, you know, whether it's at the board level or at a, you know, various decision-making level, credit decision-making level, I think it's a great thing that regulator is putting this as the largest agenda, because when we had the meeting, RBI meeting in May, I think, May end, when RBI governor addressed us, this was his top of the agenda, governance. And when we look at the board and the way now that 2 statutory auditors have come into the system compulsorily, you know, as a mandate. So all these and the way the kind of board responsibilities are coming, accountabilities are coming, it's very, very clear that, I mean, I have seen boards 10 years, 15 years back, vis-a-vis what I see in the board, the attention to details, the way the boards are looking at things a lot more than what I've seen. And that's true for statutory auditors as well. I mean, even concurrent auditors, the attention they gave because they are made accountable. Is it right? Yes. Does it slow down the pace a little bit at times? Does it become a little frustrating at times because we think it's so much easy, otherwise we have seen things happening so much easier, etc. I think when you look at from the very close angle, you may get a little frustrated, but when you take a zoom view from our top, I think these are issues which needs to be addressed from a overall governance and risk perspective. And it's not that accidents didn't happen before, and hence it may happen in future as well. So there is no harm in having a more stronger corporate governance, because again I said we deal in public money.
In my view, what I feel is that it is a clear role play. The clash of the role is probably being told as a gap today. I can give a very simple example. A guy who has been working as a management team, as an ED and MD for a long time, he rolls up to the board role. He is not able to shirk his position as a management. He continued to do the role of a management sitting in the board, which is not the case, right? There's one. There is a little difference or no difference in seeing oversight and oversee. By sitting on the board, you can't oversee the transactions. But sitting at the management, you cannot avoid that requirement of the board's oversight of the activities which is done. If the roles don't roll up to the executive committee and which in turn roll up to the board committee, if every aspects, be it a control, support, and the business, they roll up to the respective executive committees, which in turn rolls up to board, the conflict and the gap will reduce. Still, the one who is looking from the third angle will always be able to find some gaps, but it is a question of improvement, right? And the regulators' prescription and the interference is perfectly right. They held a meeting with the respective management teams, executive directors, as well as the non-executive directors. The role clarity which has been brought out in terms of the governance structure in 2022, there is one circular, which if you want the soap opera, the Ramayana to be a perfect, Ravana role has to be played by Ravana, Ram is to be played by Ram. And I can't roll up the roles together and say that we are Bhais, we can do that. So outside the stage is different inside the stage. That clarity is just emerging today. See, with the right amount of interruptions and oversight and supervision, it is coming up. And I'm pretty confident it is not something which is very far away. Maybe a short period, this clarity will emerge between the players, and this role clarity will bring in the better governance. It is improving. And as he said that there is nothing like not governed. It can be better governed. Today it is governed, it can be better governed. That's the moment which you are looking at.
So I'll just add a couple of small points. When we talk about corporate governance, generally the understanding is there a misgovernance? That may not be the case. The question is, the environment is changing so fast. The technology, the cybersecurity, the analytics, the threat of AI, all of these are very new areas. Most of the people at senior level do not have experience, so they have to depend on either consultants or younger players, etc., etc. So do the boards actually understand that these are the new areas and what are the opportunities and the risks both? Is that sufficiently discussed? I think this is one aspect of governance which is not articulated so much, but I think it's an important point. Second, of course, is in newer areas which were always there, part of governance, but not stressed so much. But now they are being asked, for example, succession planning. Not only in the private sector, but also in the public sector. RBI is asking us that question. And third, of course, is does the board sufficiently challenge the management, whatever assumptions of management are? And linked to that is a discussion on strategy sufficiently happening in the board, or is it a strategic outreach separately, which is how it is being done? I would also argue that the compliance burden today is so high, maybe for right reasons, that there is, if you look at any agenda of a board, it's 60-70% items are compliance. So therefore, where is the time for a board to actually understand all of that and actually do a very good job of that? I think that also needs to be seen. Can we actually reduce some of it, some burden, and make it not every information needs to go to the board? That's, I think, something we need to work on. Much of that is regulatory, so that needs a discussion.
Thank you. I'm going to stop here, and I'm going to throw this open to the floor. So, any questions? Yeah, you'll please state your name and your organization before asking the question, and keep your question brief, please.
Hello.
Yeah.
Yeah. Okay. Of late, we have been hearing.
Your name, please. Sorry.
Yes. Sorry. Okay. I'm Sunil Mehta, which is quite popular name in banking. Probably people on the dais can understand. Okay. So, of late, there have been a lot of thinking, a lot of discussion about this green financing. Probably SBI has raised a lot of funds on that. We just want to know whether there are any product which green finance can be used for refinancing of the existing project, which is green in nature. I'm not talking from the renewable point of view, but in general manufacturing unit which has taken all the care of green project, whether it can be refinanced.
Yeah, it can be, but see, the fundamental challenge apart from the renewable side of things in green is the definition issue. There is no definition existing today in India which qualifies a particular project as green or not green. So if that be the case, every bank has to then define its own and hope that it complies with some of the objectives of green, now that the green deposits are allowed by RBI. But again, the use cases given are not very exhaustive, so that we have to depend necessarily on the sovereign bond issuance use cases, etc. So we have been in conversation to say that, okay, let us define industry-wide what should be green. Is it a reduction in emission? Is it some renewable? Everybody understands, you're right. But other than renewable and other than EV and other than some of the very commonly understood things, how can it be? My sense is that as we define that, an existing industrial unit can surely be refinanced and we can call it green, if that is qualifying the definition.
Just one follow-on question on the same. Like if a company, corporate itself present to the banker that, okay, this is the green for this thing, and banker can take its own view whether it's green or not, and then they can avail concessional financing in that terms.
I said yes, it can happen depending on the definition which the bank has.
Any other questions? Yeah, there's a question here, please. Can we have a mic here?
There is a structural shift in the
your
way.
sorry,
I'm Raj. There is a structural shift in the way Indian people save. I mean, now they are increasingly becoming investors from savers. So their return expectations has gone up and it will go up further. So will it not increase the decrease the net interest margin of the banks, and overall growth will not hamper the overall growth in advances side we are talking about?
So who do you want to reply to this?
Anybody. Mr. Pralay or anybody can take this.
NIM is not the quotient of one or two parameters, right? It starts from capital allocation. And it was a strategic view of the growth of your bank and whichever the way you want to do it. No doubt, the avenues for the investor has grown. The people who were hitherto not, India was only a saving country. Now it has become an investment country. So look at that. Somebody was telling about the statistics that FII is also worked out. DIA is able to do that. But the amount of depth this market can create is humongous. Like that's why there is a SIP is getting around 18,000 crores. This 18,000 crores has to be reinvested in either the market or it has come back into the system unless it is going to, it has to earn. Ultimately, it has to touch the bank in one form or the other, either in the form of the fee-based income or it is going to be in the form of a holding back in the bank for the purpose of redeployment, maybe a short term. So ultimately, at the end of the day, the NIM cannot be the factor of this alone, this factor alone. No doubt the cost of deposit and the cost of funds is going to hike up a little bit. And if a capital allocation is prudently done, we have our own way of protecting the NIM and going about it. So it depends on banks to bank, and the boards will definitely have a letter.
I'll just add, sorry to cut you, but I'll just add that mutual fund, if they grow, or capital markets, if they grow, where is that money going to go ultimately? It's going to come back in investment into firms. And therefore, in that sense, the regulator has been focused on market mechanism, that's so that the banks are not the only vehicles to invest. So in that case, if this is happening, it's not such a bad thing. Yes, our loan portfolio may not see that kind of growth, but with the 56% credit deposit, credit to GDP ratio, I think there's a lot of scope for everybody in the market. So that's all right, I think.
And, so, see, one of the challenges in India itself is the entire system is dependent on banks, okay? And whether the debt markets or the capital markets has not yet developed the way some of the developed markets are, and if you have the dream to be one of the top 3 economies by 1947, naturally some of these developments are overall good for the country, good for the industry, and good for banks also in the long run, because then risk gets diversified. So I don't think that's a challenge. Coming purely from a consumer perspective, what you said, yes, consumer expectations has been going up, and that will continue to go up because they are more knowledgeable with digital processes, etc. The inefficiency through which the bank system make money is no longer there, and hence banks has to find out new revenues and avenues to make money. I think 2 components, one is the NIM and one is the ROA, okay, and automatically others ROEs and others falls based on that. So even if NIMs goes down for some reason, if you can protect the ROA, because as I said before that during the days when CMS got introduced and current account float started going down and it got replaced by fees, similarly banks has to look at saying that how do we make customer level profitability better, and that can only come if you have loyal customers and if you have a long-term franchise building kind of a concept where you have more products with the customer. That's the way the ROA is built, because every product returns may go down, but at a customer level, if you do a holistic approach, then we can make more money from a customer, especially on the wealth side. And actually, when a customer puts money into wealth, I've seen that based on broking and other avenues through which the money flows, those floats are much bigger in general. So given that perspective, banks which look at more at a customer level, service, relationship building, etc., this is on the consumer side, will always make more money, and to some extent that is true for the wholesale side as well, because you generally do not only get NIMs or get interest income, you get fees through transaction banking and other things. So ultimate rule of the game is, in my view, is how do you get more products to the customer and how do you get more satisfied customers and more loyal customers, and you don't have to keep going and attract customers and get new customers. If you do that, I think ROE will be protected. NIM will depend on cycles based on interest rates and things like that.
Are there any other questions? Oh, there's one hand there. Can we have a mic there, please? And I think that's going to be our last question, because we can see Mr. Kamath is sitting here patiently.
Hi, I'm Rajesh Chaudhary. I'm CIO for CSB Bank, and I'm going to have a technology question. And if I may request a response from Mr. Ashwini Kumar Tiwari and Mr. R. Subramaniam Kumar on this question, because I already have my bank's MD on the podium and I have discussed this question with him. So in the recent news, RBI Deputy Governor Mr. Swaminathan has directed banks to invest significantly in technology. I'm sure all of us have heard that. So I just wanted to understand your views on this. Why do you think RBI is recommending this, and where do you see more technology investment going into the bank? Thank you.
You have a conflict of interest issue. Anyway, so technology is something which is required everywhere. If you start with the customer experience itself, for better customer experience, real time, getting the entire spectrum of whatever the customer's relationship with, all of that needs technology, whether it's CRM enhancement or UI UX or the app, etc. All of that needs enhancement and continuous upgradation. It's not one time which one would have done. Second thing is that so much of analytics is happening now. The models are being created not only for business sales, but also for risk, fraud and all. So therefore, these models are based on artificial intelligence, analytics, etc. That again needs a lot of investment in technology. We are not even talking about the generative AI-based models, which surely are going to come in now. And they again will be very, very costly for setup. So some banks have ambitions to set up their large language models themselves, but it needs a massive amount of investment. So those are the other use cases. Finally, on the risk side, if you look at any kind of risk, we all thought about credit risk only, those models are there. But if you look at the fraud risk, where the next set of frauds could happen, and we are looking at the digital frauds as they escalate and scale up in the economy. We are looking at climate risk, that nobody has created a model around climate risk, and after the regulator comes up with scenarios, hopefully in the next couple of months, we will have to create those models, use data. So all of this needs a lot of investment in technology. So I think what he says is right, and one point which he laid was the nature of the business continuity planning itself, that are the banks really in a position that there's some impact on either through a ransomware or any other eventuality, are there readiness to shift completely to the disaster recovery? Is it all aligned? I think all of that leads a lot of investment continuously. So technology is something which is a continuous requirement for all banks, all players.
See, today most of us use the technology for delivery of service and underwriting of the service. What I read from that particular direction is that please ensure secure delivery, secure undertaking. So this clearly goes to the fact that the customer is to be protected, then naturally the delivery is to be secured, because there is a whole host of people available outside to see that the delivery is disrupted. Elsewhere in the world, you know about a story where they said we are a technology company doing banking. What I understand from this, you continue to do banking, use technology to supplement and invest in that technology to ensure that you continue to do the banking. That's why that has to be read.
I'm going to do a hard stop here. And may I request you all to join me in thanking the panel here. They've done an excellent job. Mr. Prakash, thank you so much for joining us.
Thank you. Thank you, Raj. Thank you so much. My pleasure.
Thank you. Thank you so much.
Thank you very much. Thank you, gentlemen. Thank you, Mr. Prakash, for joining us virtually.
Thank you.
And
Thank you so much.
So Rajrishi, I'm going to request you to kindly present a token of our gratitude to our panelists who are present with us on stage, Mr. Tiwari, Mr. Subramanian Kumar and Mr. Mondal. Thank you so much for some incredible insights that you gave us this evening. I request you to please come together for a group photograph. Can we have a huge round of applause once again, ladies and gentlemen? As we're inching towards the most awaited segments of the Mint BFSI Summit and Awards 2024, for the very last time, I'm going to invite you to join us on the online conversation. And don't forget to use hashtag MintBFSI 2024. Ladies and gentlemen, we now have the privilege of having with us one of the most celebrated bankers of our time. I think every person in the room would know that he transformed ICICI Bank to one full of energy, which further transformed India's retail lending landscape forever. And he created a legacy that is going to be hard to match for anyone leading India's top banks in times to come. He now has the responsibility of the nation on him as the chairman of the National Bank for Financing Infrastructure and Development. He is the government's trusted hand in guiding the infrastructure growth of India. How significant is this for all of us in the room? And how is he going about creating one another magical legacy? That's what we're going to understand in our next conversation. While he meets his colleagues and friends, let's give him a couple of seconds here. Meanwhile, I'm going to invite Mr. Ravi Krishnan, Editor-in-Chief Mint, to join me on stage. And I think that is my cue, ladies and gentlemen, to invite you to join me in welcoming on stage with a huge round of applause. Hold on. Numbers are being exchanged. Chairman, National Bank for Financing Infrastructure and Development. Let's give it up for Mr. K.V. Kamath. Welcome, sir. Welcome.
Thank you, Mr. Kamath, for taking time to speak to us today. So, the year has started on an optimistic note. The advance estimates for GDP at 7.3% for this financial year came as a surprise. Just before that, the IMF was, I felt, grudgingly, complimentary about what India is doing. I wanted to start by asking you, many people are calling this the India decade, because of the resilience which we have shown in the past couple of years after the pandemic. What aspect are you most bullish on and what worries you the most?
I think we have clearly shown several things or proven several things to ourselves. That we could ride, first the COVID crisis, because it now looks like it's distant memory, but for me it was fresh. Because that was probably the first event in my life where I didn't know where we would head. And then the pleasant surprise was how quickly Indian industry bounced back, how well the economic conditions and the whole process of stabilizing was done, both by the Center and Reserve Bank of India. And within 6 months, corporates came back more efficient than they were. And I think the hidden gain there was probably a 25% productivity bump, which as yet no economist talks about, but it's very clear that was there. So I think we proved that. Then the war of the last 2 years, that again we managed pretty well. And it's not just the regulators or the government, but the system managed very well. So I think we have now understood that we can chart a path for ourselves, despite what's happening in the world, And if we have to work to the upliftment of 1.5 billion people, then there's a long field of opportunity. So I'm not too much worried about many things given the last 2 years. I think there was enough of worry, and we have passed that hurdle pretty well.
So would you say it's only the geopolitical situation that worries you?
Geopolitical also, if you see, I think we have, in a way, learned how to tackle it. And as we get stronger, and as we pass through the period that friends who had earlier talked about, the 25-year or the immediate 5 years or 10 years, we are going to get stronger and stronger. So I'm not too worried about it. If you look at one number, I think what would have worried everybody most about what's happening on the balance of payments. I think we are getting into a situation where we may not have that worry anymore, given the sort of the jump we are seeing in services numbers. From a negative, it has become a positive, and as yet nobody is putting a firm number to it. But I'm clear, if that trend continues, I think those worries will be of the past. So we are finding other ways in which we can compensate for any global challenge.
What about private investment? That also seems to be not picking up as much as what has been expected.
You mean corporate sector investment?
Yes.
Yeah, actually, I had mentioned this earlier somewhere else, that there are two things that are happening here. When I started my career 50 plus years back, it used to take 4 to 5 years to build a project, a greenfield, and it took about 3 years to do a brownfield project. Those times have now come to probably 18 months to 20 months or 24 months for a greenfield, and probably less than a year, 8-9 months for a brownfield project. Given that, corporates don't need to build in advance, and I think they are building it just in time. And there's one more important thing. We have been used to look at banks' numbers as proxies for what's happening on the investment, on the ground investment. I think we need to move very quickly to looking at the sum of the corporate fixed asset growth plus capital work in process growth. And that will tell us much better numbers. Because today you have not only bank borrowings, but a very strong cash accrual that is coming through in corporates. Because you are deleveraged, and all that cash that you're throwing up, and you're profitable. That cash that is throwing up is not going out to repay bank loans, but going out to fund yourself. And if you need something more, you then always have the capital market to look at, either for additional long-term funding through bonds or equity. So the reliance on banks also is going down. So how it will play out, we will see over the next 2-3 years. But for the last 2 years, I would believe that corporates are investing through cash accruals. They have deleveraged themselves. They are investing surplus cash into projects as necessary, and the implementation time has crashed.
So as you say, corporate balance sheets have improved, and so have bank balance sheets. A lot of bad assets have been kind of written off. But having said that, do you think that our push for the resolution of these bad assets, it is kind of faltering now? I mean, 7 years after IBC has come, IBC capacity is still an issue. There are some 7,000 cases which are waiting to be even admitted to NCLT. So is there a gap there?
I think that it's a learning process, because I have gone through various phases of it. Resolution taking forever, projects never got resolved. Then came BIFR, where again you went and got stuck. And then came SARFAESI, and now IBC. I think it's a learning process. And I'm sure there are success stories there, and I would write those success stories. And that learning is being taken to heart, and I'm sure changes will happen.
Right. How do you see this RBI's decision to curb lending in the unsecured segment?
Well, I think if you look at the numbers, and probably the worries are right, because you probably had what one can in banking terms call unbridled lending and unbridled growth. And I think there are several pointers that are coming through from various sources. If you have a deep conversation with the credit scoring companies, they will tell you a story as to what's happening with the individual borrower. If an individual borrower is being lent at scores well below 700, which most bankers would see as threshold, and then that borrower has 3 or 4 loans. As a banker, you figure out what's happening. There's clearly an evergreening happening there. And indeed, the regulator would be concerned. And I'm sure the regulator knows more about this than at least I do, and most of us here. The reason is the regulator is an overall picture, whereas we may have a specific picture or an anecdotal picture. So I would think that that was a right step at the right time.
Are there any other areas of concern, you think?
No, I don't think as of now there is anything else. Good news for me is the corporate book is honestly clean. I believe it's genuinely clean. If that also had any risk, then I would be really, really worried.
But then evergreening was one of the key reasons that was cited by RBI when they clamped down on this alternate investment funds recently.
Yeah, but that's exactly the point. So that's where you have a problem, where evergreening is happening through another route. I think it was very quick action on the part of the regulators to identify this and block it. So I welcome that step entirely. People who don't like it, but if we have to continue the health that we now have for the first time in, I don't know, the entire, in banking history, where banks are running healthy capital adequacy ratios and NPAs less than 1%, strict action is required.
Do you think it will kill the AIF industry?
We'll have to see, because I look at AIF as there are a whole lot of other avenues which will be very worthwhile. I think this was, we will have to look into more details of who and where, then you will have a better picture. Who were doing this and what sort of thing was happening. But I think in the next few days it will come out. I am reasonably sure it is not the banks which were doing it. It was a systemic issue, but who the systemic players were, let it come out. But I am reasonably sure it was not the banks.
Sorry?
I am reasonably sure it was not the banks trying to game.
Okay, right. In your past interviews, you have been talking about fintechs, as disruptors in the financial services industry, and you ask bankers to wake up. But one thing I would like to ask you about fintechs is that most of them don't seem to have any sight on profitability. I mean, how will the state of affairs sustain?
Yeah, I think there are several things at play here. I think we can talk about the fintechs, and we can talk about how technology will impact banks. And I think we need to address both. And I heard that, I think the last question, or the last but one question on the emphasis on technology. I think, again, the regulator having put that emphasis is really right. The problem, as I say it, is not necessarily investing more, but I would think the challenge for banks is renewing technology that they have. We've already seen systemic challenges in a few banks because of technology which creates problems. And we have seen that in the past, going back very long back, to what sort of rigidities the mainframe cost. Of course, now everybody has forgotten what a mainframe was. But then we were working with nimble machines. It was state of the art for that time. But in the last 6-7 years, with not only cloud, but now open source coming in, your competitor is going to be much more nimble, and you are going to be more and more stodgy. So competitor nimble, well, let the competitor be nimble. But if I were a bank, I would say, what would I do to become nimble? Which would mean that large parts of my technology platforms will have to be replaced. And good news is it can be done virtually at no cost today. I repeat, at no cost today. So it's not a costly exercise that we went through in the past. Implementation of open source is so straightforward and so simple that implementation of cloud-based solutions itself was simple. We did it in Bricks Bank. Basically, simple solutions installed within, say, 4 to 6 weeks. So we could do it here also. Not that it is that simple, because these are established banks with long standing. But attempts would have to be made to revamp technology. Only then will you be able to survive and compete for the long run. As far as the fintechs are concerned, I'm sure that at this moment they are bringing a lot of value through innovation. Let them ride the innovation. They have people who have funded them who are happy. At some point of time, there will be a profitability model that will emerge. But that would need, I think, some help from the regulator also to allow them to survive. So it's going to be an interesting field.
Some help from the regulator, can you elaborate on that?
Yeah, for example, if you look at where is it that they're not making money, I think allowing to make money. For example, UPI is something that is a world beater and we can showcase to the world, but none of the players there are making money. So I don't want to go too deep into it, but if you then analyze how is it that you could allow them to make a reasonable return on what they've invested, I think it will be for the common good of the industry, this development of industry and so on. So we will need to analyze where and how they will need to do this. If not, I sometimes say that they could become good providers of SaaS solutions for banks. So that also is, they could course correct and provide that. So they will find their way.
How would you rate the regulator when it comes to allowing innovation in fintechs?
I think if you look at the last 3 or 4 years, the sandbox approach they have taken, the regulator has taken is remarkable. And that is what has allowed us to leapfrog in terms of the payment solutions that we have had. And that, I think, stands out as a success story for India, how we have mastered the payment solution. Based on my experience, I have not seen too many domains anywhere in the world, the Western developed world, which would match the payment solution that we have here. And who takes the credit? It's entirely the central bank for giving us the ability and the leeway to experiment with this. We could have well said that, look, we are not comfortable with this. And genuinely they would, and probably they would have been right. But they said, let's try it out in a sandbox and then let us allow scale and scoping. So I think all credit to them.
But that said, isn't fintech regulation still in an in-between zone? Part of it regulated, 2 SROs. And I mean, what do you think ought to be regulated and what do you think should be left free?
See, my view is that what they have done itself is tremendous, because ultimately it is touching the banks. So they cannot, and of course the depositor and the bank's customer. So they cannot take a complete broad brush approach. They have to do it selectively. And I think we have to celebrate what they have done. And I think they have exceeded what they could have done. And exceeded anybody's expectations in terms of opening up. So I would think that that's probably the best they could have done, and at the speed that they've done it.
Right. Mr. Kamath, you have been an institution builder. You're known as somebody who has nurtured talent. I'd like to know your views on this attrition challenge which banks are facing right now. How would you have dealt with it?
Yeah, I think there are 2-3 things that we need to understand. I have honestly not looked into why is there attrition and where are people going. But having said that, that's my ignorance. What I would have done is taken steps to build the talent ourselves. See, because we at ICICI, we had to build the talent to grow our business. So when we did not have, I don't think many people know this story. I'll take 1 minute to tell 2 stories. When we did not have people to put into the branch, because suddenly from 50 branches a year, we were told you can open any number of branches. So let's say I want to open 500 branches. Where do I find 5,000 people technically skilled who can operate a computer? So what we did was we codified all our training programs that we would have to teach, gave it to NIIT, and you run it for free. We don't charge you. You can charge what you charge. And when the graduate comes out, we will underwrite to start with 5,000 a year. And very soon that number increased, and we said, anybody can pick them from NIIT. We don't need to. That was first level of people to staff the branch. Then we said, where are the managers? We didn't have the managers. So we tied up with Manipal University to do a 1-year program in Manipal, in-house. I mean, they had to stay in school, as it were, to prepare people who were either a deputy manager, not a manager, or a senior person in a branch. So 1-year program, and it was surprising. We say that there are no people. So I had the same feeling, there are no people. So my HR head told me something, and I have no qualms in telling what he said. He says, you are wearing blinds. You are thinking of the urban thing. There are people in rural India. So I thought he had a point. So I gave him a very interesting challenge. I said, you will advertise only in vernacular press, and then let us talk. So he advertised. He had 100,000 applicants the first year for 1,000 slots that we had. And it still runs. The program, I'm told by my colleagues, still runs. I don't know what the intake now is and what's happening. But so, lesson to me is we need to figure out what are the solutions we can implement, rather than, if they are going, I would cheer them and say that you are going for a better tomorrow, we hope. I give you a pat on the back, but I'll make my own plans to make sure that I don't run out of the talent I need.
Right. We are running out of time, but can we take a couple of questions from the audience? Yes, please, that gentleman. Yes.
Hi, sir. It is always good to hear you. I wanted to know your view about the BRICS Bank because you have been the president there. And how do you see the future for the BRICS Bank? Also, do you see that BRICS as a country, all the nations in BRICS, they can launch their digital currency going forward in this decade of 2030 because world is changing very, very fast. How do you see that future?
The second question I'll answer first because I don't know much about it.
Sure, sir.
But I'm sure that the central banks of the BRICS countries are engaging on this and alternative settlement mechanisms and so on. Because as you have seen in the events of the recent past, that is very much required for the security of our own nations, to have a settlement mechanism, and so that I'm sure is happening. The BRICS Bank, I'll give only one learning that I have had from the bank. So you have a set of countries which on an average never works, but on an average, if you take their credit rating, the global credit rating, is below BBB minus, because BBB minus we call investment grade. It's below that. So if you take the average of the 5 countries that were the founders, and the rating that we got as BRICS Bank was AA+. Now there is a lesson which I didn't understand till we actually worked on it and we got that rating. Now the message is then very simple. Countries of the South can come together, stand together, and raise funding on the global marketplace. We don't necessarily require the West. So to me, if that is a given, then I think countries of the South can do a whole lot of other things, because we can leverage the capital 4 or 5 times very easily, and we can do do a lot with the limited amount of capital. And now there are other countries coming in with a higher rating, so I'm sure they should have a AAA rating, though I don't think that a AAA rating is really relevant, because the pricing difference between a AAA and AA when we went and borrowed was hardly 10 bips. So I think this learning is huge for not only us as members of BRICS, but for all nations of the South, that we stand together, and we can do much better than we are individually doing.
When do you think India will get a sovereign rating upgrade?
Yeah, I think to me it is very long overdue. I don't see that we should have any B or anything lesser in our future. It has to be an A of one character or the other. I think that will happen. I don't think it's too far. If you're already climbed up the way we have in terms of where we are in GDP and where we are in a whole lot of other things, it will be very difficult for people to deny that.
Any other question?
Sure.
Yes, please.
So, excellent insights. What is your view on institution building? What is the right way for a upstart to do that in current environment?
Yeah, I think institution building should be at the core of any exercise that you do. And institution building for me starts from the bottom up, really. So you have to build talent at all levels, entry level to mid levels to so on. And the other key thing that in a way we had to do going long back was to bring young talent. So you need to bring young talent. So that's where the Fintech firms and the Digitech firms have an advantage, because they are building a team from the ground level up, and they have the luxury of taking in young people and building and scoping them. So I would think my mantra is very simple: build young talent, give them responsibility, and then magic happens. It may not be possible in all occasions, but that is the mantra that I would adopt.
So what is your view on de-dollarization basically? Right now, world economy, do you believe that we will have a de-dollarization in the future?
Very interesting question. There are 2 parts to it. I would think that nations will, in a way, approach this through two routes. One is getting the payment infrastructure right. Now, if you recollect, historically we had only one, I would say, backbone, which was a settlement mechanism globally. But now, the sort of, say, UPI architecture that we have, and other BRICS countries, some of the others also have, I would say, very robust payment structures. We could now use some other currency to settle using the backbones that we have. And I think as this gets momentum, I think there will be blocks which will trade and settle in alternative currencies, and it will be to the good. So I think there will be healthy competition for settlement. It will not be an overnight change, it will not be an abrupt change, but gradually as countries get stronger, they would like to trade in their own currency and do things. So it will be a very interesting thing to watch. But again, I'm sure the BRICS countries are collectively looking at this, not necessarily to do away with a particular currency, but to use your own currency for common good.
No, I'm afraid that's all we have time for. Thank you, Mr. Kamath, for answering these questions. Thanks.
Mr. Kamath, Mr. Krishnan, what a fantastic conversation. I'm going to request you to please stay back with me. And if you could join me towards the side here as we clear the stage and we set the stage for the awards ceremony. Ladies and gentlemen, meanwhile, can we have a thunderous round of applause for the legend himself, Mr. Kamath? Thank you so much for taking the time out and joining us here this evening. And now, on that note, it is time to applaud the outperformers of the BFSI stage. Here's a sneak peek into what went into the making of this iconic award. We partnered with How India Lives for banks, insurance companies, and NBFCs, and we partnered with Wisdom for mutual funds. In fact, Mint's data team also jumped into the fray. They played a massive role in the creation of this brand new methodology. Now, banks were segregated into 3 categories based on asset size. Large banks had assets higher than 10 lakh crore. Mid-sized banks were those with assets more than 1 lakh crore. And small banks had assets more than rupees 20,000 crore. We also included small finance banks, and similarly, NBFCs were also classified by asset size. Now, within these segments, they were further segregated by the amount of premium collected. Across all the categories, we looked at scores of metrics largely grouped around business growth, financial management, business continuity, customer orientation, etc. And we analyzed data across 3 fiscal years ending in 22-23. Now, the top nominees that came out of this huge data churn were presented before an eminent panel of jury members who have selected the final winners that have made it to this list. Ladies and gentlemen, it is time to hear from the jury themselves. Let's watch.
Super delighted that Mint is setting up the BFSI Awards, being such a premier financial services publication. It was a wonderful jury deliberation. It was a good mix of data. There was a lot of research that had already gone in, so a lot of data feeding into ranking the potential participants in this in the industry. But at the same time, a lot of subjective factors, including factors like digital adoption, governance, inclusion, reputation. So it was a very good mix.
So I think the banking sector, the financial sector has such an important role to play that if we can recognize the right players, the good players in the financial sector, it will give them the encouragement to do more, to do even better service for the nation.
It's one of the most reputed institutions, like Mint, trying to, recognize, the good work which is being done across the BFSI segment, looking at, various profile of categories that has been decided. Idea is to try and see how to make this a much larger property and canvas and recognize some of the good work which has been done across the industry, across the spectrum. And then I think that's the intent.
Mint is such a trusted brand, and for Mint to have especially singled out the BFSI sector and to recognize excellence is a great sign. I think it will be something which is a look forward to for players in this sector.
It was an excellent experience going through the today's meeting of the jury. The background work that has been done by Mint in terms of making the quantitative analysis of the nominations that they have made and arriving at a good number, quantitative numbers against each entity that became the platform on which the jury could deliberate on the qualitative aspects. Some of which can be treated as subjective, but we are we could build up on the quantitative analysis that has been made. A lot of discussions and deliberations happened on areas like the governance. It has been a really great experience working on this team.
Can we have a huge round of applause for our jury? Because, you know, they say an award is as good as its jury, and in our case, we got really, really lucky. I want to quickly remind all of our winners to please stay back in the room till the end of the ceremony, because we'd like to take a nice group photograph. Gentlemen, please join us center stage as we kick off with the much, much awaited Mint BFSI Awards. Ladies and gentlemen, our first category, Best Mutual Fund Fixed Income. And the winner is HDFC Mutual Fund. I'd like to invite Mr. Shobhit Mehrotra, Head Fixed Income, HDFC Mutual Fund. And of course, I think he's here with his team. Please join us on stage. They maintained a conservative approach with a primary focus on AAA-rated instruments. They implemented comprehensive risk control measures considering parentage, financial factors, ratings, and outlook. Big congratulations to HDFC Mutual Fund. And our next category tonight is Best Mutual Fund Equity. And this award, ladies and gentlemen, goes to PPFAS Mutual Fund. Mr. Neil Parekh, CEO, is with us here. Can we have a huge round of applause for PPFAS? They're core believers in active fund management. Their approach revolves around a focused portfolio of 20 to 25 stocks, striking a judicious balance between concentration and diversification. Many congratulations to you, sir. Then we have the awards for the insurance companies. Our first category is Best Mid-Sized General Insurer. And this one goes to Chola MS General Insurance Company. Mr. V. Surya Narayanan, Managing Director, Chola MS General Insurance Company. I've been told he's been joining us here this evening. All right, let me quickly check if he's in the room right now. Okay, I believe they're not here, but we'll ensure. Can we have a huge round of applause for them, ladies and gentlemen? Thank you. Next category, Best Mid-Sized Life Insurer. The award goes to Kotak Mahindra Life Insurance Company. Mr. Malahesh Balasubramanian, Managing Director, Kotak Mahindra Life Insurance Company. They're receiving the award tonight because their 3-year growth in total premium is 17.1%, in revenues is 22.9%, and in net profit 41%. Many congratulations to you, sir, and to your team. Time to give it up for the Best Large General Insurer, and the award goes to SBI General Insurance Company. Mr. Kishore Kumar Poludasu, Managing Director and Chief Executive Officer. The 3-year growth in direct premium is 17%. Their gross incurred claims ratio is 65%. And the share of claims paid within 3 months is 95%. Can we have a huge round of applause for the Best Large General Insurer, SBI General Insurance Company. And now it is time to welcome our next awardee on stage, titled Best Large Life Insurer. Ladies and gentlemen, please give it up for HDFC Life Insurance Company. Mr. Vineet Arora, Chief Operating Officer, HDFC Life, is with us here today. Their 3-year growth in total premium is 16.4%. In revenues is 47.3%. Let's hear it for them. And the final category in the insurance category is Best Health Insurer. Let's see who's taking home this title tonight. Well, it is Niva Bupa Health Insurance Company. Mr. Jayesh Shah, Deputy Vice President, Niva Bupa Health Insurance, is with us here today to receive the award. They're taking home the award tonight because their direct premium 3-year growth has been 44% and net profit 3-year growth has been 56%, and the share of claims paid within 3 months has been 99.9%. Can we have a huge round of applause? Best Health Insurer. Many congratulations, sir. We come to the next category of awards. These awards are for non-banking financial companies, or NBFCs as we call them. And the first category within this segment is Best Small NBFC. Ladies and gentlemen, join me in welcoming our awardee, Credit Access Grameen. Mr. Garesh Narayanan, Chief Executive Officer, is here, and his team, of course. A total income 3-year growth of 28% and net profit 3-year growth of 73% with a return on capital employed 11.2%. Let's hear it for them. Many congratulations, gentlemen. Time to invite on stage our next awardees who are here as the best mid-sized NBFC. Ladies and gentlemen, keep the enthusiasm going and put your hands together for Manappuram Finance. Mr. Sujit Chandra Kumar, General Manager, Corporate Communications, is with us here to receive the award. Round of applause, everybody. Come on, let's keep the energy going. Many congratulations, sir, to you and to your team. And on that note, we come to the awards for banks. Our first category in this segment is Best Small Finance Bank. And ladies and gentlemen, taking home the award tonight in this category is AU Small Finance Bank. Mr. Uttam Tibrewal, Executive Director, AU Small Finance Bank, is with us to receive the award. Let's hear it for them. Total income 3-year growth of 23%. And a net profit 3-year growth of 32%. Big, big congratulations to you, sir. Coming up is our next category, which is titled Best Small Bank. And the award goes to CSB Bank. That's how you cheer. Mr. Pralay Mondal, Managing Director and CEO, CSB Bank, along with his team, making his way to the stage. CSB Bank saw a 3-year growth of 15% and a net profit 3-year growth of 582%. Ladies and gentlemen, can we please hear it for them? Many congratulations, sir. The next category in this segment is called Best Mid-Sized Bank. And ladies and gentlemen, taking home the trophy tonight is Kotak Mahindra Bank. Mr. Shanti Ekambram, whole-time director, Kotak Mahindra Bank. KVS Manyan is whole-time director at Kotak Mahindra Bank, are here to receive the award. Shanti ma'am, Manyan sir, welcome. Huge round of applause for the Kotak Mahindra Bank, Best Mid-Sized Bank. And just like that, we have arrived at the last and the final category, but also the biggest of them all, Best Large Bank. Therefore, let's give a large-hearted round of applause to the winner of this title tonight, ICICI Bank. Mr. Sandeep Batra, Executive Director, ICICI Bank. With a total income 3-year growth of 12% and a net profit 3-year growth of 61%. Ladies and gentlemen, come on, pour your hearts out. Many congratulations, sir. That brings us to the end of the list of the Mint BFSI Awards for this year. Quickly requesting all the awardees, please pick up your trophies and please make your way to the stage for a group photograph. Come on. We've got to catch up on time. All the awardees, please make your way to the stage. We've got Mr. Kamath in the house tonight and we want to make the absolute most of it. What a pleasure it is, sir, for you to be amongst us here. And for the rest of us, can you please put your hands together and if possible make some noise, because now we're going to go into cocktails and dinner mode. Everybody, come on, loosen up a little bit. I'm going to step aside. Make sure you're holding your trophies correctly. Wow. Yes, a round of applause is in order, because these are the winners of the Mint BFSI Awards 2023. May I invite the jury members on stage? Jury members, please join us on stage. Everybody, please stay with us on stage. Sirs, sorry, but please join us back on stage. We'd like to take a photograph along with our jury members too. Sir, वापस आइए. Award के साथ आइए. Welcome, jury members. You know, we should also applaud for our jury members who've worked really hard along with the Mint team. A huge shout out to the Mint team as well. Guided by a phenomenal jury, we were able to arrive at the list for this year. Everybody, please smile. Don't be serious. And we have got our best shot. Thank you. Thank you so much, Mr. Kamath, once again on behalf of every person in this room. Sir, thank you very much for joining us here this evening. it is only fair that we thank our partners for today. Associate partners, Equirus Capital, IIFL Finance, Union Bank of India, Jammu and Kashmir Bank, LIC of India, Canara Bank, our partners Manipal Signa and Bank of India, Enterprise Reinvention partner Accenture, and knowledge partners How India Lives, and FISDM. Ladies and gentlemen, you were at the Mint Annual BFSI Summit and Awards 2023. Thank you once again for spending a day with us. Turned out to be pretty phenomenal. My name is Zina Fernandez. I'm signing off. Have a great night. Thank you.